Mic check, 1, 2. Mic check. Check 1, 2, baby. Good morning, good morning, good morning out there.
We'll count down to the opening bell. Take another look here at the pre-market. We'll get to some news in the airlines, the semis, software
here
for
we
sure,
go.
and then we'll put into some
Good morning.
context
How y'all
the
doing
Fed
this morning?
commentary we got yesterday when we return.
Bring that over there. I just need like 15 minutes here, half an hour. I got a quick meeting I got to go to with an attorney this morning. Let me see here. We're going to get all this set up here. What you're looking for here, hold on a second here. I got a couple things I got to do. I got some, what do I got to do here? Good morning. Good to see you all out there. I just got to do a quick thing here. Put this up on Twitter. Good morning. How are y'all doing out there? Good morning, Stacy. Go Blue, by the way, if any of you are Michigan fans in any way, shape, or form. Let me see here. QQQs. Let's see. SPX, ES. NQ, baby. Live stream. YT. Twitch. Bam. Yeah. Oh, yeah. So the levels aren't out. So I will check on those right now and the levels, why they're not out at the moment. We did have a, in our house, we had, we had our oldest daughter started college. She's in high school. Started college yesterday. And So our house has been kind of crazy. Like we've all been running around trying to work around my wife's plans. And so I'll go check on that for you this morning. I'll get those levels up to you as soon as I possibly can. Tight 1 second here. Post this. Good morning. Yeah, I'll have those out to you. Blisswitz, I'll have those out to you as quickly as possible, but I'll check on this.
Again, after yesterday's snapback, the high yesterday, 47.67.
Now I'm going to mute this really quick.
Shy of an all-time.
Okay, so I'm going to go. I got to go get ready really quick and then meet with real quick. I got to meet with this attorney. He told me to check my email this morning, give him a shout. So what I want to talk to you about this morning, the important thing, well, there's a couple important things this morning, but the big one is this. Here, let's go to a trigger screen really quick.
Scotiabank CEO sees a 25 basis point rate cut in the third quarter 2024 and 50 basis points in the fourth quarter.
Mute that too. Hold on. That's so loud, dude. Why do they come on so loud? Let me turn that back up and then turn the news down a little bit. Okay, so what I want you to see is this. Oh, this is very important, okay? Very important here. What you don't want to see happen here is some kind of a slide, okay?
Scotiabank CEO Thompson speaking at a
I gotta mute some of this stuff here.
Conference.
What do I gotta do here? Mute this news top. Okay, nice and quiet. What am I pressing over here? Okay, so what I need you to understand here is we don't want to have happen, right? What you don't want to have happen here is we, come up, come down, right? We hit the top of the key, right? We did it earlier in time back here. It didn't take us until Friday, did it? Didn't take us till Thursday, any of that kind of stuff. Already happened, right? So you're down here, you come back down here, you're now back up here at the top of this key here. What you don't want to see happen is some kind, well, I guess if you're a seller, you do. You don't want to see the bloodbath down here and get caught underneath the daily trigger. Okay, pay close attention to this, please. So if you get caught underneath this daily trigger, right, and then hourly trigger comes underneath, right, gets underneath price, right, or underneath the daily trigger, and you've got price now underneath the hourly trigger and the daily trigger, you could see a bloodbath here, okay, where you get a rejection right here and start blasting to the downside. Pretty ugly. And that's where you get your 4,600, 4,630. And this is where CTAs begin to sell. So be aware of this trade setting up to the downside, okay? Very important for you. So if you're a bull here, what you want to be seeing today, tomorrow, is you want to be seeing either a bounce on the daily or the hourly trigger. This would be preferable. That would be where you catch a bounce here off of the HT, right? Come down, bounce, and start to consolidate for a move higher. Does that make sense? That's what you're looking for. That's prime for a bull. Some kind of a move like this, confirming that there's still demand here in the hourly trigger. Now, if there's a bear hit and run this morning, right? We bounce off the daily trigger or break through and come back up. I don't care. I want you to know as a bull that until you're back above, until price is back above the hourly trigger, you really have no trade. Even if you get a V-shaped here, be very careful. You can get sent back down to the depths of hell. So if you're a bull and we break the hourly trigger and we come back down here and slam into this daily trigger, I'm gonna warn you right now. You don't want to get caught in here. You want to get caught above that hourly trigger again. So either price comes back above, crawls its way back up. Maybe it takes a day or two to get back up here. But the concern here is if we break that hourly trigger, we get down to this daily trigger, you'd have no trade. Be very careful. This is a place where bulls can get caught and destroyed to the downside. This week can quickly turn into, hey, it's a bull parade, to trading, it's 460 into a Friday down here. See that down there? And some real blood taking place. So I'm going to move this one up just so you can see it. Do you want to wind up down here? You want to wind up down here, it's got to be a fool's errand, right? This is running into Friday down here. It's bulls on parade. Then before you know it, it's boom, down underneath. Get trapped in here. Get underneath that daily trigger. That hourly comes down, and before you know it, you're blooding into Friday close. So be very careful here, okay? I'll put that back over there. Be very, very, very careful in here. You want to see the continuation of the upside. Hell yeah. Consolidate. Begin to make the move higher. If we break down into that daily trigger, you're still waiting until you get back above the hourly trigger to be like, fuck yeah, we're going to the upside, okay? So today, if you're a bull, if you are a bull here, you are looking for that bounce. If you don't see that bounce, good morning out there. How y'all doing out there? So if you don't see that bounce this morning, you've got no trade. So if you're a bull, right, what are we doing? We're going to watch and use the tools that we use every day, right? Come down here to the hourly trigger. You want to be able to beat with price. You want to see a bounce and then beat your previous high here to begin to attack more upside up here. Make sense? If that doesn't happen, you sit on your hands as a bull. If you start to break through down here, right, bloodbath, get underneath, couple rejections, and you're trying to buy a dip here, and they just blood your ass down to the daily trigger down here. So be very careful. There's likely going to be some sellers trying to come in and do some hit and run action this morning. Target to the downside for bulls today, or for bears, would be 466.18. 466.18. Right down my cursor is right here. For bulls, you're just waiting. You want to see that bounce this morning on that hourly trigger. Good to see you all this morning. So I gotta take 15 minutes. I gotta make one quick phone call. I got an email this morning. I gotta talk. Joe Donut and I need to talk, and then I gotta talk to some attorneys this morning. So just give me like 15 minutes, half an hour, and I'll be right back with you guys. You gotta pretty much, you guys understand where we're at and what's going on at this point. All the tools that you use, you know exactly how this goes, right? So here, if you're a bull, I'll show you exactly what you're looking for right here. You're gonna be looking for some kind of a touch and bounce, touch and go. Right? Failure right there. Come back down. Get above the half-hour trigger. Have the 1 and 5 minute come back up, right? And start doing an attack just like that, okay? Boom, down, and then boom, right there. And you would be watching for that 1 minute and that hour right here. Hi, Kitty. Good morning, Kitty. The cat's in the background. New cat. Right there, right? So be looking for boom, get above there, come back down, confirm the turn, get the half-hour trigger. Good morning, Kitty. Half-hour trigger, hourly trigger underneath, and you're off and running back to the upside. But I'm going to tell you what, till this starts to happen right here, this part right here, don't mess with it. Do not mess with it. You can get wrecked in there as a bull. And just for the record, there's your pullback, boys and girls. That over right there for you. There's your S1. Pivot. There's your daily trigger. S2, S3. Right there. Good morning, everybody. How y'all doing? All right. There we go. Should be good to go there. I'll be right back with you.
David, I covered homicide. You can find out
the hard streets of homicide. I know, back when you lived in your car. And answer to Carl's question.
You know, like no homeowners insurance.
No, and that, by the way, you can't get it now either, apparently. So you were onto something even back then. Yeah, you can't get car insurance either that easily. So you might have even been out of luck there. Carl, listen, we are certainly seeing plenty of reports of potential M&A. We did come into this year with the expectation that that things would be more robust. It's not hard for them to be more robust than they were in the last year, given things were fairly quiet last year when it came to mergers and acquisitions. And we're waiting. We're waiting on Cytokinetics. We're waiting on this Juniper deal potentially that was reported on, that HP. Again, I got nothing to add there. We're waiting on the Ansys deal with Synaptics. We'll see whether we get these announcements. But I certainly did expect coming into the year, given the conversations I was having with many bankers and lawyers whose trade is M&A, that there would be a more robust announcement cycle. And we do seem to be there. David. Many saying as well, Jim, that it wasn't antitrust any longer, that was the number one on the list. It was back to the old issues, social issues, price, things of that nature, and that antitrust had fallen a little bit in terms of concern, perhaps reflecting the fact that many companies are determined to get done what they feel is a strategic imperative, if in fact a deal is that.
Also, keep a note down here. I want to show you guys something really quick. So just on this, one second here. Let's see if I can bring that up. Okay, so this is a way to keep an eye this morning. The gamma picture has changed a little bit today. So your gamma flip is down at 47.30. You see here, see right here, there's your gamma flip. This is support right here, okay? There's your gamma flip. Here's your hourly trigger on SPX. So you kind of don't want to be losing this in any way, shape, or form. So if you're a bull, you do not want to lose the hourly trigger this morning. Very important, key level. You see this break above at 68 million. And then the next level above is at 4,800. So next level above, the high from yesterday is 4,800. Although price is down below at the, close that. Price right now is sitting directly on bull support here. Keep your eyes on this SPX gamma models this morning.
Price, but these are always the issues, the gating issues for deals. We may return to more of an environment like that, which would, Jim, mean that we're going to see more activity.
Right. Well, I remember the ruling on Microsoft Activision. A judge just basically just said, it's FTC, FTC, it's time that maybe you thought about how to do your job. You obviously don't really have a clue. I'm really shocked that you brought this case. A lot of times, David, that's regarded as a suboptimal way to look at the FTC's work.
Yes, without a doubt, that could be considered a blow. And again, we are in an election year, and we don't know what administration is going to run antitrust, let's call it a little more than a year from now. So that comes into consideration as well for a number of companies. But Carl, back to
you're talking about grown-ups.
Yeah, back to your question overall. We're waiting to see some of these big deals that have been reported on as possible being announced, but it certainly does feel like we're going to see things starting to hit the tape in a more prevalent manner.
It'll be fun to watch if it happens. Jim, I do want to get your take. By the way, some broad-based selling here this morning. Healthcare, the only S&P sector that's eking out a gain. We did have Samsung, Jim. Operanet down 35. That is 6 straight quarters of declines, worst in 15 years. Along with the microchip guidance, what do you think's going on there?
Well, I do think that there's two worlds going on. There's the let's not look at the near term, because the near term, microchip is just nuts and bolts PCs. Microsoft, nuts and bolts semis. But you know what, Carl? If you take yesterday was a big look at the future and what Nvidia is doing. Today is a recognition that near term things aren't so great. David, it always comes back to people saying, don't be so excited about Apple, and Samsung is regarded as a proxy for cell phones. So the near term may not be as good. Yesterday we didn't care. Today it seems to be a focus.
Well, you mentioned Apple. Shares are down about 1% after a gain yesterday, of course, and an overall gain for the Magnificent Seven, so to speak. Although Apple is still down 4.6% for the year, Jim. Where do you come out in terms of all this different noise that we get on both sides, sort of about iPhone demand, particularly in China, and increased competition from the likes of Huawei, and on from there?
Look, I think that the iPhone demand in China, we hear it could be down as much as 30%. We do have the very exciting launch of the Vision Pro, February 2nd. But David, if you're buying Apple, you're not buying Apple for the quarter. It just won't make any sense to buy it for the quarter. You're buying it because you think that the franchise is a great one and it can reinvent itself, and that that Tim Cook's doing a great job. But you know what? When it comes to the Magnificent Seven, it's the 7th of 7. And I think Nvidia is the one that's jumped ahead because the near term is so great.
Jim, do you think that Apple will ever try to, I asked the question earlier about Nvidia in terms of other businesses. What about Apple and large language models and the expectations there in terms of them getting involved in their own generative AI effort, obviously integrating it with the likes of Siri?
Well, they do have a relationship. It's not talked about much with NVIDIA. They've not been the big buyer of NVIDIA cards. I do think that they are trying to figure out how to make it so everything, it can talk. When you use your cell phone, the thing that has not been as great as they'd like is Siri. I think they can make that much more involved with artificial intelligence. They are in our lives. They are the... Look, if anyone's going to do anything with the individual, it is still going to be Apple. Most of NVIDIA's enterprise, although they did announce a very good relationship with PC companies, with Microsoft. But right now, David, if you want the individual, it's still going to be Amazon. It's still going to be Apple. Amazon is of the 7. Amazon is the one that has the best relationship with NVIDIA and doing the most. I don't know. I do think that people think that Apple's behind. They just do.
Yeah, because I do know that there is an expectation, again, that they are going to launch their own proprietary large language model at some point, Jim, that will power Siri, that conceivably will be more of a competitor yet again with Alphabet. For example, when it comes to search, you'll just be able to ask Siri. especially in light of back to antitrust. If Alphabet loses that big case, and they can no longer pay them that $18-19 billion a year that they do to be the preferred search on the phone.
Well, David, I'm glad you bet. I think people have to understand there are two antitrust departments. There's the FTC, which has been regarded as amateur hour, even though that their staff is very professional. And then there's Cantor, who runs antitrust.
And
Total heavyweight, used to be at Paul Weiss, does not bring absurd cases. If anyone's going to win a case, it's going to be the Justice Department. I keep thinking that one of these cases is going to go to the Justice Department's way. You can't lose everything. You think you can? You're not saying anything.
No, well, I thought maybe Carl
back.
wanted to get in, so I was giving him a minute.
Oh, that's all right, guys. I'm happy to listen as well. Jim, I wanted to get you on Wells Fargo. Second day in a row now of a downgrade. Yesterday it was Baird. Today it's Deutsche. They do talk about credit remaining volatile, higher level of CRE loans on the books than at J.P. Morgan and Bank of America. We expect a weak net interest income guide given lower rates and sluggish loan growth. What do you think's coming Friday?
Well, look, I do think that Wells Fargo, running by Charlie Scharf, is fantastic. Yesterday's downgrade did nothing. Today's downgrade, remember, Wells Fargo's been the best in the big banks. Charlie has said over and over again, commercial real estate, not really an issue. I think that they're still waiting for consent decrees. This is the one, by the way. This stock was at 62 on February 5th of 2018. It is not expensive. David, what happened with Wells Fargo is that the regulators never forgave them, even though Charlie has gotten rid of everybody. At what point do the regulators say it's the new Wells Fargo run by Charlie and not the old Wells Fargo run by John Stumpf? When is that going to happen?
Jim, I assume it's a rhetorical question. I don't know. I thought it was supposed to happen last year. You don't feel like it did? It hasn't happened yet?
I think it has.
Yeah.
I think these downgraders are underestimating what Charlie Scharf has done. And by the way, David, Charlie Scharf, he is a kind of a rigorous guy. And a lot of people regard him as frankly not that nice, and I mean that in the terms of what niceness is.
If current economic conditions persist.
Listen.
It took me 7 years, David, 7 years to make it so I thought he even kind of liked me.
Oh, no, he doesn't like you.
I did everything
Yeah,
I could. I even like his dogs.
Nah, he doesn't like you. He's told me.
No, he
I
doesn't.
don't like that guy.
He's got one dog named Wells and the other one named Fargo. Like NVIDIA? No.
We did get a little bit of a read on the financials from Jefferies, which we always do, of course. Stock's up ever so slightly. And Rich Handler, longtime CEO there, made no secret of the fact that it was a tough year in 23. Transition year in the economy, in capital markets, and our industry. Challenges as well, he said. And we performed reasonably well. And he eked out a modest return on equity. 3.7% is what that was. And you can see the stock, though, has hung in there and actually had a pretty good performance over the last year as well. Always take a look at Jefferies because it does give us a bit of a snapshot. But remember, again, we are looking back here with these quarters. The question is much more, Jim, isn't it, going to be about what we hear on the conference calls in terms of not just the current moment, but the expectations as well.
Well, David, first of all, Rich Handler, you're absolutely right. I know you're close to him. He's a miracle worker. Jeffrey's stock is up. But, David, M&A, if M&A is back, how can you decide that all we're going to do is look at net interest margin? The money that is made in M&A, David, the fees are huge.
Yes, the fees can tend to be very large, particularly when things really get going. You're right. And so it can become a very profitable business for these companies very quickly. And yeah, they're a beneficiary, certainly in the financing side as well as the advisory side at a place like Jefferies, if you obviously are calling on the high yield markets and or the financing markets overall to help with these deals. So you're right. A robust M&A market helps and lifts the likes, not just to them, but obviously, as you'd expect, the Goldman Sachs's, the Morgan Stanleys, the JP Morgans, and on from there. Not to mention, Carl, all the smaller boutiques sometimes we forget that are public now as well, the Evercores, the PJTs, the Moluses, and the like.
David, while I got you, I wonder if you found the Elliott match story interesting in the journal.
Yeah, I mean, it's a big position. I guess that's where I'd leave it. In terms of percentage-wise, a large position. Don't have a lot of insight, unfortunately, to share there on the match thing. I know sometimes we do when it comes to Elliott. On this one, Carl, I'm afraid I come up a little bit empty right now.
Yeah. Jim, we got some Fed commentary yesterday from Bostic, and more interestingly, Bowman, who seemed to roll back some of her hawkish stance. 10 years trying to suppress back below 4 here.
Yeah, look, I think that there are various people from the Fed who are giving us it's too hot, it's too weak. I think the CPI, Carl, maybe that is going to make it so. Look, I don't want to be a doomsayer here, but if the CPI is too hot, Carl, then you know a lot of the excitement is going to come out of this market.
Yeah, Citi with a nice chart today looking at Baltic Dry, the shipping ocean freight cost index, Jim, which has risen, still 50% below the peak, but it's clear that the Red Sea has had some impact. I guess the silver lining there is that the dry van spot rate, which is more of a ground transportation index, has remained pretty stable in the face of all of that.
David,
Yes.
Morgan Stanley, boy, this is going to be a tough story. I'm trying to figure out how to do this and be a diplomat, kind of like Gandhi. But Mike Wilson's turning positive. That's what it seems like. Now, David, if he turns positive, what does that say?
Not sure. Is he really turning positive? I haven't seen the language, Jim.
Well, I mean, I don't think he is as
screen.
negative. He's talking about equity prices possibly going higher.
Yeah.
Growth could reaccelerate. I just think if you've been wrong, David, and you get a little more positive, well, what can I say? Sometimes you could argue that that's, let's just say, oh, man, how about ill-advised?
Could be. It could be. That said, he had a very good call not that long ago. As we said many times, Jim.
When? You mean like before the big rally?
Yes, I mean before the big rally. Yes. We've said many
Okay.
times it's really
All
hard
right.
to follow a really good call with another one. You know, and that is the
Well, that's
history
true,
of
but
many of these
it's
strategists.
look.
They get one thing right. You can, by the way, that can carry you. That can be a career right there. You get one thing right, you're good.
Well, Mike has it.
Yeah, I mean,
Mike Wilson has it.
marketing's
he called
everything,
He
as
said
we
it was
know.
going to be the top. But I'm just saying, look.
you might be right again. You never know. You might be right again. It
All right,
worries
he
you.
might be right.
It
I mean,
worries
yeah,
you.
no doubt
You don't
about
like
it.
it. It worries you.
Well, David, there are NFL coaches, we haven't talked about the NFL, who were really good, and then they're fired immediately. And by the way, did you see that that the founder of FedEx's son was fired in
I
Atlanta?
did at the Falcons. Yeah,
Heisman.
I did. I saw
Yeah.
that he was.
Unceremoniously.
It's a tough job, man. That is a tough job.
Oh. Yeah.
That's why they call it
the Eagles.
Black Monday.
People are worried.
Yeah,
Wow.
Ron Rivera
Yeah.
can attest to that. Jim, we'll talk more about it after the break. Quick reminder, by the way, you can always get in on the CNBC Investing Club with Jim. Just sign up and find out more at cnbc.com/join the club, or use the QR code on your screen and it takes you right there. As we go to break, we mentioned sort of a light day for data, ex-NFIB, which we got earlier this morning, but we'll keep our eye on bonds and Jim's point about some jitters leading into CPI on Thursday. 10-year still hovering just a shade above 4 with most of the curve in the green this morning. We'll be right back.
American dream.
S&P laggards led by HPE this morning. Of course, stories in the Journal yesterday and Reuters again this morning that the company's in advanced talks to acquire Juniper for about $13 billion. The Goldman desk points out it's about a 35% premium implied and about 15% of HPE's current market cap. We'll get Stop Trading with Jim in a minute. Dow down 280 to start this Tuesday. Don't go anywhere.
Asset.com.
Let's get to Jim and Stop Trading.
Carl, the most quiet of the Magnificent Seven has been Alphabet. Today, Cowen comes out and says business could be better than expected, talking about YouTube taking slight share, and it is up. It's bucking the trend, and I think people have to recognize, I know David's a chartist. I am less a chartist, but that is one of the greatest charts I've seen in a long time. Alphabet may be ready for its next move.
We didn't really get to this story on the tape that Microsoft might be facing a full-blown EU merger probe after some of their ties to OpenAI came out and that whole mess.
Yeah, just write a check to Europe. That's what you do. I mean, if you're Microsoft, how much you guys want? A lot of people feel that it's a shakedown. Other people feel it's rigorous. I'm more in the former camp. If they want to be able to say, listen, it's a monopoly, what are you going to do? Just send them a check. Move on.
Meanwhile, Jim, what's coming up tonight?
Well, I'm doing a healthcare index. I've got Pfizer. I've got Lilly. Look, I've got CVS. I've got Abbott. I have Regeneron, and I think that I'm going to try to put some mergers together right here, right now. I mean, why shouldn't I? Why should the bankers make all the money? Why can't CNBC make some of the money?
it's a new revenue silo for us.
We need it.
Well, I mean, people say cable doesn't make enough money. Let's move into an adjacency, David.
Linear cable's under pressure. We got to come up with new revenue sources. That could be one. That could be one.
There's
You
sub
and I.
fees
Do it,
and
Carl,
management
you can
fees.
talk about it. We'll do them.
The M&A Investment Club.
It's big.
Jim, we'll see in a bit
Let's
because
go
you're
to
coming back in the
Philadelphia and
next
talk
hour.
about it.
Jim's going to return with his live
Absolutely.
interview with Lilly's David Ricks from the JP Morgan Healthcare Conference. Lilly, by the way, just a shade below all-time highs this morning at 629 and change. Dow's down 264. We're back in a moment.
Here.
Good Tuesday morning and welcome to another hour of Squawk on the Street. I'm Sarah Eisen here with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. David Faber, live from CNBC HQ this hour. Take a look at stocks. Down day on Wall Street, down about 0.5% on the S&P 500. NASDAQ giving back 610. So some of yesterday's rally is still up nicely for the week. As far as what's lagging, pretty much everything in terms of sectors in the S&P 500. Only healthcare is higher as the JP Morgan Healthcare Conference rolls on with all sorts of presentations and interviews from Kramer. Healthcare is up 6/10. Everybody else is lower. Energy is among the hardest hit groups right now, along with materials, real estate, and industrials. Take a look at treasuries right now. Been such a focus. We get a 3-year note auction a little bit later this afternoon, and then 10-year tomorrow, which is going to be key. 10-year yield sits right above 4%, a little bit higher yields across the curve. We're 30 minutes here into the trading session. Here are some movers we are watching. Shares of Hewlett-Packard Enterprise plunging on reports. The company's in talks to buy Juniper Networks for a $13 billion deal. Juniper shares are soaring on the Wall Street Journal report right now. Plus, watch Unity Software, the company cutting 25% of its workforce as it tries to reset its business. That amounts to about 1,800 jobs. And we are keeping our eye on shares of Boeing, of course, after coming off their worst day in more than a year. Another airline now discovering loose plugs in their 737 MAX 9 planes. We, of course, have the very latest for you on Boeing a little bit later this hour. But, guys, we have a lot of Fed speak to dig through. That's been moving the markets and catching investors' attention. I think most notable in the last 24 hours, comes from Michelle Bowman. Fed governor gets a vote, was at the hawkish end of the spectrum really throughout this entire inflationary period. She was out front on inflation, one of the first to warn about it because she has really close contacts at community banks. Guess what? She's pivoted and the markets are taking it as good news. My view has evolved to consider the possibility that the rate of inflation could decline further with the policy rate held at the current level for some time. Should inflation continue to fall closer to our 2% goal over that time, it will eventually become, and here's the kicker, appropriate to begin the process of lowering our policy rate to prevent policy from becoming overly restricted. She goes on to say we're not there yet. However, I think the investors are cheered by the fact that she has completely changed her tune and evolved into a place where she feels good about the decline in the inflation rate and that she's talking about cuts. And Carl, you know, these Fed speakers are out and they have a chance to push back on the market pricing of the aggressive pricing of cuts this year, and they're not really doing it that strongly. They might not be at six cuts next year. They may not be at March next year. They still say we're not there yet, but they're not pushing back, which they have in the past.
Yeah, it's interesting. Couple interesting charts. One is Goldman yesterday, total household net worth as a share of disposable income near all-time highs. And then a nice note out of JP Morgan this morning saying this is really the first tightening cycle where you had corporate profits rise and interest expense fall, which they argue will keep corporate profitability strong. And even as we get maybe a rise in unemployment, maybe it's more gradual than in prior cycles.
It's why this cycle was so hard to predict and so unusual in that it feels like the companies, corporates, earnings are coming out of it along with the consumer in okay shape. The jobs market is in okay shape as well. The chart that I made today was on consumer credit, which continues to expand. There was a big jump in consumer credit last month we got from the Fed ahead of the holiday spending season, and we surpassed $5 trillion in outstanding credit. And there you can see it just goes up and up and up. Now, is that a worrisome sign? It's a sign that that they're taking on more debt. Consumers are taking on more debt, David, but they're coming from a better place because we have jobs and we have a tight labor market and they're getting wages. So it doesn't necessarily mean that we have this debt overload and things are falling apart, but it's something we're watching.
Yeah, I mean, as with a corporate balance sheet, it's really only a matter of their ability to pay it back and or meet those interest costs, and you would expect that that's been enhanced as well.
Exactly. Otherwise, they have to pay 23% to borrow right now, which is what the credit card rate has gone up to. So yeah, they're in better shape, coming from a better place. Although I would just flag a few cautionary notes that I saw this morning, to balance, and I'm not saying it's all negative, because actually it's mostly positive. Yesterday I flagged Abercrombie and Lulu raising guidance. American Eagle actually had a really strong guidance report out of the same conference. But let's talk about Albertsons, which had a pretty actually decent report. This is one of the biggest grocery companies in the U.S. Just a quote from the CEO about the current environment for the consumer. We are mindful of a more challenging economic backdrop, including declining federal and state government assistance and higher interest rates and their effect on consumer spending and our business. We also expect slowing food inflation, ongoing labor investment, broad inflationary cost increases, and significant declines in COVID-19 vaccination and test kit revenue. So it's not to say that everyone's seeing this broad strength. There are pockets of weakness. Also, did you see the Container Store? They pre-announced, they warned on guidance that it was going to be lower, and they had some comments about general merchandise being weak. So it's not all good news, but mostly the consumer's in a better place. It's a little bit idiosyncratic, David, I would say, where we're getting the warnings when it comes, and sector specific, right? We know that people just aren't spending as much money in their homes and organizing as we've seen in recent years.
Classic action in retail, though. Check out Urban Outfitters today on their better guidance. That stock's almost up 10%. Yeah, it's a mover.
Yeah, the retailers, I think the holiday season so far has been coming in better than expected. They were all kind of cautious and gloomy. It feels like we're in this really, David, confusing time to predict of what's going to happen just in the next few months. When I talk to companies, I don't know, you're talking to bankers and investors, it's a little cloudy, the outlook from here, because on one hand, things should be going well. The balance sheets are in good shape. The jobs market is doing well. But on the other, there are these lags of monetary policy, and it's kind of hard to predict where this goes.
Yeah, it is. I also talk to CEOs. You know that too, Sarah, right? Not just bankers and investors.
Well,
Yeah. Do I know?
Well,
What do
okay. So are the CEOs telling you anything about the outlook?
You know, actually, I to your point, I think there is sort of a positive tone to things, and not as much concern, perhaps, as you might have seen reflected not that long ago in terms of the market or market participants. I do think, Sarah, there's a more positive tone generally, but it's always difficult to sort of foresee what exactly is coming. By the way, in Albertsons, Sarah, since you mentioned it, obviously your hometown hero, Kroger, they're still in a deal to acquire Albertsons, but we're waiting to see whether that divestiture package gets challenged by the antitrust regulators.
Yeah, when is that going to be this month?
Yeah, it should be soon. I don't know timeline-wise. I mean, we're waiting. It could be very soon. But I did want to point that out because you would think otherwise, given they had a strong quarter, that the stock might reflect that. But really, it's deal dynamics at play here and not the fundamentals.
Market's been skeptical about this deal really since the beginning, even though Rodney McMullen has been confident and said they're prepared to litigate. I think the unions are obviously a challenge when it comes to getting this done. But it will be, and I heard your conversation earlier with Jim and Carl about how companies are feeling about the antitrust environment. It'll be a tell, for sure.
It will. They do look perhaps uncomfortably to a certain extent at certain divestiture packages given history. But again, on this one, we'll have to see. You do have some strong capital sources in there, the likes of SoftBank, and so they would say that the player they're creating will be competitive. I don't know, Sarah. I'll leave it to you, given you do cover Kroger very closely. So.
Well, you talk to the bankers and the CEOs. Well, let's hit the overall markets. We're down almost 300 on the Dow right now. Another volatile day. Joining us with his take is Jefferies chief market strategist, David Zervos. How are you feeling about the outlook, David, for the market and the economy and the ability to sort of maintain the strength that we've seen?
Well, Happy New Year, Sarah. Happy New Year to everyone. Look, I think the story is less about sorting through the difficult data and understanding exactly where this economy is headed after almost 2 years of Fed accommodation removal, and really understanding that what we've all liked to call the Fed put is back. And I think that's what Jay's been trying to tell us for the last couple of meetings, and he really pushed it in the last one. I think that's what Michelle Bowman effectively is saying, and a few others that were holdouts. But I think the committee is really telling you that they're able now to backstop the economy much better than at any time in the last couple years if things get messy. And that's actually really, really good news for risk assets and for taking additional risk in your portfolio. We haven't been there, Sarah, for a while, as I said. 2 years. The Fed put out the same thing.
They're not, sorry to cut you off, they're not even saying if things get messy. That's the thing. They're saying that they're just prepared to be less restrictive going forward if inflation comes down. And I think that's the key question for the markets. Will they do that without it getting messy?
I actually think that's less the key question, Sarah. I think they will. They could cut 25 in May or June. I highly doubt March.
Oh, too bad. David Zervos, we lost you. We'll work on getting that connection fixed and try to bring him back, just as he was about to argue with me, which I like. David.
Yeah, all right. Well, let's get to the latest on Boeing, and hopefully we'll get David back as well. That stock, as you saw earlier, is under pressure again this after posting what was its biggest one-day loss in over a year. United and Alaska Air now finding loose hardware on some of these planes that are in question following those planes being grounded. Let's get to Phil LeBeau. Fill us in on what's going on, Phil.
And David, I think both United and Alaska, when they initially started doing these inspections, preparing for what ultimately would be the checklist from the FAA in terms of do these inspections, if they're clear, you're good to go. They haven't received that final word from the FAA, but they did start preparing their aircraft, the MAX 9s that they have that are grounded, for those inspections. And what happened when they started looking at them? Alaska yesterday saying that they found loose parts in some of the door plugs on MAX 9s as they were beginning their inspections. Alaska has 65 MAX 9 planes, not as many as United, and United earlier yesterday reported that it found loose bolts in some of the MAX 9 planes that it was inspecting. So United has 79 MAX 9 planes in its fleet. Again, they are both awaiting final approval from the FAA to do those inspections, and then once those inspections, if they meet all of the requirements, that will clear the planes to go back into service. Meanwhile, for Boeing, the focus is on Renton, Washington. That's where they build the 737 MAX. That will also be the location of later today Boeing CEO Dave Calhoun holding a meeting, a safety town hall with all of the employees there. He'll be out there with the head of Boeing Commercial Airplanes, as well as Boeing's COO, Stephanie Pope, who just moved into that job, and some of the board members from Boeing. They're all there. Calhoun's message, I think we know what his message is going to be, which is we can do better. We have to do better. Having said that, we've heard this before from Dave Calhoun and the leadership at Boeing. So we'll see if there's anything different as you take a look at shares of Boeing. As you mentioned, David, huge hit yesterday, and again, under more pressure today as we wait to see exactly how it deals with this question of, or Sarah, of quality control.
Phil, thank you very much. Phil LeBeau. Let's bring back Jefferies chief market strategist, David Zervos. Got his microphone fixed, hopefully. David, what were you telling us as far as key question for the markets as it relates to the Fed and the economic outlook?
No, Sarah, I just wanted to point out that I don't think the market is focusing in on just, are they going to cut a 25 here and a 25 there? And is it going to be 2, 3, 4, 5 over the course of the year, depending on how inflation goes? I think the market is really focused on the fact that the Fed's battle with inflation has largely come to an end, and that we don't have this debate anymore about returning to the 70s and is Jay Powell Arthur Burns. He did his job. He acted strongly and effectively, and the supply disruptions that drove most of this inflation have worked their way through the system. And I think the Fed managed to anchor inflation expectations the way we had all hoped they would, although there were a bunch of folks who didn't want that to happen for, I don't know, a variety of reasons where they could make more money. But I think the important part is that Fed backstop is back, Sarah. And I think that's what the market's going to key off of in 2024. And that's a really, really valuable put structure to have as a backstop to the market that we did not have in 2022 and 2023.
Are we going to get a bonus backstop in the tapering or end of QT? All of a sudden, this debate has really heated up.
Yeah, that's a great question, and I noticed it in the minutes. You obviously did as well. I think they want to stop that. First of all, I think they'd like to be reinvesting some of these proceeds back at higher coupon securities. They've got a lot of low coupon securities, and as you know, the Fed has a lot of losses that are realized and certainly unrealized, something we've talked about a lot over the course of last year on this program. Those losses are politically not very pleasant. So I think the more they keep rates high and they don't replenish the balance sheet with higher coupons that they could buy as they mature is probably something they don't want to do. And I think at the end of the day, they're not really sure where this, QT wall hits, and they don't want to hit it. So as long as they're not getting the inflation, and as long as they're done here and maybe cutting soon, why should they still be doing QT? I think it makes no sense in the world. So I think you're going to get that bonus, and I think the market's going to key off that in a positive way as well. I'm pretty positive coming into this year, Sarah. We were positive on the high yield markets. We didn't want to make it all the way to equities last year just because we felt the Fed still had work to do. The equities did great anyway, and I think that's because inflation came down faster than most had expected, including us. But I think now you can really move into the riskier parts of the capital structure of the U.S. economy and feel like you've got a friend again, a friend in Jay Powell. He doesn't have to beat you up on this inflation stuff anymore, and that's great news.
David Zervos, thank you very much. Good to get your views, as always, from Jefferies. As we head to break, here's our roadmap for the rest of the hour. We're going to head back to Jim Cramer live at JP Morgan's healthcare conference with an exclusive interview with Eli Lilly CEO.
Tech is down again today following that big rally yesterday. Is the group close to a bottom, or is there more pain to come?
And a seismic shift taking place in the global auto industry. We're going to discuss the fallout. We got a big show ahead. Squawk on the Street right back up.
Just going to check in really quick here. Nice buyers off of the hourly trigger right here. You're just going to be looking for a quick back check. So right here, this previous high right here, just this one right here. Just going to be looking for that nice little squeeze. Boom, right there. Just get above that little high right there. Come back down. You should be off and running just like that. somewhere right in there. Right there. Close that gap. Right there. Right there. Well, no, HT tapped today. Yeah, this is the hourly trigger right here. We tapped it right here. There's the touch on hourly trigger right there. There's the back test on hourly trigger. Push up. Should come right back, tag that, and then come right back down. Bam. See that right there. Right there.
So we're looking now to the Fear and Greed Index, 71 out of 100, which indicates greed, and the Crypto Fear and Greed Index is 76 out of 100, which indicates extreme greed. Now keeping an eye on the VIX as well, it's currently trading at 13.18.
Humanly possible.
As you may know, JP Morgan's healthcare conference underway in San Francisco. Our Jim Cramer is there on the ground with a special guest this morning. Hey, Jim.
Yeah, Carl, thank you. We're with the man of the hour, with David Ricks, who's CEO of Eli Lilly. David, first of all, thank you for spending some time with us.
Great to be with you again, Jim.
I cannot believe everyone says they've got to get into weight loss. You are so far ahead. Talk to me about how big both obesity and weight loss could be for Eli Lilly.
Well, obviously, it's an enormous addressable market and a huge global health need. You know, WHO says 1 billion people by 2050. We know in America today 110 million adults with overweight or obesity. But the problem really isn't reducing obesity. It's reducing the downstream health consequences of obesity. And that's our mission. And we're undertaking currently, I think, 30 phase 3 studies to demonstrate reduction in diabetes, cardiovascular risk. 2 coming up this year that are important for us. 1 in sleep apnea. So if you take this drug, reducing sleep apnea. The other in congestive heart failure, a really serious condition that overweight seniors can develop and still the #1 coster for Medicare. So the exciting thing is not just we can help people feel better but we can make their health better.
Morning there, Trader Podcast. Morning, Bork.
#1 cause of death in Medicare. I know that if you were just doing weight loss, that would not be covered. But if you're doing heart, David, it must be covered because the costs are so big to the system when it comes to cardiovascular.
Yeah, currently we're left with this sort of legacy rule in Medicare, which is they can't cover weight loss medications. That was defined when the Part D benefit was written into law. Now, it's a little bit of a misstatement because already these drugs are fully reimbursed for diabetes, same drug, right? Which we know is highly related to obesity. So I think both Lilly and our competitor will pursue indications that can then be listed. But here we're not listing the precursor disease, obesity. We're going to be listed for the follow-on disease, congestive heart failure, sleep apnea, major cardiovascular risk. So I think seniors will have access to these medications, but it will require them to also have a diagnosis for one of these complications of obesity. Is that smart? I don't think so. I think we should try to prevent those diseases to begin with. That would be treating obesity. There's a bill on the Hill to propose to change the law, but who knows what Congress is going to do. So we're working at that problem both ways.
Now, a lot of people feel you can't get the drug. You announced Lilly Direct last week. 2 things that you announced I thought were Lilly Direct, which is great for the consumer, but you also said, look, this is not a vanity drug.
Correct, yeah. Very important point. First of all, we know there's supply constraints. There's so many people with real overweight and obesity. That's where we want our medicines to go. That's where they're studied. designed to be treated, and that's where we focus our marketing and our communication efforts with doctors. So just wanted to be clear about that. The other thing we said in that communication is there are a lot of fake and compounded versions. We cannot guarantee their safety or quality, and people need to know that. Now, some of that's driven by the scarcity. We understand that. We're working hard to make more medicine. That's a key part of this year for Lilly is executing and manufacturing. But we said that as well. And then we launched the Lilly Direct site. And people ask, well, why would you do that? Our normal path is to distribute to wholesalers and sell through pharmacies. But a lot of people, in particular people with obesity, reported to us how difficult it was to get a doctor who would be willing to prescribe one of these, an obesity specialist. And that's what our website lists, the doctors you can go see in your neighborhood that have raised their hand and said, I've got certification in this area, or a telehealth platform that does a great job who only have obesity specialists. And then the other thing we do is we can ship it directly to your door. Pharmacy in the US has changed a lot in the last 10 years. A lot of neighborhoods don't have one. A lot of rural areas don't have one, and people prefer that option in many cases. So we're just creating choice so people can get the medicine more easily.
Well, I've had Amgen on. I'll be speaking to Regeneron. I had Roche. They all say they've got something better, as if you're not working on something better, that you're static and you're wedded to a once-a-week shot. You're thinking about all these other combinations, a longer-acting in pill, right? That's just not something Lilly says, no, I don't want that.
Of course. I mean, first of all, we've been working in this area. We launched the first GLP-1 in 2005 in the United States. It was a twice-a-day injection. And, through the years, we've improved this type of product dramatically. We launched Trulicity, a big seller for us. That was the first weekly. And then, of course, tirzepatide, the first dual-acting, so GLP plus GIP, in our pipeline in phase 3. So there's 3 phase 3 projects in the industry, 2 from Lilly, 1 from Novo. So the leaders are still the leaders in the latest phase. One of them is triple acting. So if tirzepatide harnesses 2 hormones.
Just a heads up here. I want to give you guys a quick update really quick. If you can just let everyone know that you have a Blackbox message coming through right now that says CTAs become net sellers with a close below 4,700. So it was at 4,620, I think 4,630. So it's raised today. So 4,700 SPX. Do not allow it to close below that number. Okay. So if you're watching today, or if you're long, anything like that, anything kind of closing or rejecting below 4,700 is going to be super bad. That's right here on Bookmap, okay? You don't want to see price get underneath this at all today if you're a bull. If you're a bear, you are definitely looking for below that 4,700 down below there. So far, though, this all looks pretty good. Just looking for a back test here. I'll expand this for you so you can take a peek at it. It's going to be looking for a back test right now, right? You got the initial squeeze. Right? And you guys that have been around here for a long time already know that you're looking for, you don't always need the new high, but you really want to see it. It's like whatever this retracement is, you get the bounce off the hourly trigger, right? And you're looking for price to, even if it's just a tick, just a tiny tick, boom, get a new high up there. Then you'll get the retracement, and then you'll get the 1 in the 5 minute. This is a bull cross right here, if you don't know that already. So 1 in 5 minute, 1 MT, 5 MT bull cross right here. And we should rocket ship up and tag the next previous high. That's right over here. And keep your eyes every time we do one of these, right? So let's say whatever you're doing here, whatever you're watching this retracement, right? You're always looking for how close did we get, right? Did we get like within a tick or two? Do we break it or not? Shows the strength of bulls and buyers here, right? The less that the less higher you get, the less will from bulls, right? The higher you actually get, the more will from bulls. And you want to be looking for that as we attack these previous highs. Let's say we bounce here and go higher, right? and your next bounce is not as high. So you get, let's say you get this nice clean bounce, right? And then your next bounce is weak. It's like stops like right here. Instead of getting that high up here, I'd be more suspect of this petering out and beginning to trade sideways. If you get that big, nice big rip up here, you already know that you're likely going to get that last rip up here, okay? Make sense? So be paying attention to these previous highs. These previous minor pivots mean something. Or at least in intraday trading, gives you an insight as to the strength of bulls. As of right now, this is pretty good strength. Nice little squeeze. We want to see that continuation to the upside. We still have range expansion to an extent today as well. You've got an upside target up here in R3 of 483 and change. All right, that's big, right? That's huge to get up, to even consider getting up there. That's that SPX all-time highs. But then just below here, even with this daily trigger at 466, we are in no man's land, believe it or not. We're in negative gamma below S1. So bulls do not want to give up S1. Now, when I say that to you, when I say bulls don't want to give up S1, that doesn't mean if we rain down here, that's all doom and gloom. You still have to confirm that move to the downside. Okay, so no matter what this is for the same thing for bulls. You get the squeeze yesterday, right? You want the back test, and you want the successful back test so we can go higher. Same thing would apply to the bears. So even if we break down below that 4,700, you still need that confirmation for a trip lower. So it's not like total doom if we get down here. It's what happens afterwards. We begin to confirm that we're going to go lower, right? Do we get the new low on that previous low? That kind of stuff. Leave that right there for you.
NBC.
Sector under pressure again today. It, in fact, is the worst performer. Pippa Stevens tracking the action. Let's get over to her now. Pippa.
Hey, David. Well, oil is really struggling for direction and more or less stuck in a trading range. Saudi Arabia cutting its oil prices to a 27-month low spooked the market, while also begging the question of whether they'll take more steps for market share and even possibly unwind some of their cuts. But the tensions in the Red Sea are never far from traders' minds. And output from Libya is also down after protesters blocked a major oil field. Meantime, nat gas is also on the move, jumping above $3 and hitting a 7-week high as a cold blast brings cooler temperatures. Not only does that boost heating demand, but it can also lead to production freeze-offs. However, for the time being, this is very much focused on spot prices, with the next 3 contracts still trading around the $265 level. Now, the U.S. is now the top LNG exporter, overtaking Australia and Qatar last year. And one thing to watch going forward is how that impacts Henry Hub prices. Exports jumped 13% year over year in 2023 And that number is forecast to keep growing, especially with Europe shunning Russian gas. Carl?
A milestone, Pippa. Thank you. Pippa Stevens watching Nat Gas. Interesting action today. Still to come, it's been a rough start to the year for most stocks, but last year's top gainer on the S&P, of course, NVIDIA, continuing to hit record highs. What the street is saying about the tech giant when we come back.
Welcome back. I'm Silvana Henao with your CNBC News Update. The question of Donald Trump's immunity from his federal election interference case is front and center today. A three-judge panel in D.C. is hearing arguments from Trump's legal team this morning that his efforts to overturn the 2020 election were within his official presidential duties and are protected by the immunity claim. Trump, who is in attendance for today's hearing, has pleaded not guilty to the 4 charges against him. Secretary of State Antony Blinken continued his diplomatic tour of the Middle East today by meeting with Israeli Prime Minister Benjamin Netanyahu. It comes after 2 days of talks with Jordan, Qatar, the UAE, and Saudi Arabia. This marks his 4th trip to the region since the war between Israel and Hamas began in October. The Earth just experienced its hottest year on record, according to the European Climate Agency, Copernicus. The agency's data found 2023 was about 2.6 degrees Fahrenheit warmer than it was during pre-industrial time. Sarah.
Thank you, Silvana. Silvana Henao. The major averages down about 0.5% this hour, but a number of the Mag 7 names are moving higher. Our Dom Chu back at HQ, tracking some of the movers. Dom.
All right, so Sarah, we'll start with Alphabet, leading that so-called Magnificent Seven group of mega-cap tech stocks this morning, with most other names now trading in negative territory. But Alphabet right now and Amazon both up roughly 0.5%. We're also, though, keeping a close eye on NVIDIA shares, the only Mag 7 name to notch a record high so far in 2024 after yesterday's all-time closing high. Now, today, the chip maker is named a top pick over at Oppenheimer, just about flat on the session right now. But the analysts there say that AI-related growth will remain a big theme for chip makers this year, but ongoing inventory clearing and demand recovery could mean that momentum doesn't really pick up until closer to the second half of the year. So NVIDIA shares still hovering near record highs. And turning back to that broader group of mega cap tech, we've also got a big call out from BMO Capital Markets, which is initiating coverage of Amazon, Alphabet, and Meta platforms with outperform ratings on both Amazon and Alphabet, in part because of their respective artificial intelligence offerings. and their market positions. But Meta Platforms is being initiated market performed by BMO, with analysts citing concerns about unforeseen growth headwinds. They also note potential hurdles from the digital ad market, competition from TikTok, and the need for social media platforms to evolve their revenue sharing models with major content creators. So, David, overall, the mega cap tech trade still holding steady, but NVIDIA, the only one near record highs right now. I'll send things back over to you.
Yeah, 5.6% so far this year. Dom, thank you. Let's stay with tech overall. We'll bring in Rosenblatt securities analyst Barton Crockett to have a conversation. Barton, you know, I look at your coverage list, and obviously you cover a lot of media names, but you also cover many of the Mag 7 names, whether it's Meta or Apple or Amazon. I'm curious, as early part of the year here, what have you been getting the most questions about? What name and or theme, perhaps, is most often brought up to you by clients?
Well, I think what we're hearing is a real kind of digestion of what can happen this year after a terrific performance last year. You know, how reasonable is it to continue to ride many of these horses which have just run so well? And, you know, I think our stance coming into this is that this is a year that you need to be careful about what you pick. But I do think that in the large cap consumer internet, where our tech coverage is focused, where our Mag 7 exposure is focused, there are some opportunities for companies that have an ability to really explode margin. And what we've seen is a precedent with Meta, explosive margin expansion. And I think what we're seeing are some companies following on that'll be able to put up some great margin expansion in 2024, coupled with really terrific revenue growth. So I think you see that at Amazon. I think you see that outside of the Mag 7 at companies including Pinterest and Spotify. You know, where I think you have a little bit of concern are some of the ad stories where the comparisons get more difficult in the back half of the year. Meta's been a great performer. We continue to recommend it. But, you know, that's where I'd have a little bit of question about, you know, how strong can they continue to be in 2024 with the tough comparisons that they'll be coming against.
Yeah. All right. So let's go to Pinterest and Spotify, Amazon. What gives you faith there? The fact that they seem to really be focused on costs. I know a couple of those names I just mentioned have had some headcount reduction as well, I think.
Yeah. Look, I do think that what we had was a complete change in mentality.
Also going to stop in here and talk to you about a 3-hour look-back period. Just be aware that the longer we spend at this price, if it's after 3 hours have passed, as long as we're still bullish and positive, it should turn into an upside move. So if we do end up spending any time down here, from 9:30 until about 12:30, heading into that 1:30 hour, should resolve to the bullish upside.
Fast at Amazon, at Spotify, at Pinterest. But when it does, I think it's going to be hard for the market to ignore the cash flow growth we're going to see there.
And finally, I noticed you don't mention Alphabet. Has that company not yet grown up, so to speak?
Well, that company is a grown-up and then some. I do think that, you know, for Alphabet, you've got a lot of cross currents. I continue to like it. They've got a great tailwind from artificial intelligence. I think potentially in cloud, if they can improve, you know, the feature set gap they have to Microsoft right now. I think they have a great opportunity in YouTube where the usage has been growing, gaining share of consumer kind of view time. The ad revenues there have been surprisingly kind of lagging the kind of audience growth, and I'd love to see that turn around. And then when you think about the core kind of search platform there, you know, I worry a little bit about the tougher comparisons to come and their ability to maintain the growth and the share loss to other, you know, kind of things like e-commerce search on Amazon. So cross currents, but on balance, I think a decent kind of price for many kind of growth opportunities at Alphabet.
All right, Bart, I'm going to leave it there for now. Appreciate it. Thank you.
Great. Thank you.
Still to come this morning, the health of the consumer and the state of small business. The CEO of Pfizer will join us at post 9, fresh off ringing the opening bell. We're back after this short break.
Welcome back to Squawk on the Street. New clues about the state of small business in America. Kate Rogers here to break it all down. Morning, Kate.
Hey, good morning, Sarah. The National Federation of Independent Business is out with its monthly read on optimism for the month of December, increasing slightly 1.3 points to 91.9. That's among the highest readings of the year, but it is below the group's 50-year average of 98, as it has been for about 2 years now. The top issues for Main Street this month: inflation, quality of labor, and taxes. Inflation moving back into the top spot for December, ahead of labor, but those two issues really have remained sticky for operators. The NFIB reporting that overall views on the economy are pessimistic at the moment. The group's chief economist, Bill Dunkelberg, writing in his commentary that 2024 will be a slower year. Quote, overall, the growth rate will most likely be lower than last year. The economy will slow down, possibly delivering that long-predicted recession by year-end. High interest rates are also of concern. In a separate survey on credit, the NFIB found those rates were impacting decisions for businesses around financing, and that about 80% said rates were their biggest issue with accessing capital. That's up from under 60% over the summer. The average rate paid on short-term loans was 9.8% in December, up from 7.6% 1 year ago in January 2023. Quite a jump there, Carl. Back over to you.
Kate, appreciate that important number. I want to get a even closer read on the state of small business and the economy today. After ringing the opening bell this morning here at the Exchange, Frank Bisignano, Fiserv Chairman and CEO, joins us here at Post 9 with an even newer benchmark that's going to start rolling out beginning today. It's great to have you, Frank. Welcome.
Great to be here with you guys.
Tell us,
New Year.
what is the index that you're bringing?
The index takes spending across every category in small business. As you know, we're a leader in payments in small business, and in fact takes everything from category to geography. We have data in 100% of the zip codes where retail occurs or small business spending. Obviously not, farm related, but other than those, 100% of them. And we've spent a long time building the index. We'll publish it the second day of every month, right? No latency in the data. And we've went back to 2019 to benchmark it. So we published an index of 138. We break it categorically against every sector in every category. And we think it'll be very, very helpful. It's all geographies. It'll help people understand. And yesterday we went out to our client base, both financial institutions and our businesses, to publish, so they'll help them understand spending at a different level.
And as you say, it's based on activity. It's not a sentiment survey. It's not looking for, it's not a soft science.
Everything from cash to mobile to online to in-store. So every category of spending possible by every small business. And, we have data on all sides.
So Kate just reported, according to the NFIB index, sentiment is pretty downbeat and has been pessimistic. What does your data show in terms of demand and just how small business is doing?
Well, data shows, let's say we published December just now. It will be, as I said, on the second day. It showed that in some categories, spending was down in December. In the categories you would expect it up, it was fairly strong.
Services?
Also clothing, apparel. So it's granular at that level. Experiential, it was up. So you could go to Fiserv.com right now and see the index and see the granularity of the index also.
You also look at the lending environment for small business, creditworthiness, and whether they're able to access loans. How has that looked? Because we were worried about it after the regional bank crisis that happened early last year.
I think it's performed fine. Yeah. The regional bank crisis maybe wasn't a regional bank crisis by my definition. It was a coastal issue for a few. And I think the regional banks have performed, community banks and regional banks are the heartblood of our company, and they're also great providers of capital to small business. And that's where this company intersects financial institutions and businesses. And we got visibility to commerce across all of them.
I wonder if you think the stock is a proxy for how healthy small business is right now, because it's not far from some highs. Yep.
Our stock?
Yes.
Your stock.
Oh yeah, I don't. I mean, that's a longer story.
Yes.
I think though that as the economy goes, our stock is affected by it. So maybe yes.
Are you counting on a multi-year boom in productivity because of AI or?
100%.
You are.
100%. But I've counted on a multi-year boom in productivity my whole career.
It's been hard to pin down in some years, right?
Yeah.
Productivity has.
Yeah. Well, I think productivity hit an all-time low during the pandemic, and part of that was, we've got employees back to work. We have employees in the office. We believe better together, and you get more productivity. I think, there are jobs that are designed that are fine, not in the office, but, many jobs require people working together. Yeah. It's way better being here with you guys like this than on Zoom.
Yes, believe me, we're in 5 days, and we wouldn't have it any other way, right?
I agree.
Well, the street is so hungry for radars. I'm sure it's going to appreciate this index on the second day of every month. Frank, thank you for coming in.
Thanks for having me.
It's good to see you.
Thanks, Frank.
Happy New Year.
And to you, a big milestone for China when it comes to the global auto market. We're going to head live to Beijing next.
Just going to read a few things to you here this morning while we're on break from CNBC. JPM this morning saying that we believe the consumer price index rose 0.2% in December. This would be the firmest monthly change since September. As we think the recent drop in energy prices is now behind us and they look for an unchanged energy CPI in December. In seasonally adjusted terms, despite prices moving down before a seasonal adjustment. We also think that food prices in the CPI rose 0.2% in December, in line with the recent upward trend and away from food and energy. They believe that the core CPI rose 0.26% in December, which would not be a particularly soft print, but it would keep the year-ago change for this measure moderating over time, moving from 4% over a year ago in November to 3.8% in December. It's just a key point here. CPI. What you really need to know about CPI, or you as a cash market trader, is there's a few main points you need to remember, which is the rate of change in inflation matters, the velocity in that rate of change. So you want to
back to Squawk on the Street. China is set to
mute
overtake
this really
Japan
quick here so I can
as
just
the
explain
world's
this better
largest
to you.
Exporter.
So one of the so how does that relate to you would be the Fed and the Treasury Department basically need to I'm trying to think of the best way to describe this. They need to support and resist the temptation for inflation to spike. So if inflation spikes down and of course CPI is relevant to the rate of inflation. So CPI, let's say, slams down to 2% inflation year over year, and then bounces really hard starts to ramp to the upside, that's bad for the Fed and it's bad for the market. So the Fed is likely I was just talking to Joe Donut a minute ago, and we were discussing the fudging of unemployment numbers last quarter, Q4 of 2023. A revision just came out that was obscenely out of whack from the reports. We kind of knew that, though, in Q4, right? We were looking at those numbers and saying, this is a fraud, this is a scam. And, of course, there was a revision that was like way, way away from what they reported. So the idea here is you are watching closely to ensure that the Fed is going to fudge these numbers and kind of level out the rate of change in CPI, PPI over time. If they fix too much too quick, that's the end for the bulls. They will be forced to cut rates. Right, they get their 2% rate of inflation. They get stable unemployment, stable employment. They've done their job. Now, rate cuts will follow that, and without increasing the money supply, that does not favor the bulls. So the implication here is that the Fed chair and the Treasury Department, Janet Yellen, are going to try to basically suck off the administration until the presidential election finishes. So they have a task ahead of them in these first 3 quarters of the year to not rock the boat. So if you were to see CPI, PPI, unemployment, fake-ass numbers that are either in line or not spiking up or down, right? Not aggressively heading higher in unemployment, not an aggressive spike down in inflation and then a spike up in inflation. They've done their job, and inevitably they've done their job that they're probably going to try to do for this upcoming election season. Now, if they aren't able to do that, you should see some kind of a play in motion for this market to try to sell. You can see that in the bond market too. Bond market's saying to you they expect 4 cuts, 7 cuts, stuff like that. And the reason that they're saying that is because we are close to that 2% year-over-year inflation number. And then we've got the inverted yield curve that's trying to uninvert, all that kind of stuff. But so I guess you have to kind of wrap your head around just the concept of whether they're successful or not, that the Fed and the Treasury Department is going to attempt to fudge this shit as long as possible. They basically have to fudge it for 10 or 11 months.
For you straight ahead. Don't forget the CEO of Novartis will join Jim. That'll be on the other side of this break, live from the J.P. Morgan Healthcare Conference. Don't go anywhere.
There's another note here as well. This is all coming, you got to think, you have to remember too, so this is from the Financial Times, but these articles are put out by people with OM inside of the bond market. You've got a lot of heavy hitters out there. You get the bond vigilantes. You've got a lot of I saw this on Twitter yesterday, the day before. A lot of arguing. I think it was yesterday. A lot of arguing over the markets going up yesterday, and some of that argument does not stem really from a thesis point of view. It's more, hey, I'm long this right now, and I need this to print, and it's not. It does get that simple. People like to complicate things, give you a bunch of, like some rocket science out there. But the truth is that there are people along in the bond market that want to see rates get cut. So, give me a quick. I'm going to read this to you really quick. It's from FT. Investors are warning governments around the world over unmoored levels of public debt. Saying excessive pre-election borrowing promises risk sparking a bond market backlash. That's that bond market backlash. Government debt issuance in the U.S. and the U.K. is expected to soar to the highest level on record in the coming year, with the exception of the early stages of the COVID pandemic. Emerging markets are set to add to the deluge of bond sales after government's debt climbed to an all-time high of 68.2% of GDP last year, according to the Institute of International Finance. Deficits are, quote, out of control, and the real story is that there's no mechanism for bringing them back under control, end quote, said Jim Selinsky, global head of fixed income at Janus Henderson. Also, note the weakness that we discussed earlier.
$80 billion in forward bills on January 11th, settling on January 16th.
Don't like to see this weakness here in the second bounce. If you just watch this, it should be a nice high bounce. No high bounce, looking kind of bearish right there right now.
Welcome to Money Movers. I'm Sarah Eisen, along with Carl Quintanilla, post 9 of the New York Stock Exchange.
You've got a bull cross above right here, and they're trying to confirm a reversal to the downside right now on a bear cross
from macro
here.
Risk with Financial Juice Pro. Now only $99 a year for our real-time service.
A great day as the JP Morgan Healthcare Conference continues. A lot of interviews and updates from companies there. The NASDAQ down about 0.4%. We're giving back just a portion of yesterday's decline. Heavyweights like Tesla, Apple, Microsoft, Netflix are all weighing on the NASDAQ, though. There's some strength in Amazon, Alphabet, and NVIDIA today. The 10-year note yield sits above 4%. So a little bit of selling today. We've got an important auction, a 3-year auction at 1, and then a 10-year tomorrow. Getting Boeing orders and deliveries just crossing. Let's get to Phil LeBeau with those numbers. Phil.
Another note here where you're seeing someone just said they were getting shaken out here. Keep your eyes on Qs down here. They look bullish, not bearish. Just keep your eyes down here. Look at Qs. This looks like a bear trap right in here. Qs looks really strong right now, so I'm going to expect a bear trap here, not a bull trap.
67 last month. That means that they delivered 528 planes last year. More importantly, if you're a Boeing investor, they hit the 2 benchmarks in terms of delivery guidance, both for the MAX as well as for the Dreamliner. So yes, they had lowered their guidance on the MAX to a range of 375 to 400. They came in at, I think, 496 aircraft. And for all of 2023, they hit their delivery targets. While that would be news that should make you feel better about shares of Boeing, we all know what's
Also, Boeing with a bull cross on it as well, right now just starting as CNBC is running this report.
A town hall safety meeting with CEO Dave Calhoun in Renton, Washington, where they build the MAX. That'll be happening a little bit later on today. Guys, back to you.
Phil, really quick, 30,000-foot view of the market. You know, we talked yesterday about the so-called duopoly defense for Boeing, given that it's such two large players, there wouldn't be a whole lot of degradation to the business depending on what happens with the MAX 9s. But can you talk about how Airbus and their order schedule sort of fits into all of that?
Well, look, their order schedule is close to a record high. I think their backlog, much like Boeing's, I think Boeing's backlog is close to a record high overall for all aircraft. And I think it's the same thing when you look at Airbus. The issue is this, guys. The orders really started coming out of the pandemic for both Boeing and Airbus. As Airline said, look, we have this demand. We need to meet this demand. The unfortunate part of this is, if you're Boeing and Airbus, is the global aerospace supply chain, well, it was brought down during the pandemic. Ramping it back up, not just here in the United States, but also in Europe, also in Asia.
Keep your eyes on. Keep your eyes back here on the Qs. Qs are ramping hard,
if somebody doesn't want to go with
right now.
Boeing because of this controversy, they'll just go to Airbus. You're at the end of the line. You want to wait 8 or 9 years for a new aircraft? These are the things that airline executives have to think about. And a lot of this also is, what fleet have they already committed to? They're going to stick with that fleet, generally speaking.
Yeah, it's the benefit of the duopoly, I guess. Phil, thank you. Phil LeBeau. Let's dive deeper into this, what to do with these stocks on both the airlines and Boeing. Citi's Stephen Trent covers the airlines. Jeffrey's Sheila Kayalu covers Boeing, both with us here at Post 9. Good to see you both. Sheila, it does raise the question after these numbers are released as to what happens with Boeing orders going forward. Has anything changed for you?
No, I think as Phil said, we saw a great Boeing order year in 2023. Same for Airbus, 1.5 times book-to-bill, double what they were delivering essentially. So very positive, and you're at the end of the line. To get a new MAX, to get a new A320, you're probably looking at 2028, 2029 timeframe. So airline operators need to really put in their orders now to get them. And we're continuing to see delivery hiccups. Obviously, Boeing with the MAX 9, the MAX 9 is 2% of the backlog. But we're also seeing that with the A320, given 50% of their jets are powered by the GTF engine, which has its own powder contamination issues from Raytheon. So both the OEMs are still struggling to get these deliveries out, although this delivery report from December was relatively positive.
Yeah, but better safe than sorry, as we're learning. So what are you telling investors to do with Boeing stock right now?
We still like it. We have our buy rating. The MAX backlog for the 9 is only 2% of the backlog. We think, the plug could be replaced by a door. We'll find out soon with the NTSB. And also the airlines are working on re-entering the aircraft into service when they do their maintenance checks. So I think we'll have a resolution fairly soon in the next week or two. And we think this is a minor hiccup, although it could have been a lot more serious.
Wow, so you're buying on this dip?
Yes, we are, because we think production, we've learned over the last 5 years, production is not going up in a straight line. There's constant hiccups, and this is one of these pullbacks we continue to see.
What about for the airlines, Stephen?
Yeah, so we are still constructive on the network airlines. And when one looks at what's happened 2019 to now, there's been a structural shift in consumer behavior, including the way consumers purchase tickets. Many people are not in the office 5 days a week. That has made a push into blended travel. This has been very good for the demand of the likes of Delta and United, for example, that are seeing very good flow from this trend. On top of that, you look at the ancillary revenue generation, loyalty and co-branded card, and those particular names have actually de-risked their earnings stream. We take a less sanguine view on the purely domestic ones and the low-cost carriers. Those look like a tougher spot.
Yeah, I think the two interesting threads going on is the premiumization, right? And that's hurt a lot of low-cost carriers, but also clarity on capacity growth, right? Does that happen in the first half of this year? How much can the industry responsibly add?
Yeah, the capacity side is going to be an interesting one. So as Sheila mentioned, you do have a long wait for aircraft. If you lease the planes, you still have kind of a wait for them. So, excuse me, when one looks at capacity, do we have too much capacity? I would say no. 2019, there were a little over $23 of U.S. economic activity per available seat mile. Last year, we had over $28 of such activity. So I think the broad capacity picture looks okay, but there's been a big shift into who's getting the economics on those available seat miles deployed. On top of the aircraft availability, you have the pilot availability problem. That's now looking a little easier for the network guys. So I do think we kind of get into the summer travel season, we get a clearer picture.
Sheila, management, are there questions about Dave Calhoun's leadership? Because we know what happened to the last CEO at Boeing the last time they had major safety issues. Obviously more serious, as more than 300 people died on those crashes. But what sort of questions and commentary are you getting from clients and investors on Dave Calhoun?
I think just given the history of what happened to Boeing with the grounding, it comes up often with investors, but Boeing's taking, two very different approaches. First, in terms of the communication, calling an all-hands-on meeting today and really focusing on safety. Let's not forget this aircraft went through the Boeing inspection process and FAA inspection process before it was delivered. So very different messages about how aircraft are being delivered. And second, I think it's more of a focus on the supply chain. Supply chain throughout the pandemic was very constrained. Either it was materials or labor. And we saw management changes at Spirit given the 3 issues they had last year. So I think back to Spirit, how does that change? How does that improve with the new CEO who's a 30-year Boeing veteran? kind of how does that evolve from there? And Boeing management also getting more hands-on with the process. I think that's the message they're trying to communicate.
Did you believe in this bounce that we got toward the end of the year in Boeing? How much of that was suspect, do you think? Just the price action?
So the price action in Boeing through the end of the year was as delivery started to ramp. You saw production momentum in the teens in September, October. They were supposed to be at 40, 38 a month. And so that's why this December report was so positive, and that's what drove the stock higher. What we're really big on is pricing. Boeing has suffered for the last 5 years for bad pricing on aircraft that they were booking in 2019, 20, and 21. We think pricing is going to double in 26, 27 on aircraft that they're booking today. And so that's why we're really bullish on what they're booking today.
Finally, Stephen, got to ask you about JetBlue. Speaking of management changes, CEO Robin Hayes is going to be out. The president is going to take over. How do you think that's going to impact JetBlue and where it goes?
Absolutely. I mean, first off, I don't know all the details behind Robin's departure. He actually mentioned in the release that there were some medical issues, so I don't know what's going on. I certainly wish him the best. In terms of the succession plan, that looks very good to me. In terms of a long-tenured executive is going to be taking the helm. I think from an ESG perspective, it's fascinating. Kind of the only airline I can think of where you're going to have a CEO and CFO are both women, which is great. In terms of where they are strategically, it's tough. You actually had the Northeast Alliance. They tried to get that done. It didn't go through. You've had this protracted legal fight in trying to get an acquisition done. It's unclear whether that's going to go through or not. And then at the same time, the carrier indicated that the December quarter is toward the upper end of their range, but this airline earnings-wise is still way below where they were pre-pandemic. That's exactly what you're not seeing with a Delta or United, which are actually much closer to their pre-pandemic earnings stream. So I think it's a mixed bag.
I mean, the pessimism reflected today. It's down 8.5% on top of an already double-digit slide. Stephen, Sheila, we'll leave it there. Thank you. A lot of news in airlines.
Yeah, it's a complicated business for a reason. Let's get back to the broader markets as we get set for some key inflation data later this week. Our next guest is expecting a soft landing, but says the street might be overly optimistic about the number of rate cuts that's currently getting priced in, predicting we'll see the Fed ease policy 3 times this year, beginning in Q2. Joining us here at Post 9 is Barclays Head of Research, Jeff Melly. Jeff, it's great to have you. Thanks for the time this morning.
Thank you. Thanks for having me.
So kind of fits with what Bostic at least suggested yesterday, right? Although he's a relative dove, saying don't expect big things until Q3 in that case.
That's right. And we agree that the market is over-optimistic about the path of rate cuts from here. We're only expecting 3, as you mentioned. Next year, the market's more between 5 and 6. We think inflation will settle above the Fed's target and actually remain relatively stable for this year. And that's a big part of why we are not expecting the cuts to materialize.
Are you heartened at all by certain annualized views of inflation that show it below target in this conversation about an undershoot?
Not really. I think obviously the high frequency data can be a little tricky to interpret. We think there are structural factors, including the very robust labor market, which is going to factor into wages, and that we're only really starting to see the wage stories play out. That'll end up being supportive of inflation above the Fed's target. And I think that, in the end, the Fed is going to be very closely attuned to both to inflation and the growth side. We're not expecting a recession. As you said, we think there's going to be a soft landing. We put those factors together, I think it doesn't lead to such aggressive cuts.
So you think inflation settles where?
2.5.
2.5.
Right.
Which will be good enough, you think, for them to start cutting?
Good enough to cut a bit because it will say that current policy is a bit restrictive, but not enough to be on like a full-on easing cycle.
Which is the 6 cuts. That's currently priced in to the market. We've seen inflation come down, even with the tight labor markets.
That's right.
Even with the wage pressures that we've seen, there's now deflation in many parts of the goods sector.
That's right.
Services is cooling off. Rents are lagging and they're coming down.
Yep.
So why are you against consensus?
We're against consensus primarily because we don't see the labor market softening, and so the wage story, I think, only goes so far. And so the immediate wage pressures around 10% inflation, sure, those have eased off. But fundamentally, unemployment, in our view, stays very low. And with unemployment staying that low, there's only so far down the wage pressure can get.
What happens to, do you think we ever get a full disinversion of 2s, 10s?
I don't. I think that the current curve is probably a bit. It's probably overpriced cuts a bit too much. And so, if anything, I think there will be some upwards pressure on the front end from here. But we're only talking about a difference of 3 or 4 cuts, so not too much excessive pressure.
So where do you think bond yields settle here, and what do you think ultimately that does for equity prices?
Well, we think that bond yields could come up a bit from here.
Yeah.
And I think as a result, we do actually prefer equities over fixed income. We think the fixed income market is a bit over-optimistic, as I said. That being said, we're over-optimistic because we think the underlying strength of the economy stays strong. That ends up being good for equities.
Where do you see payrolls, say, mid-year? Do we get close to that 75K where you're sort of just taking care of new entrants?
Well, I think they actually stay a bit above that, and I think that's part of the strength of the underlying market. I think companies are reticent to let people go. There's still enough momentum in the underlying economy to support some job creation from here. So I think that story stays pretty strong.
Yeah, I think that's the corporate job hoarding story continues to get legs, even with some of these restructuring stories at the micro level, whether it's Unity Software or Spotify or some others, right?
That's
it's not getting reflected in the macro.
That's right. And these are high productivity, highly skilled workers that we're talking about. They're easy to recycle back into the economy, and I think that's what we're seeing.
Jeff, appreciate it.
Great.
It's going to be a fascinating year no matter what.
Great.
Thank you. Jeff Milley at Barclays.
Up next, 2 big guests from the JPM Healthcare Conference. The CEO of Bausch Lomb, shares falling yesterday after the company said it is going to be a year of investment, looking to fundamentally change the way it operates.
And then the chief executive of Novartis is with us. We'll get his response to reports the company's close to closing a $10 billion plus deal to expand its cardiovascular pipeline. Stay with us.
Turning to healthcare, which is the only sector higher right now, shares of eye health company Bausch Lomb lower again today after a more than 3% drop yesterday. That was after the CFO said 2024 is an investment year for the company as it kicks off what is expected to be the biggest launch year in its history. Joining us now from the JP Morgan Healthcare Conference is Bausch Lomb Chairman and CEO Brent Saunders. Welcome back, Brent. Good to see you.
Likewise. Thank you, Sarah. Thanks for having me.
I mean, it's good to have you. You've been in the company now 8 months. My big picture question is, how are you going to make eye care as exciting as Botox?
Well, we're working on it. We do have a few aesthetic products like Lumify, but the real key will be innovation and solving for unmet need in eye health. And it's truly exciting to be back.
What does an investment year entail? Where is the investment going, and when are you targeting growth?
Yeah, so most of the investment is going to innovation. We're a 170-year-old company, and 2024 is the biggest year of new product launches the company's ever seen. In particular, we have a new drug called Mibo for dry eye disease, and we are investing significantly behind it. We've had a few months of really good data, and we're excited about it, but we have new products in contact lenses, in surgical intraocular lenses for cataract surgery. We have a new laser that was approved yesterday. We have some new consumer products. So it is really a rich year of new product launches and innovation for our company.
And you're doing deals. I mean, you paid $1.7 billion for a Novartis dry eye drug. Are you anticipating more deals on the horizon? You are kind of known as a deal maker, Brent.
That is true. Yes, we did. We purchased Novartis's eye care portfolio, and I think your next guest is the guy I bought it from.
Yes.
It's a great product, and it's very complementary to the one we're just launching. And so having that 1-2 punch, two very complementary products to talk to physicians and ultimately treat patients with is really strategically important to us, and I think financially compelling as well. So. Yes, we're going to look at more deals, but not of that size for the short term. We want to delever and get our debt ratios into good order. But we're always on the hunt for innovation and R&D and investing in the business.
Hey, Brent, more tactically, are supply chain issues still a thing? Are there things you need to address there?
It is, Carl. Yes, absolutely. When I came in, I did a quick assessment of the company. I'd been CEO about 13 years ago, so I knew the company a bit. And the supply chain is quite complex for a company our size. And, we need to think about it more strategically. We need to make sure we can have high quality, reliable supply for all of our customers around the world. COVID really challenged the supply chain for our company. And so we brought in some new leadership, and we're really focused on making sure that the supply chain is a competitive advantage versus a liability that it's been over the last few years.
Is it more
that will take some time, though, Carl.
I was going to say, is it about sort of logistics or vendor management or maybe country portfolio management?
It's a bit of all of them. Our biggest issue is component availability. So take a surgical phaco machine, 20,000 components. All of them have to be qualified by health authorities like the FDA. And we need alternative sources of supply, dual supply. We need to be able to be much more flexible when there's shortages around the world or shipping issues and the like. We also had some self-inflicted errors last year where we tried to upgrade a distribution center my first week on the job, and the upgrade failed. And so we're working our way through it. A lot of lessons learned about that, but I'm really confident over the next year or so we are going to turn our supply chain into a competitive advantage.
One question I'm sure you're getting from investors there is on the separation from Bausch Health, which still owns the 88% stake, and where we are in that process and when it's going to be complete.
Yes, that probably is the number one question I get. To be fair, it's a decision for the BHC board. I know they want to do it. I'm confident it will happen. It's hard to predict timing and the actual mechanics of it at this point, but there's a strong commitment to get that done.
And finally, Brent, what do the demographics look like and the market size for the issues that you're targeting and the launches you're creating? Why should investors be excited about it?
Yeah, eye health is a terrific category. It's a category that historically has grown at about mid-single digit. I think we can do better than that over time. But the unmet need in eye health is vast. And so that's why I'm so focused on innovation, because to the extent we can solve some of these issues like geographic atrophy, even AMD, glaucoma is still an issue. Cataract is still a leading cause of blindness around the world. So there's so much white space to innovate. And that's what's, I think, so exciting about the opportunity to be back at Bausch Lomb, is to drive innovation back into this storied 170-year-old company. And that's really my number one mission.
And what are you saying about earnings growth, if this is going to be investment time? When does that come?
Yeah, so we are committed to earnings growth. You're going to see margin expansion in 24 this year. We're going to provide guidance in a month or so with our Q4 earnings. But I do think over time, you should expect margin expansion. This is a business that can do that. We have a lot of launches, which is exciting for a long-term investor. But I do think the payoff is just going to build year over year as we expand margins and grow top line. And that really is the recipe for success.
You know, one last thing from me, Brent. I mean, I've got young kids. They're on screens literally all the time. And I take one into the ophthalmologist, and she is always like, get him outside, because the muscle strain that's being activated through the screen use it's generational. And I wonder what you think that does to the addressable market over 20 years.
It's actually a big issue, and it's almost I think it's an epidemic. It's called myopia, the issue you're referring to, and it is a real problem. Places like China are really struggling with that issue, and I think it's starting to really impact the Western world as well. So you're right, you do want to get them outside. It is creating more opportunities for innovation. It's growing the market. You know, a lot of screen time also creates dry eye, which we have a leading position in. And so, yes, I do think the demographics, I think the environmental factors, pollution, screen time and the like are just going to expand this market as we go forward.
Brent, thank you very much for joining us. Good to get an update.
Thank you for having me. Yeah. Thank you so much.
Brent Saunders, Bausch Lomb, Chairman and CEO, and that worries me a lot. Thank you, Carl.
Coming up later this hour, the EU examining Microsoft's ties to OpenAI with some antitrust concerns in focus.
Crude oil output by the most since the cut started.
Whoa. Okay, so just as we squeeze up here, I want you to pay attention to a few things. Number one would be you've got your squeeze right here, looking for that last one to come up here. And the only other issue that I see here is that the hourly trigger needs to catch up.
So Russia pumped 9.57.
So that'll be coming up this way here, right? Zigzagging up. You got your half hour, which is very aggressive right now. That's actually a good sign too. Here's your half hour trigger. See how it's just coming up like vicious here? The idea would be, see, let's draw that in better like that maybe. That's a better gray line for your half hour trigger. The idea being here, though, that once you tag this, you're likely going to come down and consolidate, maybe have a liquidation breakdown of this hourly trigger, but then come straight back up here. So there's some kind of a chance of a quick rip down, and then you get that last leg up. So just watch out for this finger trap in here. If we squeeze up into this, let's say so if we break and squeeze up there, we tag it. If we come back down, just drop in here. Just don't get caught in this, or at least reset and look for that last dip buy on the hourly trigger as it comes up from the bottom here. And then ultimately, if you don't already know, ultimately you want to be up here, right? So here's the previous high from yesterday. Here's the back check on the hourly trigger that we talked about, right? As it came into close yesterday, I was like, I don't know if we buy puts here or on the open today, but we want to see that back check down on that hourly trigger. So far, looking pretty successful. The other note to be made here as well is pretty much if that 4,700 breaks in here, if this zone breaks, we start to reject underneath, any kind of bull run is over. You'll start to see mechanical selling from commercial traders, and you don't want that, right? You have that, something like this triggers a pretty big sell in the marketplace. Bull run is over. So if you're a bull, this is the only dip buy for you, basically. But generally speaking, in this vicinity, this is your only place to buy the dip. Once we get underneath this zone, you are just sell the rip. You are STO or STR every time underneath from that point. So as a bull, if you're trying to buy a dip, this is the place to be buying a dip, whether it's call spread or whatever, trying to trade that 4,800 or that 5,000, whatever. This is the place. This is your bottom. This is your rot gut bottom for buying dips. Now, saying that, I'm going to scale out here to a 30-minute chart so you can see this, where we are. Right, here's your 30-minute chart. Right, and you already know about your traditional bull flag that's down here somewhere, right? Came down, bounced back up, right? Came right up, teed off, sold off, holding the hourly trigger right now. So what are you looking for? Looking for a break above here, right? Right up to this R1 right here, okay? And then a bounce down and a consolidation. All you need as a bull is this. If you get that right there, right, that's extremely bullish for a giant upside move. So that R1 is in particular going to be a bull target they want to see here. So we're going to snap that back, go to a 1-minute chart here. And there's your R1 right there, right? You got your BAM target up here, consolidates, liquidation break, back to the top up here. And where do we want this one? We want this one to consolidate and at least tag this R1, and then you can come back down. All this is fine, just as long as you're up here, and then this here for more consolidation. We'll start talking about higher highs from there. That's if all this works out over here, okay? Be able to make sure we can buy dips down here. Be able to buy this dip on this hourly trigger. You want this to come up right here. Whoop. And actually, we'll bring that back down 472. Just in case we get a snap down below here, something insane. Something like that. We should clean the timeline up on this, but you get the picture. You get the picture there. And I guess you could draw this twice. You could draw, because I don't think it's guaranteed that you get that, but somewhere there. Somewhere in there. I'd be focusing mostly for today. Your real focus for today is going to be this. If you're a bull, what you really want to see is just that tag right there. Middle of the day, consolidation. End of the day, move up here. That's what you're looking for today. Hopefully that helps. Yeah, John, I'm like, I don't know, like, how I like trying to, like, at least, even if it goes the other way, at least, like, even if this fails, we start sending it down, we can redraw it again, but at least, like, drawing it out, dude, is like, at least drawing it out kind of gives the, kind of like a thesis outline, at least, as to what to expect. What up, Shaq, baby? What's going on, brother? I'll turn this back on again for you. Oh, you got a snow day? Where are you at, man? Where are you at, Shaq? We got a bunch of like we have a bunch of like, or I just spoke to Joe Donut. He said that, or I was on the phone with him this morning. It wasn't just now. I was talking to him at like, I don't know, 8 o'clock or something, 7:30 this morning, and I could hear the rain just coming down where he's at. We're supposed to get, I don't know if we're getting snow. I don't know if we're getting rain. I got different people thinking different things where I'm at. We haven't seen it yet. We haven't seen the rain and snow and the wind. I'm mostly afraid of the wind here. You're in Iowa. You got snow, dog? Hell yeah, brother. Hey, Shaq, by the way, I think that I'm going to ride the I'm not positive yet. I want to see the route, if it's the southern or northern route. But brother, I'm going to be out in Iowa, I think, for the. I'm pretty sure. I'm at like 65 to 70% sure that I'll be riding the Ragbri this summer. So if I do, dude, we got to hook up without a doubt. Without a doubt, got to hook up if I do the Ragbri, man. I got to be out there and hang out with you. Are you in the northern or southern part of the state, Shaq? Are you in the northern or southern part of the state, my brother? I want to hook up with you, man. Anyone that lives in Iowa, by the way. Oh, all right, right on, man. Definitely, man. And I'm supposed to be bringing out a support crew and everything, so there'll probably be anywhere from 5 to 10 of us out there. So that'd be a blast, man. We'll hang out. Oh, you're in the south. I think it's in the southern part, dude. I heard a lot of call. I was on the Facebook group last week, and everyone was calling for the southern route this year. That'd be fucking rad. That'd be hella fucking rad.
Myopathy, it would be you, just muscle biology. I know that you're. It's difficult for you to talk right now about it.
Look, Jim, I can't comment on any specific deals, but more what I'd say is that our overall M&A strategy, when you look at the deals we announced yesterday, is really to focus on sub-$5 billion assets. We announced 4 deals yesterday, all in the kind of sub-3, sub-$1 billion space. Now, we look at larger deals, which is why I think you see the media coverage. It's always something that we do, and we have an obligation to do that. But we really want to highlight, while we look at larger deals, our M&A strategy is bolt-ons. We did 15 deals last year, all under $3 billion. And that's where our overall idea is to build a portfolio of medicines for the future.
I met you 6 years ago, and you told me about this vision. You wanted to get out of these businesses, whether it be, you wanted to get out of Sandoz. You wanted to get out of consumer products. And I was like,
Kramer's poked out of his mind this morning.
It all worked. You are the most beaten raised pharmacy company there is. How did you know?
Jim, well, look, I really believed in our R&D engine. I thought back when I started and you and I first met back in 2017 that the right story for this company was to focus on R&D, where the heart of the company is over. We're a 250-year-old company. And what we were able to do was $130 billion of transactions. We exited consumer health, Alcon, Sandoz, our Roche stake, and focus down. And now you see the performance come through, and that's what's really exciting, I think.
Well, it turns out that you have drugs. Look, you have a drug like Ernesto, a heart failure drug. This is $4.6 billion in 2022. How big can that be?
So we've announced peak sales on Entresto now of $7 billion, doing extremely well in the U.S. Of course, in the U.S., we'll have IRA hitting that medicine.
Oh, now you also do. You're the head of the pharma group.
Yeah.
I mean, can they derail some of the work that you're doing?
Look, I think this is a problematic legislation for the long run. I'm hopeful that over the coming years we can adjust it. We know the adjustments we need to make, adjust what's so-called the 9-year timeline to 13 years for small molecules to where large molecules are. And that, I think, is a sustainable model. But we need to fix this. Otherwise, what you're going to have is you're going to have fewer cancer medicines, fewer neuroscience drugs, fewer cardiovascular drugs. And this is something the industry has to get fixed.
People don't understand how much it costs to bring something to market. Maybe you fire half your R&D in order to be able to make your numbers.
I think that's part of it. I think people also don't understand how much we build medicines over time. So if you put a 9-year clock, we don't have time to take a cancer medicine from 3rd line to 2nd line to 1st line. If you think about a cardiovascular drug like Entresto, $7 billion peak, that takes us 7-8 years to build. And if at 9 years you're going to cut it off, companies can't make the investment they need to get these medicines to patients. So this is something we got to get right.
Well, you just mentioned cancer. You have got a whole new way. I mean, people are talking many different ways. Radioligand, why do you think that's the way to go?
So this is a really cool technology where Novartis is the global leader. We have scale and multiple products on the market. The idea here is you link a drug to a radioactive particle, and you can bring the radiation in microdoses right to the cancer and then kill the cancer locally. So we've succeeded
without killing the patient.
and the safety profile looks good, 6 cycles. And it's a medicine now in prostate cancer and neuroendocrine tumors where we see really great results. So we're investing big in this space. We've got scaled manufacturing, a full pipeline. And you hear a lot in this conference about antibody-drug conjugates. We think this is another approach to take a lot of cancers and really treat them with better medicine.
Right, there's someone who knows you quite well, Sarah Eisen, who would like to ask you a question.
Hi.
Sarah, your interview last April was the eye-opener for me, so go right ahead.
Oh,
Hey,
thank you, Jim. Hi, Boss. Hi, Jim. So I know Jim tried to get you on the deal that you can't talk about right now. That's reportedly on the table. But I'm just curious, Boss, about the overall environment. I mean, we are coming into 2024 with a bang here on healthcare M&A, and it feels very different. And I'm just curious what changed. Was it valuations? Is it internal pressure from shareholders? Is it the Inflation Reduction Act? Why is it a completely different environment, it feels like?
Yeah, I think a couple of things, Sarah. I think, one, valuations, of course, have adjusted down. You've seen that the XBI has come down quite substantially, which gives more room to find good deals. I mean, we acquired a company called Chinook, for example, for $3 billion and really built out our kidney franchise with that. I think, in addition, part of the challenge in our sector now is how are you going to drive sustainable growth in the context of IRA when that starts hitting multiple companies at the end of the decade? So I think companies are looking on how to build out franchises where they can get additional medicines, drive growth 28 to 32 and beyond. And I think that's going to be a big story now, is getting enough replacement power to not only be able to replace genericization, but also be able to replace IRA medicines.
You know, Vess, I want to talk to you. We know you're a doctor. You represent the industry. You've gone to Kennedy, JFK government school, not just being a doctor. And yet, one of the things I think you should be known for is your capital allocation. You $45 billion in buybacks. You had another $15 billion in buybacks. You have conviction in yourself and your company.
I mean, one of the things we've tried to do, Jim, is really say, look, if we're going to bet on anything, let's bet on Novartis R&D. And so when we focused the company, we saw the opportunity, exit our Roche stake, buy back our own shares. Now, when we're fully focused, spin out Sandoz, buy back our own shares, because we believe in that R&D engine. And as I talked about yesterday on stage, we had 10 positive phase 3 readouts last year. It was the best year in Novartis, probably in our history, for R&D innovation. That spans immunology, cancer, renal diseases, rare diseases. So I think the pipeline is humming. That's what gives us confidence to really bet on ourselves.
And one last question. It's hard to see how well you're doing because of COVID, but the normalization is bringing out the incredible earnings power that you really have. High single digit, double digit. It's a remarkable moment for your company.
I mean, this is what's really rewarding. I mean, when you go on a 6-year journey to transform a company, and then you start to see the performance come through. 3 guidance raises last year. You know, we've guided to, the mid-teens, mid to high teens core operating income.
No one has that.
You know, and so it's really great to see that the plan paid off. What you and I talked about many years ago.
All-time high.
So we'll keep working.
You figured it out. I was baffled. Well, you knew far more than I did. Vas Narasimhan, Novartis CEO. Back to you, Sarah.
Thank you. And even without a weight loss drug, still that kind of performance. Jim Cramer, thank you. Vas Narasimhan. Up next, a new survey shows the emerging factors that have 60% of CEOs afraid of losing their job. Full details of that new report after a break.
Watch HPE today, reportedly in advanced talks to buy Juniper Networks for around $13 billion. Juniper is leading the S&P, and HPE is the biggest laggard. We're back in a couple of minutes.
me ask you guys another question out there really quick. What is your favorite Twitter breaking news, breaking financial news? Like I follow Pick and Walter Bloomberg. I followed some others, but what's your favorite? If you had one for your tweet deck, what would it be? Financial Juice. For Twitter, at least, what would your favorite breaking news Twitter handle be? Let me know in the comments.
My member.
Yeah. I kind of like. I like Gurgavin.
Annual disruption index showing that CEOs
I don't like his
have a
bias
number of
as a
concerns
pure
as we head into
news source.
2024 and souring their outlook.
I'd put him on the same.
54%
I
say
don't
they now expect
mind
a recession
Gurgavin.
in their national economies in the next 6 months versus.
I look at Gurgavin like I look at Zero Hedge. There's some bias in there, and sometimes that bias can be like brutal or brutally wrong sometimes too. I don't have anything wrong. I like what he does, so I've got nothing negative to say about him. But I'm looking for like a pure like a news squawker type Twitter handle. Good one though. What do you guys got here? Let me see what you guys are saying. Sasha said Gurgavin. Let me check on Twitch. Pick and Walter for you guys. Yeah, I like Pick too. But Pick's still kind of the same. He's not really, but he gives a little bit of his insight too. Yeah, Walter and Financial Juice. What about isn't there like B&O or BMO is another one? There's a few of them out there. I think there's like BMO or BNO Financial News or something they're called. Yeah, I think is that it breaking market news? That might be them. Yeah, Market Rebellion is good too. I like Market Rebellion. I haven't thought about him in a while. Hold on, let me put him up. Yeah, First Squawk is decent too. I feel like First Squawk's a little delayed. I could be wrong in that, but tell me if I'm wrong in any of that there. I think let me I'm gonna see how fast these guys are. Yeah, we got Market Watch too. I think Market Watch is slow. Let me see here. I'm gonna look at them all right now. I think maybe breaking market news might be the quickest. No, that's B&O, right? No. Wait, breaking market news is Financial Juice. I think it's B&O, right? Let me look. Yeah, I forget which one what it is. Let's see this one here. Yeah, this guy hasn't fucking delete this guy. Get rid of that guy. Market Rebellion last time was 18 minutes ago. Benzinga Audio Squawk. Yeah, is that the guy? Is that Benzinga Audio Squawk? I thought that was it. Doesn't that come from Trade the News? I think that might be a Trade the News thing, which I really like. We used to have that here. We used to do the Trade the News subscription. It was like $600 or $700 a month or something insane. Okay. So the Benzinga Live Squawk that was on Thinkorswim, that was the Trade the News Squawk. So that's all the same. That's all Trade the News. So that Benzinga News Squawk is definitely Trade the News. Because I remember I remember they used to have it for Thinkorswim customers, and when they canceled it, that's when I stopped using. Matter of fact, I think that was the time period where
we get the EIA steer report. We also expect comments from
instead of making recorded videos, I wound up doing live streams because the News Squawk was no longer available.
The Q&A will.
It was like part of the reasoning why we started this. Yeah, King Cow, I'm not anti. I want to see really King Cow. I want to see for me, King Cow, like you're saying, I really want to see whatever this is right here. Whatever rejection this or that is, like how low does it go, and does it go like spring shot straight up, or is it just picked up and we just grind higher? This part of the day here is going to be important. Whatever this stuff is down here, is that the double top? Like you got the top back there, then you got the double top, and then we start that big roll down, right? So whatever this is here is going to matter the most. It's a pretty big deal over here. I'm with you on that, King Cow. Am I flat? No, I'm in a meet. Well, yeah, I'm flat right here. So it's hard for me to be long or short when I'm meeting with these guys. So what happens is I'm with you guys on a stream, and then out of the blue, I get an email or a phone call or a text message, and they're like, we need you to talk or discuss this or make some decisions on that. And so I can't be in an active, whenever I'm in an active trade, I'm fucking there, dude. You know what I mean? Like you're like, eat shit, sleep this stuff. So if I'm in a trade, I'm all eyes. I know that people take a trade. I used to be able to do that too. I used to be able to take longer trades and not look at my trades. But day trading specifically, I got to stare at it. Because if it goes against me, I fucking don't want to lose, or I want to cut my losses or not lose. So if we just had a big fast, if we started turning around on a bear plane or something like that. And that's happened to me, dude. Like I can't tell. So last year, right? You want to hear a fucked up story? So at least 2 or 3 times last year, I fucking forgot that I had trades on, always in the overnight. Like I would close or leave a trade open, right, for like an overnight trade, right, for the next day, and then I would fucking do some shit at nighttime, forget that I had a trade on, and then wake up in the morning. I kid you not. Like, wake up, come in at 9:30, and I'm either like trying to forget to the last second, or it literally was green, then goes red like half an hour after open, not realizing that I had a fucking trade on. It's like zero dates, like 0 date, 1 date stuff. I try to be like laser beams. Am I in call spreads? No call spreads for me. I was in a trade yesterday, made some good money. If I had left the trade on, I would have been fucking rich, but didn't. I was bouncing in and out of the stream yesterday. Same thing this morning. So the other thing here too is, let me see if I can bring this up. Another thing too here, at least from my perspective here. Let's take a look at this here. At least from my perspective, I mean, this looks good here. From my perspective, I would like to put a spread on here. That's where I want to put a spread on. Now I don't like this here, so I'll day trade this. I day traded this yesterday. I haven't bought anything today, but I would day trade this, but I would not put a spread on here. I prefer the spread down here. Day trade, weekly trade, all that, like short term in here. I don't mind trading this, but in truth, for a spread, I want a little bit more cooling off. And the reason why I want that is I really do like the idea of this daily velocity being on the negative when placing any kind of spread. So, and the reason for the greater reason for wanting that buy down here is risk, time, the amount of money, and you can actually see what happens, right? Big giant move here.
At 12 p.m. Eastern Time, we get the EIA short-term energy outlook report.
So just from a perspective of the amount of money I put on call spreads, the risk that I'm exposing myself to on those call spreads,
but we do expect a Q&A.
And then it's not a perfect setup. So I trade call spreads anywhere from 6 to 12 times a year. If it's really a bull market, 12 times. Like, we're going straight the fuck up for the whole year, and that opportunity presents itself. I shouldn't say 12. It's more like 9 or 10. On the low end for a year, roughly 6 times. If we're in a bear market, about 6 times a year, 4 to 6 times in a bear market, and then about 9 to 10 times in truth for like the most prime setups. A call spreads, but they have to hit certain metrics for me. It's like I need us to be oversold. I need to have the right amount of time on them, and I don't double dip and triple dip on those trades. We've had this discussion before. Jill Natolo and I have discussed this before, because when we're down there, I could make more money just buying some 30, 40, 50 delta calls out in time. But this is a safe, it's not very, I don't have a lot of, from my history of trading, I'm trying to clarify this. On my history of trading, right, I've traded a lot of different shit. Like, when you're a new investor, trader, that kind of stuff. No, I don't want to move that. I want to do this. When you're a new trader and investor, things excite you, right? Like, oh, I like this, or oh, I like that, or oh, I always wanted to learn about this, or oh, someone's teaching me that. So from when I look back on my trading history, no matter how much money I made, right? No matter how much money I fucking made, something would always catch me. And over the years, you end up learning, I need something that's no matter what consistent. Like, it's not glamorous. It's dumbed down. It's not complicated. Doesn't take a ton of management. I'm not looking to be tinkering with stuff like running the wheel or winning 9 out of 10 flies, but then losing one major one in a big way. Just over, like, even buying stock, right? Buying stock, sometimes I'd be buying this like spec growth risk stuff, and then a bunch of it would get caught, and I'd have to wait a year or two for that stuff to actually come back and pay me. I've been in all those situations. So for me personally, the call spreads have been some of the most basic, simple. I could make more money doing other things, even if I have a high rate of wins on them. Just for me, it's worked simply for me. If I go back into my trading history, I'm most successful in those trades. So would I be in a call spread today? So to answer that question, it's not a perfect setup for me. So for that part of my investing, I have rules about it, and they're pretty firm. Like, they're pretty fucking firm rules. And when I put those trades on, why I put them on, why I don't mess with them. And why don't change what isn't broken? And you know what it reminds me of is
Shortly expecting the EIA steer reports and comments from FedSpar.
reminds me of J.P. Morgan. You know, their collar is very dated. And as a hedging strategy, there are better hedging strategies out there, but they stick with it. They've stuck with it for all these years. And I'm kind of the same way for myself. Over here, just take a quick peek with me really quick. If you look down the bottom right-hand side, we're coming into that yellow box right now in SPX. This should be a source of rejection. Even if it holds, we should bounce into it. Like we're either going to reject off it to the downside or we're going to break above and then sit on top of it. Okay, so just note this right here. And there's one other big note here. If we get above this 47.60 on SPX, it is literally big sky until 4,800. So big sky, big giant gap above. You can see that reversal candle as it's taking place on SPY right now. This is a tweezer, reverse tweezer. It's called, I think classic traders call it that. Just be aware of it as we come up in here and be aware where we are in SPX because above this, right? So we could trade this right here if you wanted all this, but above this whole zone up here is clear sky, literally. There's nothing stopping a giant fucking squeeze. So expect some selling pressure to come in here would be my point. Just keep your eyes on this down below, right down. This is a big boy right here, okay? Oh, yeah, definitely. Yeah, it's kind of like computers. It's weird. You're going to find out. I don't know how long some of you have been trading. If you start, you're going to go through this whole history, this whole career. You're going to have like 2 great years. You're going to be trading, not knowing a lot of stuff in the market, or at least for myself, right? Not just no market awareness. And then like I became a bear at one point, lost a bunch of money. Then what else did I do? Started learning how to trade complex spreads, went down that big thing. What else? Then I went and learned how to trade all the indexes, one by one, traded Qs first, then traded S&P 500, then dabbled in IWM from time to time if there was big moves expected. Then went to Tesla for I did AMD too before all that. Then I went to Apple for a long time, dabbled in like BA, tickers like that, risk tickers, then traded Tesla for a long time. Actually invested in Tesla, then traded, hold on a second here. Kitty, what are you doing? Risky kitties. I'm getting attacked right now. Then traded Tesla for a long time, like just actively trading Tesla, individual tickers, stuff like that. Did all that through, I think, a lot of COVID, if I recall. And then switched back to the indexes. As a matter of fact, Horse Lover Fat and myself started selling all of our stock back in the end of 2020. And then we both were like, you know what, let's start trading the indexes and the blue chips for 2021, and then we went and dumped all blue chips and just traded S&P from that point forward. Qs and S&P from that point forward, just knowing that it would be the easiest to trade. So that's really been where I've been at the last, I would say, September, November of 2021 until today. Mostly just for myself, S&P 500. But the point being here is after like 10, 15 years, there's a moment where you're just like, I only want to trade futures, or I only want to trade S&P, or I only want to do this with that, or these exact setups. You kind of, after you take enough beatings, you lose enough big trades that you do one of two things. You either get flushed out of this market forever, or you say, fuck this, no matter what, I have this one money maker that I know over 10 trades pays me every year, keeps me in this market every year, no matter what. Even a heavy loss, no matter what, you need to have like a good 10 trades where you can look back consistently every 10 trades and say, I am successful. This helps me in the market. The only other thing that I would say here would be make sure that you're removing money from the market as well and placing that money into some kind of appreciable asset. So this is another thing. If you're a young trader and investor, if you hit something really big, you make some money. Let's say like you get this stupid trade. I don't know, your favorite company, you buy some fucking calls on them. They trade up into their ER reports. They get a stock split. You make 15 times your trade, right? The one thing I got to say to you guys out there is please, please, please remove some money from the marketplace and put it into something that appreciates in general. One of the best ones would be real estate. If you don't think you have money for real estate, there are ways for you to invest in real estate as a fractional owner. There are companies out there. You can buy artwork, you name it, you can buy it. Get it out of the stock market. Like have that like it's like a third insurance, second insurance, for you to always have the ability to invest, trade. If God forbid you ever blew up your whole account, right? You have to have that second or third outlet. It is critical that you always have that like funding secured no matter what. And I'm not talking about your job. It's not your job. It's not like make your lotto trade. I know people do it. I get what people do to build accounts. I know what they do. They work every week and they make a lotto trade. And if one hits, they're in business again, right? I get that's the simple way. But in truth, if you want to be successful, every time you hit it big, remove some money. Put it into something that pays you. I don't care if it's a money market fund. I don't care if it's T-bills. I don't care if it's a fucking savings account that's earning you like I'm like some kind of a brokerage that's earning you 5% a year. Just something that is almost risk off that makes you some money. Grows, pays you, dividends pays you, monthly pays you, yearly, whatever that is. So that you're always funded. You always want to be a funded investor, funded trader in life. Do you have any favorite REITs? No, I have in the past. For myself, what I did, if you want to know my quick story, I had an opportunity and a chance to buy real estate in Detroit, Michigan. As a matter of fact, my first deal in Michigan, I got burned on. I actually broke the deal, put money down for a deposit. I think the house was $50,000 or $60,000. We'll talk about that in a minute. So I didn't come actually here. I looked at a house on the internet. I signed a fucking deal. I think the house was $50,000 or $60,000 or something, and they wanted like $10K down or something like that. So I signed the deal. In the last minute before I was closing, I flew to Detroit, and I wanted to see the fucking property. Thankfully, I did. I got a whole other thing on this stuff, which you should never do certain things. The mistakes that I made a ton of mistakes buying real estate, but I ended up backing out of that fucking deal. The rehab was bullshit. And I was going to be paying for something that I could have bought for 20 or 30,000 and put 20 or 30K in at that time period and got a way better house. I ended up backing out of the deal.
13.21 million barrels per day, which is up from the prior 12.93.
But the point here is this. I still bought a fucking house, and that house was in my means. I renovated that house, and then I began to rent that house out. And what that house did for me was give me guaranteed money every month, no matter what. It's fascinating too because, I got friends, right, that got caught in, like, I've had friends and family that have gotten caught before with their pants down when a housing market folds or blows up, right? You end up buying like a house in, let's say, a nice suburban area. Let's say you pay 150, 300,000. Well, not now, but at that time. And if we have a housing recession, you can get fucked over. We get pretty fucked up buying houses to flip or even to rent at the rent that you need to get, right? So what did I do? My whole family was like, do not move to Detroit, Michigan. It's a shithole. Now, I got here at the perfect time of the turn in Detroit, and it's worked out very well for me. I did very well in those investments, but I was counseled not to come here. I was counseled that those properties wouldn't pay me. Those properties with Airbnb are paying $2,000-3,000 a month, right? If there was a rental, it'd be paying me $1,000 to $1,200 a month, right, regularly, but on a $60,000 investment, right, not on a $125,000 or $150,000. And I bought those houses for way less, and I paid for way less. And then even the flip on those, I'd be making 100%, close to 100%. Now some of these houses are like 2, 3, 4. I have houses, dude, that have gone up in value thousands of percent. But you get my point, right? You got to find a place wherever you live. If it's some shithole in Salt Lake, if it's a shithole in California, if it's a shithole in the Midwest, if it's a shithole in upstate New York, wherever that is, find something that's value driven. Find something that you can buy, something you can rehabilitate, something that you can turn into a moneymaker for you. And there's a prevalent discussion out there about people shouldn't own homes, right? There's an argument like you shouldn't have an Airbnb, you shouldn't have a rental. There is a market for rentals out there. There always will be. Not everyone can afford or wants to own a home. So by owning a home and providing that, especially if you're an in-person landlord, you live in the neighborhood, you live in the county, you live in the state, you actively manage for tenants or for Airbnb guests, and you're a good landlord, you're a good manager of your properties, you take care of your people, those things come in, they pay you back multifold down the road. A lot of my friends now, they own 10, 20, 30, 40 properties, 100 properties. Since 2015, 16, most of my friends are now major, big-time landlords. I'm not that guy. I never wanted that. That was never what I wanted to be. It wasn't what I wanted to become. If anything, the more passive as a landlord is really what I want to be. I'd really like to own like a storage unit of some kind, something I have to do shit to, long-term tenants, commercial properties. And even here with Airbnbs, I'm trying to get out here by 2026. I'm trying to get out of owning anything and then maybe go back and buy some commercial real estate in 2028. But generally speaking, for you, you need to have some investments that are over time some of your best appreciating assets. Those tend to be real estate. Real estate tends to be one of the safest, even in a recessionary period. If you get caught in a recessionary housing market, it will come back at some day, unless it's like Detroit, a place like Detroit went through, where there's major decline. What about my kids' savings? What do you think for them? I don't want to keep it in a savings, and thanks, I've been killing it. Right on, Matthew. So, Matthew, for kids, I have 2 daughters. My wife has an investing account for my kids. So they buy and hold stocks that they like. So my wife and I will talk to our kids, and my kids are very insightful. They'll be like, well, I really like this, and I really like that, and it's on the exchanges. So they get to buy stuff that they like, and we get to have discussions about finance or economics or finance together at the same time. My oldest daughter has worked on gamma models with me, some stock market models in the background behind the scenes, and they discuss stonks with me, stock prices, accumulation, distribution, all that kind of stuff. It opens the door for conversation with your kids on making good investments in life. So for me, for kids, if it was, we have to do some other stuff too. Like we have college funds that are untaxable. But generally speaking, for the kids, the key part here is we have, or I should say more than that. They have a savings account with a credit or a savings bank card of some kind of small credit card that they use. We also have something where they get paid for tasks. So my wife will make like these tasks out, and she pays them when they do these tasks. And then they also do something where they buy and hold stock. I don't try to get them not to sell their stock that they hold. But opens up a discussion to further that point. It opens up a discussion between the kids and yourself as a parent. But you should start that young with your kids too. One other topic here too. I was told by my family and friends not to move to Detroit. It was a bad decision on my part, right? And it was dangerous and all this other stuff. I'll tell you what. I've made some of the best friends of my life here. Best friends. Most of my friends here are African Americans. I love these people. They're like my fucking family. And I'll tell you what. I've never been in any danger here, like real danger. I don't do stupid shit. I don't find myself at a gas station on the wrong side of town at 3 a.m. I'm not hanging out in barbershops waiting for a haircut. So I've never really encountered that. That hasn't been my experience here in Detroit. And the other thing that we had, one of our biggest issues here was education. That was the biggest issue for us here. Not finding work. If you wanted schooling, great places to live. They have to work on that stuff in Detroit. They have to work on transportation in Detroit. But one of the biggest fears for us was education. And we did just fine here in education. Our oldest daughter just started going to the University of Michigan, taking 200 level classes during high school. She's done so well in high school here that we had to put extra effort into her high school there, but our oldest daughter is going to the number 2 research public university in the United States and top 23 public-private institutions in the United States. So there's no the only thing that limits you as an investor or someone trying to become wealthy or someone trying to just not worry paycheck to paycheck. The only limit to that is your willingness to do what you need to do to get there. I was reading an article yesterday on Reddit. I forget what subreddit it was in, but someone was showing a house in Syracuse, New York. And I don't know anything about Syracuse, but I couldn't believe some of the top comments in that discussion were so negative towards this house. And truthfully, it took like a third of the way down in the comments to find the real comments. And people were like, they tell you that if you work hard, you can't get anywhere in life. That's not true. That is not true. That statement that you can't work hard and get somewhere in life is not true. You have to make sacrifices sometimes. You have to build a community. You're not always going to be able to buy right into something that's established. There was a time when New York sucks, but it doesn't suck like it used to. There was a time when New York was a real fucking shithole. There was a time when people were shooting up in Penn Station and Grand Central. There were war zones in New York City. Boston at one time was a fucking combat zone. Santa Monica, California at one time was a fucking shithole. So think about the idea that there were older generations that moved to those places and rebuilt those communities. Now, if you're young out there, you might not be able to rebuild Santa Monica or New York, but there are other places. There are communities all over the United States looking for young people that'll come and buy a house, raise children, work hard, pay their taxes, show up to their school board meetings, invest in their community, and grow that community. So if you can find those communities as they are coming up, jump on that if you can. If you have the ability to do that, do it. It does change your life for the better. Q's. Extreme bullishness right now. Q's able to get above their previous high set on Monday at 4 p.m. Now coming back to get some sexiness to the upside. Keep your eyes on Qs right now. Looking absolutely gorgeous here. Bullish. I don't expect this big pullback down here looking at the Qs right now. Just going to let you know I'm not expecting this major pullback right here. We could go straight up at this point. We might just bypass all of this. You might get a 5-minute pullback here, but that's about all that I expect. Q's looking extremely bullish right now. Extremely bullish. Keep your eyes on the bottom left-hand side of your screen down here. Here are the QQQs, and they look, this is a gorgeous setup down here. Absolutely great traditional setup. We got the back check on the hourly trigger, trade up, and now we're just looking to back test this and create a nice level of support to get a giant squeeze to the upside. If we are able to get that giant squeeze to the upside, the gamma models on SPX are showing a giant air gap to the upside. Let's see what happens here. Okay, so where we roam just asked, Cap, generally when the Fed starts cutting rates, we see a big pullback in the market. Looking at some historical data, looks like to be around 30%. What are your thoughts for the next one? We have a yearly report coming out that addresses this in full, exactly what you just said, where we roam. The idea here right now is put your blinders on, truly put your blinders on, and I want you to consider this right here, okay? I don't care what any fucking Fed president has said except for Jerome Powell. The little Fed presidents mean zero. They're allowed to say whatever they want. They are not the president, the Fed president. The Fed president has only stated one thing and has reinforced it. Higher for longer. Do not expect cuts until late 2024. That's December or even later. You are correct where we roam. You should see a major sell on any thought of rate cuts. So as we move through this year, every meeting will be the fear of a cut. The bulls need the Fed to not cut, and the bulls would even do well with a rate increase in December or January of 2024-5. And we'll talk about that in more detail, but generally speaking, the Fed, as long as they hold rates, outside of normal corrections, the market should grind up into the right. The moment they begin to cut, this market, even if it squeezes, should have a significant downside move, like you're speaking about that 30%. So how do they accomplish this? Well, you should get some seasonal weakness that we get every year as long as rates hold, right? So you should see that seasonal weakness into March or April, and then you would have a dip buy. And for this year in particular, we have a presidential election, so they're likely not going to want to rock the boat, the Treasury Department nor the Fed, if they possibly can. And that would mean that you'd have a big run up into not the run up into the election, some weakness in September, and then a run up into the election, and then an extension of that into January and March. Now, if the Fed's looking at cutting rates in December or January or March, it's going to be kind of a hard place for Jerome to do that, right? You're going to be seeing, not all time, you might see 5,000 or 5,200 around that point, but you're going to see the general public saying we want rate increases, not rate cuts. That could extend this bull market into 2026 at least, early or late 2025 or 2026. It'll be a conundrum. Now, if we get into that January-March period, let's say we're trading 5,200, something like that, 5,000, 5,200, right around there, the question becomes, do they raise, right? You'd be having the roar of Main Street to raise rates. Now, if they don't do that and cut at that time period, that's how we come to that old idiom of the Fed's cutting while the market looks great. We must have broken something. And that will trigger your 30% downside move that you're looking for. But yes, you are correct, where we roam. Where we roam, keep your eyes on two things. The rate of unemployment going up. If you start to see it steepening to the upside, heading towards that 4%, 6% area, and you see also at the same time inflation slam down, vertical down and slam into 2% year over year, and then begin a vertical rise, straight vertical rise as employment's coming into that 4%, I would be very fearful of the Fed beginning to cut rates soon. Where we roam, I got a report for you, man. There's something else fascinating too, where we roam, where you have the window of a soft landing, how long that lasts, and then the window between the next recessionary period. So you've got, on your left hand, you've got the soft landing, and then you have an almost guaranteed or historically guaranteed recessionary period after that follows. But if you look at the start and end dates of that soft landing and that recessionary period, there's also a window in between the two of them, and that's the window where the Fed does or does not cut rates. And we have 3 examples of that in prior history. In those 3 prior examples, they lasted anywhere from 1 year to 3 years to 5 years, and it all depended upon what the Fed did. All laid with the Fed in whether they raised rates or not. Now, there's an option C or D or X out there where the market does not sell off on rate cuts. It's a very rare thing when it happens, but when it does happen, you would want the Fed to be cutting rates, but also announcing in public that they are increasing the money supply. And preferably, you'd want to have a public announcement of the increase in money supply before or as you're cutting. Now, I don't see that happening. I think there'd be an outrageous outpouring of rage. Now, are we increasing the money supply? Yes. How are they doing it? Oh boy, are they doing it. They're very sneaky right now. You've got the federal government increasing the money supply through spending. Then you've got Fed banks that are funding prime banks that are loaning hedge funds money to put into the market. So you've got hedge funds with loans going long in the marketplace right now to make more money for themselves. So rather than increasing the money supply for the poors out there, you want to hear how disgusting shit is? You want to know how gross stuff is? This is gross. Rather than increasing the money supply for Bob on Main Street, right? So instead of me saying, hey, here's a living wage, here's, here's improved this or improved that, anything like that, they're saying, you know what? No, we're not giving it to Bob on Main Street. We're going to give it to some fat old rich guy. We're going to loan that guy the money and let him make more money in profit for themselves. So that's what we're dealing with right now. I'm going to think of a pullback right now. I am expecting a pullback here. I'm going to expect a back check at least on the 5-minute here, mostly due to, if you look down here below, you look down here in this chart that I'm wiggling around down here in your screen, and this is Q's right here. Classic setup, right? Little dragon, right? What you see is the tail back here. Here's the belly down here, a couple legs. Sometimes you'll get this second leg down here, and then we come back up right there, and you get the head over here. So you got this one right here, that one right there, and then the shot to the upside. So some kind of a pullback check back in here we should get at some point. We may not get it, but I'm going to expect it at least. We'll get some kind of a test down here. Maybe we come up here, squeeze up here, pull back, and then we get our next big move to the upside. I got you where we roam. Yeah, John Haggerty's also saying the Fed won't cut until the 10s and 2s yield curve uninverts. That's the recession signal. And, to John Haggerty's point as well, you're going to see the Fed. I mean, I want you to wrap your heads around this. Stockchart.com had a interview. Oh, I posted a link to it in the chats, right? They had an interview with a few hedge fund managers a week or two ago. And one of these guys said, I have to be able to, he's like, I'm trying to wrap my head around the idea that the Fed is going to manipulate the yield curve through this year. And truly, what they're going to try to do is manipulate the yield curve for about a year until we get through that election period. Where we roam, too, one other thing. When you stated cap generally when the Fed starts to cut rates, you are correct, brother. More than generally. You can, where we roam, the 10s and 2s, 10s and 3s are a poor indicator over time of being a crash predictor. Your best predictor is typically rates, unemployment, jobs as one thing, and then inflation. Those are your three drivers right there. I feel like your three, what am my most consistent? About 80% of the time you can predict a crash with those three right there, and which is the yield curve is more like 65% of the time. It's a poor indicator. Yeah, I know, Beartown Sheriff. I know, dude. They're lying, man. They're so lying, dude. This whole market is a fucking fraud. I'm gonna be honest with you. You guys, this market is. I was telling Joe the other day. I was like, I think this period. No. I'll say it like this. From the start of Q4 2022 until our first rate cut, you're likely going to see the most fraudulent market that we've had in some time. And I mean fraudulent, like just lying, point blank fucking lying. You want to call maybe the COVID money was a fraudulent thing. They were upfront and honest with you. Right now is probably the most fraudulent creation of money period that I've ever seen, and the most fraudulent reporting of numbers that I've ever seen. Hands down. That's right, man. National champions, baby. Yeah, I don't like the corporations and what they own. I don't like that. I'm not a fan of BlackRock managing other people owning all of those properties. I'm not a fan. The thing that bothers me, the thing that really grinds my ass is that these banks, right, are in a constant pursuit of profit. Banks used to never, ever, ever trade the stock market. You think about the exposure that banks have taken on since the 1950s and 60s, but even more aggressively in the 70s and 80s, then the 90s, then the 2000s. And the last big one that they've done is housing, real estate, specifically residential real estate is the newest thing that's taken place the last decade, has been residential real estate investing from banks. It's probably the most exposure that they have to risk as well. They have some risk in commercial real estate too, but the residential real estate market specifically, there's like three or four groups out there, like Moody's, BlackRock, couple other where this money that's managed, it's some of the most concentrated money in the world. These are the real people that make the real decisions in our world when it comes to like money and power. And I don't like that they're as involved with real estate as well. I'm with you on that one. Whoever, I think that was Bork that said that. I'm with you on that one 100%. 100 fucking percent on that stuff. Well, that's the other thing too about the commercial real estate market. The grossness of it is so. Like last year, Jamie Dimon had a bunch of meetings with Yellen at dinner. Like I kid you not, there was like a dinner, and Jamie Dimon's claiming that he's saving regional banks and he's he's saving commercial real estate and all that kind of stuff. The idea that they're trying to do is to stop that bubble from bursting and just give a new owner to all that shit, right? Basically, Jamie Dimon. GS wants in on that deal as well, or wanted in on that deal as well. And that's how they're trying to thwart that. So basically, if I own commercial property and I go bankrupt, all that debt gets wiped away, right? Wipe your hands of it. And then there's just a new owner of it. Just consolidates to the heir apparent, which at that point in time, it was Jamie Dimon. Yeah, I'm interested to see what happens after this election. I'm interested to see who becomes the president. I would assume that if Biden wins the presidency, we're going to burn this fucker down because he's not reelectable. It'd be an easy president to dump this on. If he wins the re-election, I would expect us to he's going to carry whatever that is, whatever that doom and gloom is. New York still sucks. Just a different kind of suck. Yeah, there's no more need to float the market. If he wins the election, right? There's an opportunity to fucking destroy the stock market and literally let him be that president. That way you get a fresh election cycle and you get two different we should have more, but basically you're leaving a clean slate for Democrats and Republicans to say, we're going to save the country. We're going to cut your taxes. Look at how bad the economy is. It's all that guy's fault. Biden steps on a sword, that kind of stuff. There is an idea here that if he did lose the election, that you could see an extension or a continuation for that president's first term. Do I want to long some banks with you? In the yearly report that I have, KRE. I have KRE picked as the long for January 1. We're past that now, but January 1. You're in KRE calls. Awesome. Let me see what I got. You guys want a little bit of a leak here? Hold on. I'll read off some of the. Get a pen and paper out, okay? If you're at home right now, get a pen and paper out. And I'm going to list off some of the sectors that I'm looking at for this year. Joe's going to get mad at me. Hold on here. Can I, hold on. Let me see what I got here. Private post. Can I view this? Here we go. Hold on one second here. I'm going to read off some stuff. You get a pen and paper out, okay? I was going to actually leave this out of the report and leave it for some like VIP people, but I'll read some of this stuff off to you. Okay, so I've got sector ETFs to watch for outsized moves to the upside in 2024. You're our Bad Influence Trader podcast. Okay, you ready? These are the sectors that I'm interested in for outsized moves in 2024. IHF, healthcare. India, Hotel Foxtrot. For infrastructure, IGF. That's India Golf Foxtrot. For real estate, VNQ. Victor, November. And I forget what Q is anymore. I forget what Q is now. Quit, maybe? What's going on, David? Good morning, brother. That's VNQ. Next one, luxury. LUX, Lima, Utah, X-ray. Utilities, VPU. That's Victor, Papa, Utah. For metals and mining for 2024, SIL. And remember, SIL, this is Sierra, India, Lima. And this is the Global X Silvers, Silver Miners ETF. Make sure you got the right SIL on that one. Consumer staples, Yummy, YUMY. That's Yankee, Utah, Mike, Utah. For materials, SLVP, Sierra, Lima, Victor, Papa. Communications, XTL. That's X-ray, Tango, Lima. Now, if you're a tech bro, you're gonna love this one. XTL. And then for all my widowmakers out there, I got one for you. One of my favorites. Healthcare equipment. XHE. That's X-ray Hotel Echo. And some of that COVID trade has fully retraced in hospital or healthcare equipment. So take a look at that one. David AMS checking in this morning. He's saying he's checking in from the middle of the Atlantic Ocean, baby. He says he's got 6 more hours to fly to beautiful weather, sandy beaches. Last year, David AMS checked in. I think he sent pictures or a video. I thought we had a live stream. So maybe when David gets that to the Caribbean, he can live stream and just check in and say hello on his current vacation. Say what up to us. So, David, if you can hear us, man, when you get down to the Caribbean, if you have a chance to get on your phone, man, we could do a signal video call or a Google Meet, whatever you want to do, whatever's cheap and easy. We can get David on the show to say hello and what's up to everybody. Beartown Sheriff's asking if David is trading from the flight. David, are you in any trades right now, brother? Oh, and Jill Natolo is down in Aruba. So just a heads up, Jill wants to know if you're going to come to Aruba and party with her, David. Oh, hell yeah. Andy's going to live stream with us. So we're gonna have when David arrives in the Caribbean, we'll have David on as a guest to live stream and get a market update from him. You guys are gonna read these off to you one more time. I'm gonna read them off one more time, just to confirm. Now these are yearly trades. At some point, you're gonna get an actual chart that's gonna show you what to look for the year. I'm going to go through them quickly one more time. IHF, IGF, VNQ, LUX, VPU, SIL, that's the Global X Silver Miners ETF, YUMY, SLVP, XTL, XHE. These ones are the gnarly ones, okay? These are the widow makers now. I'm going to give you I'm going to give you a bonus here. You ready? Bonus. For any of you that do like widow maker stuff, like natty gas. These are dangerous. These are commodities. Be very, very careful. Please do your due diligence on trading this stuff. Dude, I'm telling you, I know people that have been serious and taken delivery Well, they were trading straight commodities, but these are ETFs, so you should be safe here. Relatively safe. Well, versus taking actual delivery on a fucking truck full of oil or wheat. So these are some widow makers for 2024. You ready? EVMT. This is electric vehicles. EVMT. Next one, wheat. WEAT. Wheat. Any of you guys remember taking deliveries of wheat back in 2020? Biotechnology. GNOM, excuse me. So it's Gamma, November, Oscar, Mike. And then we got banking. KRE, baby. KRE. Big upsides expected. And then solar. RAYS. Raise. We'll go over those one more time. You ready? Electric vehicles. EVMT. That's Echo, Victor, Mike, Tango. Agriculture. Wheat. WEAT. Ticker signal. Whiskey, Echo, Alpha, Tango. Biotech is Genome. That's Gamma, November, Oscar, Mike. Banking, KRE. That is Kilo, Romeo, Echo. Then we have Solar, which is Raise. That's Romeo, Alpha, Yankee, Sierra. There you go. There's some outlook stuff for you guys. And then I've got a bunch of charts on that stuff. You'll get that released to you in the upcoming week here, day or so. Still, I'm not done with it. Thought I would be done. Still not done with it. Yeah, Lux's juicy, man. Juicy. No XBI. I'm looking for, this is a heads up to you guys out there, okay? I picked all of these sectors because when we came, so last year, right, in December, we had a conversation at Captain's Alpha where I discussed sector-specific ticker symbols that had been really beaten down. These things were down for like 2 years, like just taken to the fucking woodshed. And a lot of these ETFs, if they've been taken to the woodshed, way outperform because of the makeup of what's inside of those ETFs, right? Now, all those ETFs this past year in 2022, they went up like 20, 30%. Pretty fucking big gains for all of those ETFs we went over. So this is in that same fashion. If you're looking this year for major outperformance, like outperform, does XBI go up? Sure. But we want to get into a granular, I want specific outperformance. All of these tickers I listed to you are very risky, but should outperform. So it's like a spec growth type ETF. It's not spec tech growth, but it's spec growth, like speculative growth for this year. Where will it be? And then my expectations are that most of these, or some of these, like 70% of these are going to outperform in a big way this year. Oh, they're trying to go way higher, way higher. So, look right, keep your eye down here. This whole thing right here. We're not getting above it right now, but we are banging into it. It's kind of take a pic or keep your eye on this. Snap a line at home at 47.60, and they're rejecting us up here right now. Slam. It's kind of bearish seeing this. But if you're able to get above it, there's a giant fucking gap up here. Giant gap to the upside. And I mean fucking giant. Like this is looking for that right there. Yeah, so any of those tickers that I listed off to you, I want you to look back try to do yourself a solid. Look at all those tickers on at least the daily chart and look at how long they've been in decline. Most of them have been in decline for multi-years, 2 years. Most of them have given back all of their COVID gains, which is the other thing that I'm looking for. So remember we used to talk around here about a stool? Remember I used to say to you guys, think of the market like a stool, right? When they're cutting off one leg at a time without a major crash and then buying those bottoms. So they dismantled this market slowly beginning in November, December of 2020. And they began to de-invest themselves, but it was like one sector at a time, very slowly over time, which kind of stopped us from crashing in a major way. And so as we began to head into 2023, we were looking for those sectors that had been destroyed. Now, the same thing applies to 2023, 2024. This winter season, like December, January, you're looking back in time and saying, hey, what right now has given up all of their COVID gains and is starting to bottom and make a turn to the upside? So we're trying to find out where these hedge funds are buying before the big banks, before the elephant comes in the room, right? You always want to be in first, right? You get in first, you get the hedge fund guys in there, you get the speculators in there. These are speculators. These are like market makers, like true market makers, and speculators that have big money, right? These aren't commercial traders. These are, well, they are, but these are like your best traders that leave your best banks and they go on their own. They become market makers or friends of market makers. Market makers are accumulating all these tickers on a big low, and then what they do is they begin to sell or pump this stuff up, right? And people start buying it. People like you and I that are watching, we're buying it along with them, raising the price on this stuff. Then eventually it gets into the public. Then the banks jump on it, and the banks are like the big elephant in the room. They got to hold it for another 6 months or something like that. And then we get these big giant upside moves to the end of these runs. So these are the ones that I'm watching for this year. I'm looking for a turn in these ETFs. Yeah, David AMS is saying right now, Powell always said his aim was market stability. Agreed with you, David. 100%, brother. Yeah, I agree too, David. You can say what you want, hate the guy, love the guy, but he kept his word. That's a key point, David. He kept his word. He's been forward. They used to never be like that, right? They used to always drop bombs on us. Now it's like, we're going to pre-warn you. We're going to say it until we're blue in the face. What was the other thing they said? He said, stop using that word, right? What was Joe was saying something about, and we were relating it to the soft landing. Eventually they're going to tell you that we made the soft landing. We know the soft landing likely took place in late July. Yeah, transitory, right? They said transitory, and then one day Jerome's come out and said, okay, you can stop using that word. He'll come out and say that about a soft landing too, right? So we'll have that soft landing period. A year will pass. We'll look back, and one day he's going to say, stop saying soft landing. We had the soft landing. So right now you're trading that soft landing. Even though you haven't been told that officially, that's what you're doing right now. You're trading the soft landing. Your next phase will be the window between the soft landing and the next recessionary period. Could be we look for a giant squeeze here, boys and girls. Giant squeeze. Starting to establish ourselves above 47.60 right now. See this right here? This bad boy is very bullish here for a squeeze. We could get a giant squeeze here. Giant squeeze to R1 on deck right now. Yeah, we got a real chance here of a fucking moonshot, like straight moon. Woof. Straight up. All right, I gotta go back here.
Are going to be things like that. And now you get companies like HP doing acquisitions because they're looking for growth. And I think that's where Juniper's been out of favor. So you're going to see companies consolidate. It's going to be more cost control. And then how do we grow our revenue? So I think this is going to be a start of some of these other companies, and you're going to see more acquisitions.
Juniper's been out of favor since 2001. If you look at that chart, it hasn't done a thing.
Yeah.
So the fact that HP has to pay up for this thing, that's crazy to me.
And you see what happened to HP stock.
I know.
Right?
No
So
wonder, right?
21% or 22.5 now. So look, Urban's up about 9% today as they report their holiday sales. They have a new president of their Urban Outfitters brand. Unity is down 8.5% as they say they're going to lay off 25% of their workforce. And then JetBlue's down 10%, having its worst day since October. They have a CEO change. So you own United, which got double upgraded today.
Right.
And Delta, you own Delta too
I own
still,
Delta,
right?
yes.
Delta reports on Friday.
Yes.
So what's your take there?
So I think for United, you're seeing travel now grow internationally, and that was their biggest. I think if that what was going to hurt them was the international travel, especially the Far East. I actually prefer Delta over United because I think Delta's got the best routes. And by the way, this Boeing thing, like I mentioned at the top of the show, it actually helps all these airlines because now they can price even higher. And that was actually slowing down as we got into the year.
All right, final trades. We will take a break and we'll come back and do that next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
HYG closing their gap just then. VIX getting sent down to the depths of hell. Trading 1288 right now. Apple with a gorgeous cup and handle right now on a 1-minute chart. TNX looking pretty bearish here. NASDAQ completing a cup and handle. Apple still not completing it for a squeeze higher. Watch out for a giant squeeze here.
Fed's bar says potential new exploratory stress test scenarios could not be used to set capital requirements. So again, Fed's bar speaking on cap requirements says a potential new exploratory stress test scenario would not be used to set the capital requirements.
Look at that. We're lining right up right there, too, to this part right here. So is it like a bloodbath then straight up?
Protect your. Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service
Ah,
for
shit.
the price of 1 month and save 92%.
Fed's bar goes, potential new exploratory stress test scenarios would not be used to set capital requirements.
All right, 3 o'clock Eastern. Hope you'll join me on Closing Bell. Walk you through the end of this market day with Adam Parker. Nicole Webb is going to join us here at the New York Stock Exchange. Anthony Scaramucci on as well as we wait for this Bitcoin ETF announcement from the SEC. I think we're going to get it by tomorrow. I think that's the deadline. So we'll talk about what that means for crypto.
Fucking, they got Scaramucci still out there slumming.
Off to a decent start this year as well. So I hope you'll join me then. Josh,
The
final
mooch.
Alphabet, think it's going back to 150.
Okay, Surratt.
Delta, going back to the airlines, I think they've got the best pricing and the best routes.
Okay, Amy Raskin.
Franco-Nevada playing on Surratt's commodity trade. It had a big tumble due to a mine in Panama. We think it comes back.
Okay, and Stephanie Wayne.
Home Depot, I like the housing theme for 2024.
Okay, so Dow is still negative. We have had that buying, though, in the NASDAQ. We'll see what progresses. I'll see you in a couple hours on Closing Bell. The exchange is now.
Quite a few Tesla gang on FinTit disgruntled about performance as of late. Let's take a look at what we talked about with Tesla yesterday, see how that played out. What did we say about Tesla? Look at that, huh? What do we say about Tesla? See that right there? You see that right there? We said what? We said expect this to get sold, right? I said what was my price target? 227.67, right? Yeah, it kind of happened yesterday. What else did I say to you yesterday? I said I like to buy the daily velo. Whatever happens here, what am I going to expect? More downside to come on Tesla. And what did I say I wanted to buy? You guys remember? Said I wanted to buy daily velo lower, right? Down here, right? I want minus 25, minus 50 on daily velo. It's my favorite Tesla trade. So let me tell you guys something. It's a very good thing. It's a very good learning experience here. So think about this for a minute. Oh, yeah, baby. Squeeze it. Oh! Oh! We're squeezing, baby! Oh! Well, hello there. Hello there. What's going on? Oh, baby. The squeeze. Let's go back to Tesla really quick while we're squeezing. So on Tesla, I personally love buying Tesla cheap. So let's say this Tesla right here. Tesla goes back up, big sell to the downside, right? This is all lining up, by the way, for likely a major sell to the downside on Tesla, okay? Be careful of this right here. So can Tesla keep going up? Sure, but look at this 236.78. This whole like cluster right here. Looks like we want to revert. Well, here, we give you that last one right. There's a new one right there, bro. Right there, 237.83, and then another sell. Believe it or not, is what I'm looking for on Tesla. I always like to buy Tesla cheap, and I also always love to buy Tesla on a daily velocity low, which is not showing here, but it's not there yet, quite yet. So when we get there, right? When you get there, my point behind this conversation is that if you're listening to bulls that are unhappy with Tesla performance, it means that they're not buying at the right place. So if you're hearing people that are angry on Tesla right now, if they're angry on Tesla's performance, I would ask them a follow-up question where I would say to them, why are you angry right now? If they say something to you like, well, I was long Tesla, I got caught. Or they say something to you like, I got caught in Tesla. I'm upside down in Tesla. Why is Tesla not moving? Ask the reason why they're angry about it. Because what I would posit to you is that those people likely don't know when to buy Tesla. If they did, they would have exited, be very happy and wealthy right now, and then just be sitting on their hands waiting for that dip buy on Tesla. Now, there might be an intermediary dip buy here today on Tesla, but in truth, Tesla's not at the next buy point yet. Daily velocity on Tesla is not at minus 25, minus 50. That is the best time to buy Tesla, bar none. We can go back in history, and every single time we are at minus 25, minus 50 on daily velocity, it is the right time to buy Tesla. So I'd be asking people on social, like, hey, are you upside down? Did you not take profit? Did you buy the wrong place? Find out why, because the truth is this. Whoever's telling you that, they may be on the wrong side of Tesla frequently. So from my perspective, when I'm looking at Tesla right now, it's not the time to buy. And even if it goes up, to like 300, it's not the right time to buy for being a happy Tesla buyer. Oh fuck! Oh yeah, dude, I bought Tesla right. Well, no. So the morning the Tesla low, I was so angry that morning. I was like, I'm gonna wait on the open, and hopefully it goes down and closes the gap, and it didn't. It left that fucking gap down there. Made me so angry. I had to chase it, and then I was all stinky about it, and then I didn't join in the party until later in the day. I think I was pretty pissy that morning. That morning when it had that low, I wanted that last couple bucks, and I didn't get it. But I did end up buying. I ended up buying Tesla and running it up. Where we roam. Just check in with me. Not on the hour. It's you check in every couple days. So, and I keep checking it every day. When it gets down there, it's time to buy. I'll let you know. You'll be a happy Tesla buyer. And I'll tell you what, where we roam. I don't care where Tesla goes from here. I don't care how high it goes. Always buy the negative daily velocity on Tesla. It is like a sure fucking thing every time, every single time. You get giant fucking gains out of it. Sell off. They didn't like that, did they? They didn't want that at all, did they? Look at them up here. These fucking guys don't want that at all. Look at the squeeze right here. They're like, fuck you. Selling into you. They did not want that, did they? Look at that right there. They were like, get bent. I'm going to post something on Twitter. That was too. Watching that right there was hilarious. That was like the anal probe Does that hurt? Yes, it does. Hold on a second here. So terrible. I shouldn't be. That's not about trying to be mean. Oh, so terrible. So bad. Oh God. Oh man, that was so terrible. That was the bare anal probe right there. That was the no touchy zone. Yeah, exactly. Point to where the bull touched you. Oh God, so terrible. We're so bad. We're so bad. Oh God. Oh God, so terrible. Oh God. All right, hold on. I gotta hold on. I gotta do. Hold on a second here. Oh God. Hold on. Hold on. Hold on. Hold on. Oh god, we're so. Oh god, it's so terrible. It's so fucking terrible. Can't not supposed to be laughing.
What that's accomplished is we've gone from job growth of 700,000 per month down to about 165,000 per month. And that's a lot more sustainable. That's what we've seen over the last 3 months. The unemployment rate is still sitting down at 3.7%. So it's not as though this slowdown in job growth has caused the unemployment rate to shoot upwards as many people had feared. Rather, this is allowing the unemployment rate to stabilize at a very low level.
Are we going to look back, Dean, and say, well, as I remember from past cycles, the 3 sectors you're citing for job growth are often the last place that a downturn shows up. Is there just a lag effect here?
I don't think so. And I think that's what is different about this cycle. It is the pandemic cycle. These sectors are still very depressed relative to pre-pandemic readings. And I don't think they need to be as depressed as they are. Healthcare, leisure, and hospitality, those should be growing along with the economy. And so I think that these sectors have had trouble staffing up. And most firms in these sectors are understaffed. For example, that's what we're seeing strikes in the healthcare sector about, is understaffing and overwork of their employees. Right. So I think there is still a lot of hiring left to do.
Quick last word, Steve.
Yeah, Kelly, you and I have talked about this stacking effect, the idea that you would go into a recession if all of these industries were negative at once. One of the things that has been good about the process is we've had already some changes and restructuring in certain sectors already. So the idea that these 3 sectors are pulling us through this period when other sectors are adjusting, that's a good thing for the economy. And then you may be on the backside of things like transportation and warehousing and other sectors that have in the down cycle from the pandemic, they could be coming back at a time when the economy will need that strength.
No, you've been early in identifying that, Steve. Maybe we can ride it out here. Steve Leisman, Dean Mackey, thank you both. We appreciate your time today. Let's turn now to one place that is often a barometer of overall job growth in the economy, small businesses. And they are getting slightly less pessimistic on things, although they still see 2 major issues threatening to tip the country, yes, into a recession by year end. Kate Rogers has the details. Kate?
Hey, Kelly, the National Federation of Independent Business out with its monthly read on optimism for the month of December, increasing slightly, as you said, 1.3 points to 91.9. That is among the highest readings of the year, but it's also below the group's 50-year average of 98, and it's been there for about 2 years now. The top issues for Main Street this month: inflation, quality of labor, and taxes. Inflation moving back into the top spot for December ahead of labor issues, but those 2 remain really sticky for small business operators. The NFIB reporting overall views on the economy are still broadly pessimistic at the moment, although slightly improved. The group's chief economist, Bill Dunkelberg, writing in his commentary that 2024 will be a slower year. Quote, overall, the growth rate will most likely be lower than last year. The economy will slow down, possibly delivering that long-predicted recession by year-end. High interest rates, Kelly, are also of concern. In a separate credit survey, the NFIB found those rates were impacting decisions around financing, and that about 80% said high rates were their biggest issue with accessing capital. That's up from just under 60% over the summer. The average rate paid on short-term loans was 9.8% in December. That's up from 7.6% 1 year ago in January of 2023, although the CapEx number for small businesses was still slightly higher in December. So a lot of mixed messaging there.
I don't know if we can show that chart one more time. The rates they're paying, it's exactly what the Bears said was going to happen. They said small businesses are going to be paying.
Just watch out here. There's a little bit of a rug pull going on. Just be careful of that drop. We showed it back here happening. There's some risk of that quick drop down. Look for a nice dip buy down here if you can get it. It'll look like a liquidation break, and then it'll blast straight down, then straight back up. There could be a moment of weakness in the market where it's just quickly to the downside. Just be careful. If it happens, it'll give you another nice dip buy down here. So just be prepared to be able to buy this. If this does happen, you get a little bit of a bounce down here. So we're ready to like start a position here, add to it down here to get back up here and squeeze higher. Yeah, that was pretty touchy down there, right? They knew that, I mean, you know what's happening there, right? They're gonna the squeeze there would be brutal, right? Everybody be unfucking trying to get unfucked as quickly as possible. And they are trying to sell into that number too, right? Every time you come up here, or not every time, but this coming up here, you can see this. This is where the sellers really are up here, and otherwise they get squeezed in a very big way. Like that squeeze becomes, here's your R2 up here, and then you've got your R3 even higher. Way up here is your R3 for today. So this is a pretty significant place, right? They're telling you, fuck you, no, there's where sellers are. Why are they telling you that? Why is there so much supply in here? Because they don't want you fucking going up here, and they don't want you going up there, right? You got a bunch of old money stuck trying to sell into. You got to wear out those sellers. You got people that have been long this market, trapped since early 2022, excuse me. 2022, early 2022, trying to escape, get out of the market. So we got to wear all those sellers out, and then we can squeeze higher. Yeah, I don't know if it's that as much. Oh, no, but it's like anything. There's two things, right? You got people that are people that are selling into this number, then you got people that have been trapped for a couple of years, just trying to get out, that kind of stuff. You got funds that want to sell off this, knowing that people are going to be scared to long here. You got all kinds of mechanics there in the background working against going up. There is one positive here, though, which would be that dealers are supportive of this move up. So if you're a retailer trying to get up there, right, or as of right now, the gamma is supportive for dealers to buy and route all of these sellers from above. That's right. JPM is not a trade. It is a hedge. They win regardless. If the market goes up, they win too. If they pop the collar, they're still making money on their underlying holdings. That's right. Absolutely. Absolutely. David has got that correct. Popping the collar on the JPM hedge is not a losing trade for them. What are the odds of the JPM collar missing 2 quarters in a row? Pretty rare. It's not too common. Not too common. And as a matter of fact, not matter of fact, but I think their upside. Let's take a look at their. I have the collar here, right? We look at it. I thought we looked at the collar a week ago. Let's see it right there. So this is where I've got the collar. These are my expectations on the collar. I showed you guys this right when the collar came out, right? I'm expecting a dip buy, hit the 5015, and then have your seasonal low, which is normal. Now, is it at 3,800? Probably not. I don't think we get this low. I think it's going to be more. If it so I left this down here. I guess I left this down here, but more to the point. My seasonal low here is roughly around 4,100, somewhere in here. But if we had like a brief moment at like 4 a.m. where we went down there, and then by 9 or 10 a.m. we were back up here, like literally something like that, wouldn't shock me. Also wouldn't shock me to just come down here and just bounce around right here. But you get the 5,000 that you're looking for. Come back underneath. Seasonal low is somewhere in here. That's like a 30% chance at best. I'd even give it maybe a 15% chance. Okay, that we actually do this part here. This part right here is about a 60% chance. Even in a bull market, you're looking for. So like this 4,100, 4,200, So this right here is pretty fair chance of us tagging this area down here. And that would be your yearly low. And that would be sometime in late March. Now, this could take place in April. So there's a potential for this to not come true until we get into April. But mid-March, March 20th. As a matter of fact, I got a date for you. March 20th, 21st. Sorry, March 21st should be this low right here. And I think even in here that we don't beat that. I think we just get the SPX high. And then you begin your descent down for your seasonal low. Now, even in a bull market, you're going to get a seasonal low unless you have money creation public and rate cuts, which we don't have. So we're not in that situation where we're going to grind straight up for an entire year. So if you're trying to say to yourself, hey, can we have like a 2020 where the market just fucking goes straight vertical for a straight goddamn year, basically goes straight fucking vertical, high probability that does not happen. Now, saying that, right? If you guys saw whatever this stuff is down here, I think that's like the September one. It's close. And then there's the December ones right here. Let's pretend I've got this right. This is just funny math right now, but the idea being here would be that one right there. Put that on like a 30-point right there. Oh, that looks kind of wonky too. So the idea here, let's see if I can go over this one. Screen. The idea here would be what? That we're going to be targeting at least this right here. At least this is the target, okay? So the idea here is that all that. They're all that, because that's something completely different. The idea here is that we grind up, we have our corrective pullback, wherever that is. I think the least of it is 4,200. And we're still weakness in September, grinding up into, I don't know if that's September in here, but yeah, September 30th is your next low. And then you're looking for that target up there. So generally speaking, maintaining this path all the way up, and believe it or not, even higher into March. I would like to see in March some kind of like crazy move to like 52, 54, possibly 5,500 on the election. This is your doom and gloom for the election trade, but then you're actually going to long it. Then the vol kicks off on that election, and we go cranking up here. So something like that. So you're looking for a dip to buy this year, okay? So you are looking for that moment wherever that is. You have the SPX, right? Then the failure. Come back down here, get underneath here, find your low, and then you're moving on into the end of the year over here. Does that kind of gives you the idea here, right? Now, what you don't want to see is some kind of nonsense like this, right? Break down, get underneath, slam into that 3,800, and then get stopped down here. Rate cuts come into play. You get your early rate cuts, that kind of stuff. That's what the bond market's saying is going to happen, something like that. Now, the Fed chair has said that's not going to happen. So something like that for this year. Does that help you guys? Hope it does. Now, what does that mean for you as a trader or as an investor? More for investors. So, if you're a day trader, you're trading weeklies, you're trading even if you're a swing trader. I don't care if you're a bull or a bear, but if you're like a bull or a bear and you're in shorter time frames, that stuff doesn't matter to you. But if you're an investor, it does matter to you. It does matter if you're an investor to say, hey, where are my bottoms on the year that I'm looking for? And you need to be, if you're an investor, you are that guy. I would never be an investor saying, hey, I'm going to fucking buy tops and buy bottoms, and I'm going to buy every time I hear an investor say, I'm going to buy everything, I don't give a fuck. That's just, you're out of your fucking mind doing that. You're looking for, if you're an investor, or a year-long swing trader, quarterly swing trader, You're looking for your quarterly lows. You're going to be looking for a low in March or April. You're going to be looking for a low in the summertime. You're going to be looking for a major low again in September. So you're looking for those places to add or build a position into the end of the year. $5,200 where we roam. Would love to see like 49.5, then a drop to 44 before end of Q quarter. I don't know. I personally, I'm a bull, so I want it as low as possible. I'll be honest with you. Whatever that yearly low is, I personally would love to trade like 42 to 5,000 or 52. If we get 4,200, 4,100 and fucking run it up fucking 900 points, just fucking major bull run, I would love. Do I think that's going to happen? Not guaranteed, but I would love for it to happen. So if we can get down there, get that, whatever that low is, 44, 43, 42, 41, I'll take any of it. But I would fucking love to buy that fucking dip. Would love to. There's that weakness here that we had earlier, and SPU's trying to sell it down on you, panic you, manipulation right now, doom and gloom. Yeah, saucy. Oh, what, I got text messages, or do I got? Oh, he had Joe had a sell trigger. Now, remember what I said to you earlier? If we have that capitulation down here, that quick liquidation break, right? You're actually looking to build a position from here and from right here. You start the position on the half-hour trigger, and you add to your position down here on the hourly trigger so you don't get left behind. Yeah, where we roam, I'm not really concerned with the price of where that low is either. I'm with you, man. I really don't care where it is. I just want to know that we can buy that. I'm hoping that when we're down there, we're not getting a rate cut. The Fed is, maybe we're selling into it with the Fed, or people scaring investors, right? Investors are getting scared. Everyone's drinking the Kool-Aid, right? Well, the Fed's going to definitely cut at that rate decision meeting, and then of course the Fed comes out and they don't cut, and then you'd see a huge squeeze in the market. So I don't really care where the price is down below. I don't know what I think I charted it. I put it on Twitter. It's on there, but I was looking for a low of 4,200. Now, can we go down to 38 or 39? Sure. You're not getting your 35 or 3,600 unless they cut rates. That ain't fucking happening in my book. So, or at least from my perspective historically. And I looked at the pullbacks. I think that 20% was at that 38 or 3,900. I think the 30% was down to that 35 or 36. I could be wrong. Maybe the 3,800 was the 30% pullback. I don't see any 30% pullbacks, brother, unless we have a rate increase. I gotta go. I gotta answer a call.
Seven 737 MAX 9s, when they return to service, remains unclear. Will it happen this week? Is it going to be a little bit longer? And part of the reason for this is that loose parts at both Alaska and United were found on those grounded planes. How many? The extent of those loose parts when they were looking inside the fuselage remains to be determined in terms of how much we learn about those. Meanwhile, out in Renton, Washington at the 737 MAX plant, there will be an employee safety town hall that will be taking place in a couple of hours. That will be led by Boeing CEO Dave Calhoun. We know what his message is going to be. There has to be a better performance by the company, especially when it comes to quality control. You cannot have planes, certainly can't have planes with parts falling off, but you can't have planes where people or airlines are reporting that there were loose parts. And so that's going to be the focus of it. Real quick, take a look at shares of Boeing. You talked about deliveries and orders. We got the December numbers, and they were strong, Kelly. In fact, in December, the company logged orders for more than 300 aircraft, one of the best months the company has ever had. 369 planes were ordered with 1,114 ordered in 2023. Strong year, not just for Boeing, Kelly, but also for Airbus in terms of the airlines placing orders for future aircraft.
Phil, while all of our attention is focused on Boeing, and deservedly so, JetBlue's CEO just resigned. The company's having its worst day in over a year in what seems to be a pretty sudden change, although they're in the middle of this battle with the DOJ over the Spirit acquisition. And then this morning, B of A downgraded the stock to underperform, slashed its price target in half to $3. They're also expecting capacity to be down this year. What do you make of all this?
You got a lot of headwinds against JetBlue right now and a lot of uncertainty for the new CEO, Joanna Garrity. The sell-off is not because Joanna Garrity was named CEO, and she'll take over on February 12th. She is highly respected, highly regarded within the airline industry, and it has long been assumed that when Robin Hayes, the current CEO who will be leaving, when he would leave, Joanna Garrity would get the job. That has long been the assumption. Robin Hayes announcing yesterday, because of the stress and the toll that the job has taken on him, he is going to tend to his health, and then he's going to retire. And so you look at those two pieces of news, and you look at the fact that we don't know if the JetBlue Spirit acquisition will get approved by a judge. The judge could rule in favor of the DOJ, which would send JetBlue back to the drawing board and saying, okay, if we're not hooking up with Spirit in terms of growing our network, growing our capacity, what do we do? It would be a tough spot for Joanna Garrity.
And it's also fascinating to me, Phil, that the argument is basically by the government, if you approve this, it'll be bad for consumers. And if they don't, JetBlue is going to be lucky to be a $3 stock, basically. It's just a strange conundrum for investors.
Well, you know what the DOJ would say. They don't care about a stock price. They care about competition.
Right.
That would be their argument here. And in terms of investors, look, if this were rejected, do I think it's a positive for the stock? No, I don't think it's a positive for the stock. On the other hand, there is some clarity, and JetBlue could say, okay, we know that this isn't going to happen. How do we grow the airline from here?
True. And either way, his successor will have their work cut out. Phil, thanks so much. We appreciate it. Our Phil LeBeau. Let's get to Tyler Matheson now for the CNBC News Update. Tyler?
Kelly, thank you very much. Ray Epps, a January 6th rioter who was targeted by conspiracy theorists for being a government plant, was sentenced to a year of probation today. Before his sentencing, Epps expressed regret for believing the lies that the election was stolen. He pleaded guilty in September to a misdemeanor charge for joining the January 6th mob attack, and prosecutors argued that Epps had encouraged the mob to storm the Capitol and recommended time behind bars. He has been in hiding due to death threats from accusations that he was an operative planted by the government. The NFL is offering buyouts to more than 200 employees at its headquarters in New York City. Employees across multiple departments were emailed a voluntary buyout package on Monday and have until late February to accept it. Last March, the league laid off about 5% of its workforce. And a coroner has confirmed Irish singer Sinead O'Connor's death came from natural causes. They did not provide additional details, however. London police had said the singer's death was not suspicious when she was found unresponsive last year. Kelly, back to you.
All right, Tyler, thank you, and I'll see you soon. Coming up, one longtime hedge fund watcher says this will be the year in a surge of activist investing. And as for that high-profile proxy battle over at Disney, he says the tide may be turning in Bob Iger's favor. We will tell you why later in the show with Disney around $90 a share. The exchange is back after this.
C.
Welcome back to The Exchange. They call it the Consumer Electronics Show for a reason. It's not just phones and cars being unveiled at CES this year. Hair dryers and shower heads are also making an appearance, thanks to the likes of L'Oreal, which just announced a slew of beauty tech products. And the company's shares are up more than 20% over the past year as the beauty category remains strong. Joining us now to discuss is L'Oreal CEO Nicholas Hieronymus. Nicholas, welcome.
Hello, Kelly. Very nice being with you.
Without making this too personal, we're curious what exactly you had to unveil. This is a water pressure shower head, we understand, and an infrared hair dryer, and what else?
Well, we've been here at the CES presenting products for almost 10 years now with many awards, and today we unveiled a few innovations. The newest one, the one that was not known to anybody, is Airline Pro. It's indeed a revolutionary hair dryer that uses infrared lights instead of heating rods that allows to dry hair faster, 30% faster, without damaging the hair, 30% more moisture, and of course, and that's very important to us, in a more sustainable way with 30% less energy. So that's really the one that's, I think, is the most groundbreaking innovation that we showcase today, amongst many others.
Can I ask about that? Because that is very interesting, and obviously, people don't want to burn their hair all the time. So who came up with the infrared technology? Was it researchers at your company? And do you think that we will all quickly, in a few years' time, be using this kind of technology to dry our hair?
Well, actually, this invention was created by the startup that we met last year at CES. It's called Zuvi. It's a Chinese startup, and they came up with the technology, but their hair dryer was not at the level of that we need for professional stylists and for consumers. And that's why partnering with us, with our deep knowledge of hair, our science of the hair fiber, allowed us together to create what I think is the best hair dryer in the world today.
That's really interesting. So it wasn't an acquisition. It's still, this is a collab, as they say, L'Oreal Professionnel x Zuvi. Want to skip ahead over here as well. You have a color reader. Tell us about that.
Well, what's fascinating with beauty is that beauty is an innovation-led market, and there's many products out there, and it's very difficult both for consumers and sometimes even for professionals like stylists to find the right recipe that will match a given consumer's needs. And the hair reader allows you to really identify the natural color of your hair, even if it's colored, so what's underneath, the state of your fiber, of your scalp, whether you have dandruffs and everything, and then it allows a professional to give you the right prescription of products and, if necessary, to choose the right recipe of hair color to make you look beautiful. So it's really enhancing and augmenting both the professional and the consumer and the capacity to choose and to be more satisfied.
Yeah, and I would love to try. You have a color sonic that's kind of looks like it could help you self-apply hair color.
Yeah.
That sounds really interesting. How many of these products, Nicholas, though, are marketing exercises and publicity for the company that never become mainstream mass market products? Or do they? I don't know if you can give us some examples from history.
Well, when we present something at the CES, of course, it's always like a concept car. It's in early stages of development, but we have always the firm intention to bring it to market. I will give you an example of a device that's called Perso that was showcased a couple of years ago at CES, which is a little machine that allows you to create every day your personalized lipstick at home with cartridges, and it allows you to choose a color that matches your dress or have the same look as a celebrity you saw on TV, and the machine creates every day a different recipe. This has been presented at CES. It's now sold on the market. Lots of sales actually in China, where they love this type of products. And there are many like this. The Hapta by Lancôme, which is a device that allows people with hand mobility issues to apply makeup, has been presented last year, and will be on the market probably at the end of this year. So in most cases, well, I'm not aware of any that we haven't launched.
Well, it's not only very cool, it makes me want to try a few things out. Do you think you should be valued like NVIDIA if you're such a tech-first kind of company?
Well, we know we should be valued for what we are, which is the #1 beauty company in the world. And I think it's a very important claim because beauty is a market that's been growing almost for 100,000 years. It's essential to humanity. It's innovation-driven. And we are an innovation company. We innovated for decades and centuries in chemistry and hair biology or skin biology, and now we're partnering with the best tech inventors. So we're a bit of everything. We're a beauty company, we're a luxury company, we're a dermatological company, and we are a tech company. That's why we claim to be the leading beauty tech company in the world.
You know, if this is journalistically sound, I'd say send us a few things. We'll see if we can get things to match, you know, lip color and hair color, and we can do all sorts of things, maybe, you know, if we get permission.
Well,
Nicholas, thanks so much. Congratulations, and we look forward to learning more. We appreciate it today.
Thank you very much.
Nicholas
Have a great day.
Hieronymus with L'Oreal. Coming up, stocks unable to hold on to yesterday's rally, down almost across the board today. Nasdaq's up 4 points. The Dow is still the underperformer, down 0.5%. Yields also are something to keep an eye on. The 10-year above 4%, and decidedly so after that 3-year note auction went over a little bit soft. We'll get a check on more of the biggest movers, I should say, next. Don't go anywhere. Here. Welcome back to the exchange. Dow is down 310 at the lows. We're down 176 right now, with the S&P down 6 and the Nasdaq up 16. Juniper Networks is leading the S&P, hitting a new 52-week high on those reports that HPE is in advanced talks to buy it for about $13 billion. Deal could be announced as soon as this week, obviously already in the shares. HPE down 7, almost 8% on the news, and that makes it the worst performer in the S&P 500 today. Coming up, shares of Match Group are popping on news. Elliott Management has taken a $1 billion stake, although they're off the highs, up less than 3% right now, and down more than 11% over the past year. What Elliott could be seeking and whether they can get it, that's next on the exchange.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month. And save
Look at that nice dip buy down there. Look at that nice little capitulation we talked about. The dip gets bought, and we're right back up again. And they did it right on the half-hour trigger. Now you should expect from this point to get up here and start that fucking consolidation for that big old push to the upside. This is a big move here. This is showing you two things. This is showing you that your stops got triggered, right? They're now buying and forcing you to be a chaser up here. You're now a skinny or a chubby chaser, whatever you want to call it. And now you're going to be chasing price to the upside. Woohoo! Start chasing, boys and girls. Bunch of husky jeans chasers. You guys like those mom jeans, don't you?
Welcome back. Shares of Tinder owner Match Group are up around 3% today. This comes after the Wall Street Journal reported a roughly $1 billion stake taken by activist investor Elliott. And our next guest says this is only the beginning of a huge year for activists. Joining us now is Ken Squire. He's founder and president of 13D Monitor and a CNBC contributor. You want to offer any specific thoughts about what they might want to do with the dating service first, Ken? Welcome.
Yeah, sure. Hey, Kelly, thanks for having me. This is a company that's a far and away leader in online dating apps, as I'm told, and they lead the market. But they've had 4 CEOs in the last 6 years. Tinder, the biggest part of that business, has had 6 CEOs in 8 years. The median CEO tenure is just about a year. So it's hard to implement a long-term strategic plan with the new CEO every year. I think Elliott is going to probably look like they did at Pinterest to get on the board to help monetize some of the assets here, fix margins, maybe help with the growth. And at Pinterest, they returned over 100% in a year and a half since being on the board. So
Amazing. Do you attribute that success to them?
Well, no. Listen, the success goes to the board and management team in every situation.
Right, but I mean, was that really a key catalyst of theirs to figure out monetization with a declining user base, or did they just time it well?
I think it was a little bit of both. 100% is a big number, but the activists can often be the catalyst to motivate management, to motivate the board, to keep people accountable, and I think they did that. But at the end of the day, the credit goes to the management and the full board.
So you think this isn't just about Match or Pinterest, but really we could see a lot more activist activity this year. Where and why?
Activism. For the last 5 years, as you know, the market has really rewarded growth over profitability. And you've had a lot of management teams that are very good at growing companies. Now that script is flipping and people are starting to focus more on profitability. And there's a lot of CEOs and management teams that need to learn new skills. and that this is an opportunity for activists to come in who are more value profit investors than growth investors to either replace management or help them with profitability and margins.
And last year you saw, so let's go over the kind of bigger trend here. What has been happening with activists over the last couple of years? And other than some big examples like Disney, where else should we watch for potentially some big moves?
Well, so last year, activism, the number of activist situations in the U.S. were down, but money going.
If you miss that dip buy down here, right, you might get one more. It's possible. It's possible you could see. You got that half-hour trigger, and then it rolls down one more, and that's the actual dip buy. You get something like that going on, right? 1, 2, and then bam. Or even 3, and then bam. So you might get one more chance at it. I'm not guaranteeing it because of where we are, but you might get one more down there. So if you do, you might get one more chance to buy another weekly for Friday or for Thursday close probably. Hey, Scott, this is for you. My favorite backtesting website is TradeWell. Now, it's completely free, and I got to also say that who turned me on to it was Jedi Marcus. I love that site, so TradeWell if you want to backtest your trades. You guys got it. You guys got it.
Argue that maybe M&A is dead. I would argue we may be in the infancy of an M&A cycle because this other side of the seesaw is so remarkably cheap.
Rich Bernstein, always good to see you. Happy New Year. Glad you're with us. See you a lot this year, I hope. Thank you.
Great to see you. Thanks.
You too, my friend.
Now to shares of Boeing, which are slightly lower as the company investigates the issue, which caused a door plug to blow out mid-flight on a 737 MAX 9. Let's bring in Phil LeBeau now for more on those reported loose bolts showing up at other airlines, Phil.
We don't know how many loose bolts were found between Alaska and United, and the terminology has been a little bit different between the two airlines. When we get a better sense of that, we may have a better sense of what the FAA is going to do. That's one of the developments that we're going to be watching for today. First of all, the FAA has yet to weigh in on final inspections for the grounded 737 MAX 9s. Once that happens, then Alaska and United will be able to do those inspections. But they're in a waiting mode right now. And the inspections, they're not going to be 4 to 8 hours. I was talking with one person familiar with the process who said, look, this could be 10, 11, 12 hours. So it's going to take a little bit longer. And again, the loose parts were found both at Alaska and at American. Meanwhile, in Renton, Washington, in 1 hour, at the plant where they build the 737 MAX, they will be holding an employee town hall. This will be led by Boeing leaders. They're going to be talking with their employees, basically reiterating safety culture, a culture of accountability, quality control, all of the things that we have heard from Dave Calhoun and his top executives for some time. But clearly, that needs to be driven home once again. Whether or not new initiatives are announced, that remains to be seen. And as you take a look at shares of Boeing, all of this comes on a day when they actually improved their monthly deliveries. In December, they delivered 67 planes. That's an improvement compared to November, and the fourth quarter year over year was better. Deliveries for all of 2023, 528 planes. Their delivery targets for all of 2023, they hit them. And that's important because there was some speculation a few weeks ago that they might fall short of their delivery target for 737 MAXs, but they hit those as well as the targets in terms of their guidance for the Dreamliner as well. Guys,
a couple of quick questions. The loose parts that are referred to, were those all loose parts associated with that false door or whatever it is? I heard somebody call it a door plug. Others say it's not really a plug. But were all the loose parts associated with that, or were they found elsewhere in the planes?
No, they're associated with that. And what happened is both Alaska and United were pulling off the panels, getting prepared for what they expect in terms of the inspection process from the FAA. Remember, yesterday the FAA said, this is the process, we've signed off on it. You're not quite ready to go, but this is going to be the process. Now there's been some back and forth between the FAA and Boeing. So both Alaska and United, they're getting their planes ready. Look, they want to put them back into service as quickly as possible, so they were getting them ready for this inspection process. That's when they found the loose parts.
Which leads me to question number 2. Before the loose parts news broke yesterday afternoon, I believe you said that it wouldn't be shocking to see some of these planes going back into service maybe within the week. Do you still feel that way?
Sure.
Really?
I don't know if I feel that way. You know, basically, I'm telling you what I'm hearing back from people within the FAA as well as within the airlines. I think there is a bit more caution now. Anytime you have these planes coming out in these reports of loose parts, that's going to make everybody step back a little bit. And look, the pressure is on the FAA in all of this, Tyler. You don't want to say, okay, do this process, put them back up in the air, and then there's an incident. You want to be as judicious as possible. And I think the loose parts, that revelation coming out, has probably made regulators and Boeing as well say, okay, are we absolutely sure this is the process?
Yeah, that's right. And I'm sure the airlines, too. I mean, they have a shared interest in making sure that the planes they're flying are absolutely as safe as they can possibly be. Phil LeBeau, thanks for following this for us. We appreciate it.
You bet.
All right, we're going to do a 3-stock lunch here in the top half of the program today because of the airline news. Here with our trades is Adil Zaman. He's a partner with Wall Street Alliance Group. First up, Adil, welcome. We're glad to have you with us.
Great to be with you.
Fantastic. Let's talk about Boeing. The company, of course, still dealing with those 737-9 MAX jets. The shares are flat today, down about 10% on the week. The trade here, Adil.
So for us, this would be a sell because, you know, this is a company, every time it seems like they've got things back on track, another major catastrophe like this happens and it derails stuff, right? So they just finished a very strong year with increased plane deliveries, and now investors have to deal with this type of a catastrophe again. We just feel that from an investment point of view, there are so many other opportunities available out there that we would simply stay clear of Boeing. So for us, it would be a sell.
Okay, let's move on to JetBlue then, because that's a whole other story today. The CEO has announced his plans to step down in February. They're waiting on the judge's ruling on that merger with Spirit, of course. They got a downgrade this morning saying shares could go to $3. They're just over $5 right now. What would you do?
I would sell, Kelly, because, you know, I sympathize with the CEO, and it was a very tough job. You know, like when you are in the airline industry, it's razor thin margins. It's survival of the fittest, right? And you need to have a certain amount of scale in order to do well in that business. And JetBlue simply did not have that scale, right? And also, they're very domestically focused. So they're not really benefiting from the increase in international travel like some of the other larger airlines are benefiting from. And because they don't have a brand loyal customer, they are unable to pass along the higher cost in fuel and labor in terms of higher prices to their customers. So we would say that this is, again, you know, this would be a sell.
Well, speaking of a stock, a company that does benefit from the strength of international travel, that would be Delta Airlines, close now to placing a huge wide-body order with Airbus. Those shares up about 1% today. Adil, your trade on Delta, I think we've got one here that isn't United and isn't Alaska, which may be one of the strongest things going for it.
Yeah, I agree with you. I think that this is, so the reason why we like Delta is for the exact opposite reasons that we don't like JetBlue, right? So Delta has the scale, right? It's the largest player in that industry. They have a very niche market focus. So they've figured out they're going to cater to the higher income earners. So this gives them the ability to charge a premium pricing, which their customers are willing to pay for the luxury. It also gives them the ability to be able to pass on the higher cost because their customers tend to be more brand loyal. And in terms of international travel, they've benefited tremendously from it, especially traveling from America to Europe. We, as a family, took 2 vacations last year to Europe, and the airports were jam-packed. And Delta is benefiting from this trend.
So are you saying, I'm curious on this, if I were to take a flight from New York to Rome on Delta, if they go there, Delta would have a higher price than if I were to do that same flight on another American airline?
So we feel that, you know, Delta, when we were looking for flights, we felt that Delta was very expensive. And a lot of times, you know, customers are willing to pay for the luxury because their customers do tend to be the higher income earners. So yes, a lot of times the prices would be higher. They also have the largest frequent flyer program of the US-based network carriers, which is also a very high margin business for the company. So they have different sources of revenue. And that's why we are constructive on this one. This one would be our favorite in that space.
That's interesting because Delta certainly does have the reputation of being able to avoid some of the operational difficulties that have affected other airlines. Adil, thank you very much. We'll have you back. Thank you.
Thank you.
And coming up on Power Lunch, rise in Shein. A new report from CNBC.com shows revenue for the Chinese online retailer is a lot more than anyone expected. Could be good news for the IPO. We'll get you the details. Plus, consolidation ramping up in the pharma space. Of the 10 largest biotech deals from last year, 6 came in the fourth quarter. And according to EY, the top 25 companies in the space have more than $1 trillion in cash to make deals this year. $1 trillion. We'll discuss where the next big merger could come from when Power Lunch returns. Welcome back to Power Lunch. Fast fashion giant Shein's highly anticipated IPO is expected to take place at some point this year, but little is known about how much revenue the retailer brings in right now. CNBC reports Shein sales could actually be a lot more than $30 billion annually. That's according to a key partner. For more, let's bring in the reporter behind the story, our friend, CNBC.com retail reporter Gabrielle Fonrouge. Also joining us is Fashion Launchpad founder and CNBC contributor Sandra Campos for some perspective here. Welcome to both of you. Gabrielle, we'll start with you. What have you learned?
So there's very little known about how much Shein makes, how profitable they are. I mean, they're a private company. They don't actually have to disclose anything. You know, what we know from some reports that came out is that they did $23 billion in revenue in 2022, and they set out to raise that number by 40%. So now the market kind of thinks that they're making about $30 billion a year. And what we heard yesterday at the ICR conference in Orlando from one of Shein's key partners from Authentic Brands Group, who they partnered with last year, that number is actually a lot more than $30 billion. Of course, he didn't disclose how much that number is, but you know, Authentic Brands is in a position to know. Last year, they started a partnership with Shein where they started selling a co-branded clothing line with Forever 21, which Authentic owns. So they had to open their books, and these people know how much they're making, and it seems to be a lot more than everyone thinks.
And if that's the case, Sandra, we're putting them in terms of their heft and their size in the retail world on par with the likes of Zara and H&M. Is that right?
Even more so, even greater than that. So right now it's estimated that they actually have about 20% of the fast fashion, the global fast fashion market share. That's pretty substantial, being that they were projected to just be selling about $4 billion in 2019. So they've had exponential growth since the pandemic.
What is, Sandra, what explains their success?
There's a few things. Number one, they use teen influencers and user-generated content, which are the teen consumers themselves. So it's not just Gen Z, but they were definitely the ones. If you look at just TikTok and how many people are talking about Shein hauls, it's almost 15 billion views on Shein hauls. And that's just coming from the holiday time period. So that's one. The second thing is that they've really figured out the supply chain. They have an agile supply chain that is not really focused on what's happening on the runway and waiting for trend research. They're really focusing on having a lot of designers that are outsourced. And those designers are constantly pumping up a lot of product, about 1.5 million styles in an annual basis. And that's about 37 times more than Zara and 65 times more than H&M.
That said, Gabrielle, there was some focus recently, I think in the Wall Street Journal, about how it's not as lucrative for the suppliers as it is for the parent company. At what point do you think suppliers might push back?
So this is a big issue right now for Shein. And in order for them to remain competitive and to be able to continue with this crazy growth that they've posted, is they need to keep those suppliers loyal, because that's really their secret weapon. It's called like the ultra fast fashion manufacturer and supplier. These aren't the typical fast fashion suppliers. These are manufacturers that are able to turn around styles within days, if not just a week or two. And that's also a fresh design as well. So Shein is able to identify designs that are getting popular on TikTok, online. They send those designs over to the manufacturers and they turn it around really quickly. But there's a lot of competition for those suppliers as well. You've got Temu, which is what Shein doesn't consider it a competitor, but many others do. Temu is competing for those very same suppliers. And Temu actually recently sued Shein in federal court here in the US, accusing them of mafia-style tactics, accusing them of signing loyalty oaths and things like that, requiring these suppliers to pledge their loyalty to Shein and, you know, pledge that they're not going to work with any other competitors. So, you know, but if Temu is willing to offer a higher price, if some other newer entrants to the market are willing to offer a higher price, then, you know, Shein is they might lose some of those suppliers, some of that loyalty. So that's going to be a really big focus for them. And what kind of impact is that going to have on their margins?
Sandra,
you know, there's so much we don't know about this company.
Sandra, what about the quality of these garments? Is it not just fast fashion, but disposable fashion? How good is it? How disposable is it? And does that disposability then cause there to be criticisms on environmental grounds?
Well, absolutely. Well, they have a cohort of young shoppers that want immediate satisfaction, regardless of the environmental impact. And I think because of the fact that the price points are so low, you can get a dress for $8, a t-shirt for $4. it really already holds the bar at a very low quality standard. You're not expecting a lot when you're paying $4 for a sweatshirt. So that's definitely one thing. The other part is they're definitely having some challenges as it relates to, copyright infringement, some potential labor issues, obviously sustainability as they're filling much more in terms of landfills. We're getting a lot more of the landfill conversation going on around Shein, but the customers are still shopping.
If the items, Sandra, I'll ask you, and then Gabrielle, maybe you can jump in. If the items are that cheap, $8 for a dress, $4 for a sweatshirt, the shipping must cost more than the garments. Sandra?
You'd be surprised that there's actually lower shipping rates from China directly to consumer, and they're shipping it direct to consumer from their DCs in China, and they have 3 DCs in the US as well now. So even, within the States, they're able to ship it and still make margins. So they're optimizing their supply chain from a fabric standpoint, where 65% of a garment's cost comes out of the textiles. They're actually able to optimize that across all of their suppliers. So they're able to get, much better margins that way.
Gabby?
Yeah, and Tyler, what I'll add to that is that, we've all heard about the de minimis exemption, right? So, items that are being shipped overseas that are less than $800 aren't charged import duties. And of course, legislators will say that that's why Shein is able to offer such a low price, because many of their packages are under $800. They are being shipped directly from their manufacturers. Shein, of course, denies this and said it's their supply chain that's allowing them to offer this great price. But there's also a misconception here about quality. I've spent the last couple of months reporting on Shein. We've talked about this before, but I've also been talking to Shein's customers. And these aren't people that are coming in and trying out a $4 dress or a $4 shirt once or twice. They're buying maybe a $10 dress, a $10 shirt, and they're coming back because they're telling me over and over again that the quality is surprisingly good. Price does not define quality. And because of Shein's supply chain, the way that they're able to do things, I am surprised to hear it, but these customers are telling me that they're over and over again surprised at the quality, and that's what's keeping them coming back, which is so important, because you're not just getting these customers once, you're getting them 2 times, 3 times, 4 times, and then that's not even talking about the algorithms and all the ways that they bring those shoppers in, even when they're not looking to shop.
All right, Gabrielle Fonrouge and Sandra Campos, thank you very much, both of you. We appreciate the discussion. And further ahead, Pittsburgh-based space technology firm Astrobotic's inaugural lunar mission, major malfunction shortly after launch, problems abounding. This would have been the first U.S. moon landing in more than 50 years. It ain't happening. We'll be right back.
LLC.
All right, welcome back to Power Lunch. So let's get a check on the bond market right now as yields are flat today. Seems like everyone is looking ahead to that big CPI report that will come out day after tomorrow. Rick Santelli in Chicago. Happy New Year, Rick.
Happy New Year, Tyler. Indeed, whether it's CPI or PPI the day afterwards, inflation data will be important. But between then and now, supply is the issue. We had a 3-year note auction today, $52 billion, and I'm looking at intraday of threes. You could clearly see at 1 Eastern we had that drop that established the low yield of the session. But it didn't last long, and as a matter of fact, if you look at the extremes on the yield curve, let's look at 1 month of a short maturity like a 2-year, and you can see on the right side how much it's been in a tight range. Matter of fact, every maturity today's range is inside yesterday's range. Now, if you go to the other extreme on the longer dated, look at a 30-year for 1 month, you can see its yields are a bit more to the upside. That's something to pay attention to. We see that 10-year note yields are on pace for the 4th consecutive close over 4%, and we see the 2-10 spread has been trading quite a bit in 2024 under 40 basis points, and we also see the spread with overseas boons starting to widen a bit as longer dated treasury yields seem to have a little bit more horsepower towards the upside. With regard to supply, 10-year tomorrow, 37 billion, followed by 21 billion 30s. Auctions are everything to the markets right now. We'll continue to monitor. Kelly, Tyler, back to you.
Thank you, Rick. Rick Santelli. To Courtney Reagan now for the CNBC News Update. Courtney.
I'm going to have to send it back to you guys right now.
No problem. Court will come back to you as soon as they tweak the audio. We appreciate it. Courtney Reagan standing by over there in headquarters. After the break, everyone talks about tech dominating the NASDAQ, but biotech also delivering some massive gains. Pretty massive. December marked the IBB's best month since the pandemic nadir in April 2020. More on what to expect from that sector ahead in Power Lunch.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Asset.com.
Welcome back to Power Lunch. I'm Courtney Reagan with your CNBC News Update. Let's try this again. Secretary of State Antony Blinken once again in Israel today, urging the country's leaders to avoid harming civilians as the Israel wages war with Hamas.
We want this war to end as soon as possible. There's been far too much loss of life, far too much suffering.
Blinken also made clear the U.S. will reject any proposals to settle Palestinians outside of Gaza. The first attempted moon landing mission in decades has officially been called off. Astrobotic says because of a propellant leak, there is no longer any chance of a lunar soft landing. The company says the spacecraft is expected to run out of propellant in about 40 hours. Much more on this in a few minutes with space reporter Michael Sheets. And fired CNN host Don Lemon is launching a new internet show on X, the platform formerly known as Twitter. X made the announcement today, saying Lemon will host 3 30-minute episodes each week covering politics, culture, sports, and entertainment. It comes after Tucker Carlson, who was pulled from Fox's air on the same day Lemon was fired, started his own program on X. Kelly, back over to you.
Yes, a raft of launches as they look to expand their media offerings. Courtney, thank you very much. Courtney Reagan.
Maybe soft landing for the economy, but not for that spacecraft. We'll talk more about that in a little bit. All right, deals, meantime, in the pharma space heating up to start the new year, continuing the trend that started late last month. Pfizer recently completed its acquisition of global biotech company Seagen in I hope I'm pronouncing that right, in a $43 billion deal. And Johnson & Johnson, I know I pronounced that right, Johnson & Johnson. Merck and Bristol-Myers Squibb also striking significant deals. Bristol-Myers CEO Chris Borner talked about the value of M&A at the J.P. Morgan Healthcare Conference yesterday with Jim Cramer.
It's an exciting time to be taking over Bristol-Myers Squibb. We are writing the next chapter of this company. We've got a lot of real strength here. We've got an incredible pipeline of recently launched or launching products. I don't think our pipeline has been richer than it's ever been. Never. And we've got real financial strength that has enabled us to go and actually bring innovation into the company from outside. And that's what we've done with these most recent deals.
All right, let's get some reaction from Evan Seigerman, biotech analyst at BMO. Welcome, Evan. We're glad to have you with us. What do you think these deals are signaling about the drug business broadly and the biotech drug business more specifically?
Well, it feels like a breath of fresh air here in San Francisco. The tone is noticeably lighter. Everyone seems to be happy. It really helps when you start off the J.P. Morgan Healthcare Conference with a few deals. As you said, there were also some deals announced last month. And of course, the big closing of the Pfizer-Seagen transaction, which everyone was closely watching. So it's really good for the sector because it's not just healthy for the big biopharma names, it's also healthy for the small biotech names that need funding. It shows investors that there's a path to an exit.
Why are these? I can see why the deals are sort of the tonic that the sector needed. But why are companies like Pfizer, Bristol-Myers, and J&J down so much over the past year? Pfizer down 39%. I suppose it has to do with sort of the decline of sales of COVID drugs and COVID vaccines. But what else could it be?
So there's a lot of nuances here because if you look at something like Lilly, it's up massively year over year. But something like Pfizer, they were transitioning away from COVID, trying to reset their revenue base, really kind of misaligned expectations between what management was saying and what investors thought. Now it's a reset. Seagen's coming in, a lot of revenue opportunity there. Bristol, same thing. LOEs after LOEs after LOEs. They need to replenish that revenue base. And some of their new launches weren't doing as well as the investors had hoped. So now they're bringing in new assets to hopefully to accelerate that.
And what about with Cytokinetics? So we had Novartis on with Jim earlier.
So we heard in the Wall Street Journal's reporting that Cytokinetics may be taken out by Novartis. I don't cover either one of those companies. But given the reports, that is signs of a healthy ecosystem. I know at the conference, Novartis was downplaying it, but that's probably just the game that they're playing right now. I could see something happen. Usually when the Wall Street Journal reports on it, it does end up happening. What,
Evan, would you say are the super cycles happening in the healthcare space right now that are driving these deals? Obviously, weight loss to the side. We're talking more about oncology. What else?
A lot in oncology, a lot in this subset of oncology, radio-oncology. You saw that deal that Bristol took out, RAYS. So these are kind of radiotherapeutics to treat cancers.
What does that mean, radio-oncology?
That's a very good question. It's basically taking a drug, adding a radioactive particle to it to target it right to the tumor to kind of destroy the tumor. High science, high manufacturing, a lot of interest there. I also want to add an inflammation. I believe that the CMO of Merck was talking about doing more deals in inflammation. We saw a lot last year. I cover a company called Morphic. They have an oral drug for IBD. Data coming next year could also be very interesting for a strategic.
Give me a thought on Eli Lilly and I guess Novartis. But first on Eli Lilly, is it the sort of irresistible force here in the space?
Well, Eli Lilly is still our top pick in big pharma. We do like Lilly. We think that Zepbound is going to have a fantastic launch this year. Remember, this is their drug for obesity that was recently approved in November. They're off to the races there. We think that there's a lot of enthusiasm around it, so we're really focused on that. I don't cover Novartis, but we could see some more deals there, especially with the reports in the Wall Street Journal with Cytokinetics and Novartis.
All right, Evan, thank you very much. We appreciate your candor and your ideas. Evan Siegerman, appreciate it.
Thank you. Have a good one. Bye now.
Yeah, you too, sir. BlackRock announcing hundreds of job cuts. Let's go to Leslie Picker for some details. Hi, Leslie.
Hey, Tyler. Yeah, this is according to a memo that was sent by Larry Fink, who is the CEO of BlackRock, as well as Rob Capito, the president of BlackRock, sent around the firm discussing, quote, as we prepare for 2024 and this very exciting but distinctly different landscape, businesses across the firm have developed plans to reallocate resources. These changes will result in about 3% of our colleagues leaving BlackRock. That amounts to about 600 people based on the number of employees that have been disclosed in public filings. In terms of kind of qualifiers as to why they're doing this, they talk in the memo about the industry changing faster than at any time since the founding of BlackRock. That's thanks to the work of their iShares teams, ETFs becoming more ubiquitous as what they describe to be the preferred vehicle for delivering both index and active investment strategies. They talk about growth coming from a wider range of markets around the world, Europe, Middle East, India, and other markets in Asia. And then this is something that people have been paying close attention to. Perhaps most profound new technologies are poised to transform the industry and every other industry. A lot of people have been focused on BlackRock as we see the events unfold with regard to the potential spot Bitcoin ETF. Obviously, BlackRock potentially a key player there. I'm told in speaking with a person familiar with the matter that the cuts aren't focused on a particular team. They were broad-based in nature, so there's been a lot out there about the potential for, pulling back an ESG. I'm told that's not the case here, that it was actually, they're going to be very broad-based in nature. But once again, the news today that BlackRock is laying off or plans to see a 3% reduction in its workforce, representing about 600 jobs. You can see shares there down about 0.5 percentage point at this time, guys.
Leslie, thank you very much. We appreciate it. Leslie Picker. Coming up, more eyes on AI. Microsoft's investment in OpenAI is staring down major antitrust scrutiny in, yes, the European Union. Could the impact be felt across the pond back here at home? We'll discuss the potential fallout when Power Lunch returns.
ABC and Peacock.
Microsoft's multi-billion-dollar investment in OpenAI could now be the subject of a merger probe in the European Union. Deirdre Bosa has more on that for today's Tech Check. Deirdre?
Hey, Kelly. It's only the second week of 2024, and already the antitrust headlines and developments, they have been rolling in. The latest EU regulators are looking into deals made between tech giants and generative AI startups. Actually called out Microsoft's investment into OpenAI. As part of the Commission statement, EU antitrust chief Marguerite Vestager is quoted, "Virtual worlds and generative AI are rapidly developing. It is fundamental that these new markets stay competitive, and nothing stands in the way of businesses growing and providing the best and most innovative products to consumers." Now, she also happens to be coming to the Bay Area this week to meet with our biggest tech companies and CEOs, including Tim Cook, Sundar Pichai. Now, typically investors, they don't react to antitrust headlines because where the EU has won battles, it usually results in fines rather than major changes in business practices. But there are signs that that may be changing. Apple, for example, has offered to let rivals use its tap-and-go mobile payment system in the face of an EU investigation. And the idea itself, Kelly, that Europe and Washington regulators are taking a harder look at AI deals, that could suggest more aggressive, more nimble enforcers that could actually have a chance of winning a few battles this year. It's been a very tough slog over the last few years, but a number of them are coming up this year. And even if they don't win concessions, the information that is coming out of these lawsuits is important and could hurt them down the road.
And in what ways do you think splashes, or kind of directly affects what they're doing here at home?
Yeah, so the European regulators, well, I mean, our enforcers with Lena Khan and Jonathan Cantor over the DOJ have just become more aggressive, and you have to wonder if that's a response to how effective or aggressive the European regulators have been. But even an example, in the Google lawsuit, we found out that Google pays Apple some $18–19 billion to be the default search engine on the iPhone. And that's just a huge number that its rivals and smaller companies can go after. So even if this information is unveiled here or across the Atlantic, it can help enforcers in either places. And 2024 could potentially be the year where we see some of that start to affect the businesses.
I'm curious, the history of antitrust is that these cases often move slower than the traffic that's over your right shoulder there. Is there a possibility? I mean, if I'm Google or I'm Apple, I might want to slow walk these cases under the thinking that maybe there will be a change in administrations in November or a year from now.
Tyler, you could have used any example. They move so slow, and even if you do get anywhere, the appeals process can take years and years. But that's sort of my point, is that even if you don't get sort of any certainty with these cases or any concessions that are won, the information that is revealed through them can be damaging, and they can also amount to a distraction, right? I think back in the 90s when Microsoft was under antitrust scrutiny, it wasn't sort of this one moment where it changed their business practices, but it led to sort of a decade of underperformance because of what those cases did to the company. So you could imagine a similar scenario. I'm not sure, but it's a possibility that investors could consider.
Deirdre, thank you very much. Deirdre Bosa. And still ahead, not quite to the moon and back, Astrobotic's first try at a lunar landing falling short after a technical malfunction. No soft landing there. We will get the key details on exactly what happened when Power Lunch returns.
Did I miss something? Hold on, am I missing something here? What hot mic? I don't think my mic was off. Missing something. I don't know what's going on. I was trying to read through the I think that's the what do I have on here is I got CNBC on, and I've got something on. The barking might have been Financial Juice had something wonky going on, maybe. Yeah, I don't know what that is. That's not my dog. Did you hear moaning and stuff? No, mic was off. I just turned it on. Yeah, I think it could have been a commercial or something. I didn't hear it was said. I heard barking on my headphone. My headphones are on the table here. Hold on. I wonder if my phone was beeping or something. Oh, that was okay, I got it. So I saw a post from I got it now. I saw a post from Wifey, and he posted a hunter trying to shoot bears, and there was a dog with the hunter. I just reposted it on Twitter, so I think I played it so I could listen to the sound. I got it. Hold on, I'll show you guys. Hold on. Maybe this is it right here. Hold on a second here. I'm gonna put my headphones on. I reposted a post from Wifey. Here, I'll get the link to it. Tell me if this is the sound you heard. Is that it? Is that what you heard? I guess that does sound kind of fucked up, doesn't it? I got it. All right. So I'll leave you guys a link to the post. I guess that does sound really bad, doesn't it? Yes, as a matter of fact, I was having bear sex. There's a link to it right there. I just posted it. I reposted it on my feed earlier. I'm like, what are they saying I'm doing there? I don't understand. What am I doing? I'm glad I addressed that. You guys would have probably been like, dude, you should have heard Cap, man. He was getting hammered by a bear in the office. It was an important meeting. So we're just waiting here, right? We have the nice little dip back here. Chance to buy. Boom, you get the chance to buy. Looks like they're trying to give you another chance. We talked earlier about a couple things here, right? We talked about you get your first dip, that you might get another dip down here, possibly even a third dip. You can see it before it lines up, right? It's not quite there yet. Right, you get that dip down. You blast down there, and then that's your actual dip buy. So just be aware of that. If you're a bull, you want to be seeing, well, I mean, you should be buying dips, of course, on the hourly trigger. But at the same time, just have awareness of this drop to the downside that's possible. Also be aware that I never like seeing, I never like to see us, let's see if I can go down to this. You guys are hilarious. So, okay, so this is SPX down here on this chart right here. This is SPX, right? So this is all SPX in here. I want you to just briefly look at something. You know, bulls are trying to build a base camp here, right? This 4760 is where bulls are trying to build a base camp here. So just following along on what I just showed you above, the hourly trigger and gamma flip is down on 40. 47.30 down here. So just keep your eyes on, maybe I'll bring you over there right now, okay? So I'm telling you to watch out for a capitulation move down with a real dip buy, right? So let's just take a quick peek here. This is the gamma picture for SPX on the right-hand side of your screen. If you want to take a snip of this, you can. It changes every day, but veritably for right now at this moment, this is where your gamma flip is, okay, right here. And if you were looking at SPY earlier, now I'm talking to you about, you see this trend right here, this zigzag trend that's being formed? You see it right there? You see these sellers coming in right here, sold, sold, sold. Now, I'm all for the bulls getting up here and doing their thing, but just keep an eye out, right? Here's your hourly trigger, though. This is at a 47.33 on SPX. So let's say they did try to sell you down here and rain it down on your ass. Boom, boom. That could have been your actual dip buy down here, okay? So just do a little snap of this at home. I'm not anti us going up here. I'm not saying don't buy the dip on SPX down here. Whenever we're down here, yes, do buy the dip. And I'm not saying we can't base camp this and make our move higher, okay? What I would say to you would be, what I would say to you is that's going to take time. You're going to need a 3-hour look back to get up there and start moving to the upside. It's not going to be easy. You guys already know that they're out here trying to sell on you, right? Right here. They're just showing you right here that are strong sellers right here. Now we have some strong buyers here. They step right back in. Stronger buyers right here. So we're going to try to come up here again and do the same thing. If they come in and they say, fuck you, we're stronger up here, then you know where real strength is, right? It's way down here, right? The real strength is down here in this gamma flip. And I'm going to tell you one last thing down here, okay? If you're a buyer and you're a bull, okay, that's what you are, right? This hourly trigger in this gamma flip is your bottom. It ain't any lower. So if we start selling this here, my point here to you is this. If you're a bull and you're like, oh, I love buying dips, Cap, I love making money with a bull, right? Then you should be buying this hourly trigger every time we encounter it, even if you put stops below, because I'm going to tell you something. The moment we break this hourly trigger and we start to reject it, there is no more dip buying. We're changing direction. We're heading lower. And fuck you, no, you can't buy a dip. You get my point? So from a thesis perspective, if our trend is up, right, you are buying these dips for those higher highs, right? Now, let's just take a quick look here at SPX and what I'm talking about, right? So you're buying the dips on the hourly trigger. We're heading higher. You have a reversal down here, but generally speaking, this is where your move is, where your money is, and all that kind of stuff. When we get underneath the hourly trigger, see how we get underneath the hourly trigger here, right? Underneath the hourly trigger, confirm we're going down right here. And once we're underneath that hourly trigger, we start to have some major downside moves, right? No buying dips in any of there. No buying dips in there until we make the turn, right? Remember last week for January 1st, we were talking about that over here, right? And I was saying to you, yeah, you got to wait, right? So I was like, remember on Tuesday, I was like, there's no buy for a bull. 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 Thursday, squeeze. Friday, hey, let's buy a fucking dip. We're going to have a trend change here coming up, right? Then we got the trend change this week. So if you're a bull, your thesis is that you are buying these hourly triggers. Buy the hourly trigger. Buy the hourly trigger, right? Buy the hourly trigger. Buy the hourly trigger. Buy the half-hour trigger, right? So if we do break below this and start getting underneath, you are no longer a buyer. You're now a fucking bear right in here. So if you're a bull, don't be trying to buy fucking dips up here. Always trying to be buying that hourly, that half hour, that hourly DCA. Buy the half hour DCA, the hourly. Okay. Never be buying these tops. Never be joining in the party up here. Talked about this yesterday, didn't we? We had a big conversation about buying these fucking tops, and I'm like, don't be buying these fucking tops. Buy these fucking bottoms always with stops underneath them, even if we roll. Okay, so even if we roll down, doesn't fucking matter. You're a buyer of these fucking bounces on the half hour and the hourly trigger. So as a bull, you're buying that shit, right? So I don't care about your double tops. I don't care about your triple tops. I don't care about your low new highs, all that stuff. Down here, when we're down here, you're buying this shit. And if you get stopped out, you get stopped out. You get stopped out. Oh, you took a little bit of a hole hurt here. starts to reverse and you're back in the game again, selling the market down here or waiting for the turn to go back to the upside, okay? But what you're not doing is buying these fucking things up here. You're not buying this shit because you're always a loser then, aren't you? You're always a goddamn loser up there. And there's no, like, hindsight trading here either. There's no 20/20 vision trading. Every fucking time we make a trend change to the upside or the down, and we confirm that move on retests of the hourly trigger, you're buying those dips or you're selling those rips if we're underneath every single time. So right now, you know where the gamma flip is. It's down here. You know we get all bared up below this. So until then, every time you see weakness, you're buying that shit and you're looking for these new upside targets. You also know that the gamma level at 47.60 is the big fucking fuck you to bulls. So the more time we spend here, the more we work on this, the more time we can look back in time, the better your chances are of us actually getting up and trading 4,800. All right. Hope that helps. So right here, where are we doing, right? What does this say right here? Here's your buy the fucking dip on the half-hour trigger. Here's your buy the fucking dip. This is where you add to your position, right? You're buying here, adding if you have to. If your thesis is wrong, what are you doing? Right? Let's say you buy this, boom, and then it come down here, you buy this, boom, and you get sent down, and you're all, fuck you, I'm so fucked. You're likely given a chance to get out from unfucking yourself here and turning into a bear to the downside. So your thesis right now as a bull is buy the fucking dip. Where? Hourly half-hour trigger. Where do you stop buying the dip on the hourly and a half-hour trigger? Once price breaks below. And when price does break below, you're likely given some kind of a chance to unfuck yourself. So the first smash down likely retraces. This actually shows the weakness in bulls, and then it goes down. That's your sign. Hey, I bought the dip. I did what I was supposed to do when I was supposed to do it. I followed my tools, right? And I'm looking for that upside move. Most of the time, you're going to win those trades. Most. 6, 7, 8 times, right? The one time that you lose, you recover and become a seller or sit on your hands as a bull until we make the turn down below. Jay Shade is like, make my eyes bleed right now. I agree with you, man. Definitely. Yeah, exactly, Sam. Ryan Morris. All right, there we go. I gotta get back. I gotta send this stuff out. I'm trying to write a bunch of stuff for for an offer really quick. I gotta go. So last thing here. If you want my expectations here, right? My expectations likely lie with SPX down here. So if you want to know what my expectations are, it's gonna be some kind of a bullshit down here. You're gonna get all panicky, and you're gonna come into the like power hour and shit. It's gonna blood down on you to the close or some shit, and you should have bought that dip right there. So I'm looking for something down in here to buy. I'd like to put a trade on right there. So see what's up. What do we got here? Today's Tuesday. We got Wednesday, and then what the fuck Wednesday, and then the actual print on Thursday. So yeah, some kind of weak ass shit, some kind of like panicking of the bulls, something like that. If I can grab that that downside move, I'll be stoked. All right, I'll be back with you guys in just a little bit.
About 1% as we speak, and we're going to watch for any headlines that come out of that meeting. today as well. Quick check on interest rates. 10-year, well, it's hovering right around 4%. You see across the board here, we're green there. It takes us to our talk of the tape, the outlook for stocks in this new year, and why one closing bell headliner says the risk reward for investors is now skewed positive. Let's welcome him in. He's Adam Parker. He's the founder and CEO of Trivariate Research and a CNBC contributor with me, as you can see, at Post 9. You're the headliner.
Yeah, baby.
Like
Let's do it. Let's do it.
So I know you've gotten more positive, but risk reward is now much better than it was, even with that big rally towards the end of the year. Why?
Well, as you know, last year we were positive too. I mean, it went up more than I thought.
Not this much.
Went up more than I thought. But I think the skew positive to me comes down to three things. One, I think the average company has a good chance their margins expand. And stocks work when gross margins expand. So that's one. Two, I don't think the Fed's going to cut 6-7 times between now and January 25. If they do, it won't be skewed to the positive. It won't. I don't think that'll be necessary. I think.
Oh, but you think if they do cut that many times, it's because
things got way worse.
They got bad.
Yeah. So I'm in the. I don't like the view of good news is bad for stocks. That makes no sense beyond like one day. I think good news will be good for stocks. And I think the third point would be, I think there's a reasonable chance that earnings grow for several years in a row, like they did from 2010 to 2019. We're a few years in that process now, and what looks a little expensive at 20 times forward or 19 times forward to get 10% upside, maybe we'll look a little more attractive as we start believing 25 earnings are above 24 and 26 are above 25. That's my base case, and I think that probably means the skew 6, 12, 18 months out is higher.
Basically, margins have troughed in your
it looks like
in your point of view, and that's ultimately that ends up being the key to everything.
Yeah, stocks work when margins expand. And I think that's the key. Obviously, it depends on pricing and mix in certain industries. It depends on input costs. But I think a lot of businesses are going to see pretty good productivity, lower input costs from commodities and materials, less, wage inflation. It's wage inflating at a lower rate and can be offset by productivity. Currency could help a little during earnings. So, dollar kind of weakened across the board last few months. I add it all up, and I think probably margins expand.
Does it matter how many times the Fed really cuts or when? I mean, I know you said if they have to cut 6 or 7 times, it means things get bad. But, given where inflation expectations are, we got that read yesterday. That was good.
Yeah.
It's trending in the right direction.
Here's the challenge I have, okay? When I look back I wanted to take a step back coming into the year at Outlook we just did and say, okay, if the ECB and the Fed are going to be accommodative, I don't want to be a jerk and fight that. We've learned the lesson. Don't fight, the Fed. But when you go back and you look at the last few times that's happened, it was TMT bubble, it was financial crisis, and it was COVID. Are you sure that this is the exact same period? It doesn't feel. This feels more like a mid-cycle adjustment, or we had some sort of. It doesn't feel to me like it's an acute problem that's going to need massive accommodation. So I don't think we're going to get 6, 7, cuts unless things get way worse. And my base case, from looking at economic activity, leading economic indicators, the strength of the consumer while eroding is still okay. Financial conditions. When I add all that up, it doesn't seem like we're headed into a COVID or GFC
But Fed funds are probably higher than right now than where they really need to be relative to where inflation is going. You think so?
Yeah, I think on a normalized basis, a 4% 10-year could be okay. The front end's trickier. We'll see. I think most people believe the curve's got to uninvert, right, at some point. When you go back again, there's insignificant sample size to evaluate the uninversion playbook, but generally it's bullish for equities too, right? So I think what you need to believe is the 2-year yield becomes below the 10-year yield. The economy is slowing but not tanking, and the average company's margins can still grind higher. If that's the case, equities will be, of course, they'll be 10%.
But I mean, isn't the risk, though, that the Fed waits too long to cut? How much risk do you think there is in that? Right? They snatch defeat from the jaws of victory because they wait too long. Like they waited too long at the front end, they wait too long in the back.
So I would answer that differently, which is I'm not sure how wrong they were on the front end. The part that I would be more critical of was, I think, still in early 22, the balance sheet, they were buying tons of mortgage-backed securities when housing was on fire in every market.
So what do you mean that they weren't too wrong in the front end? You've been criticizing them for that since we've had these conversations.
Well, I guess I don't know what they do, but I guess the reason I paused is because I actually don't want them to start cutting crazy. What I want them to do is, what I know is the probability they are accommodative is a lot higher than the probability they hike, and I like that dream right now. I like the dream of eventual accommodation. I'm not sure the reality of it is going to be awesome if it's because the economy is eroding a ton.
No, but it's because the inflation is coming down. Do me a favor, hold your thought real quick.
Yeah.
I got Phil LeBeau on the phone because we do have some new news regarding Boeing that we were watching and looking at how the shares were doing. And Phil, this seems to be all around how long it is going to take these airplanes to get back in the air.
It's indefinite, Scott. I remember yesterday when the FAA initially approved the inspection process for the grounded MAX 9s, the thought was, well, maybe later this week we start to see some of these grounded planes back in service. Well, within the last hour, the FAA has come back, and we've heard that this was going on for some time, a discussion between the FAA and Boeing. And the FAA has come out and said, look, we're going to continue talking with Boeing, looking at their inspection protocols, revising it, telling them what we think should be changed, what should be amended, and we're not there yet in terms of feeling satisfied with the inspection process. So the bottom line is this, Scott. If you thought those grounded MAX 9s were going to be in service tomorrow or Thursday or Friday, that's not likely to happen. I think we probably have a few days here at least where the FAA is going to say, let's take this and make sure that we have everything exactly as we want it before we tell the airlines, this is the exact process. You do this, you can put the planes back in service.
Yeah, we're going to watch these shares. Phil, thank you for that. The shares hit a low of $223 today, but you see a little bit of a move lower on the news that Phil was elaborating on, that maybe it's going to take a little bit longer until the FAA has enough confidence to let these airplanes back in the sky. But we'll continue to follow that over the final stretch. Boeing shares down 1.35%. I look at your, Adam, back to you. I look at your sector picks, and they don't scream, let's play offense, do they? I mean, energy, healthcare, utilities?
The way you make money and you beat the S&P 500 is you have to own high-quality growth stocks and then value that isn't quality now but is improving. And that's sort of how we're positioned. The S&P is such a big percentage of it is tech, and so even if you're market weight tech, you probably have 27% of your fund in tech. So it's not like we don't have offense in there. I really like software over semis. We have a tech strategy product at Trevariate, and our main call there has been to like software over semis for the first half of the year. NVIDIA is a little bit of an exception.
Why software over semis? Why?
Because you want to buy growth companies where growth is a little bit below average and improving. That's a lot of software. You want to avoid semis where gross margins are contracting. And because the inventory across the board for semis, 80th, 50th, 20th percentile, is all very high versus history, that impedes gross margin progress for a lot of them. So you own semis where you have low and accelerating, you own software with low and accelerating revenue, and you avoid semis where margins are contracting.
But you think some of this move in semis last year, which was the best year for the SMH in 20 years, was punk? A lot of these stocks just went up and they didn't deserve to.
Yes.
I do.
So? Yeah, I mean, there's some great businesses there. Obviously, NVIDIA having the biggest 2 upward sales revisions of any mega cap company ever, and some of the semi indices are price weighted, so it drove a lot of the performance in SOXL and some of the other ETFs. But there aren't that many pure beneficiaries. The inventory levels are very high for a lot of these businesses, particularly the industrial-focused analog companies, Texan, ADI, et cetera, very high inventory levels. So I think there was a bit of a, stuff went up that it didn't deserve.
Like rising tide just lifted every single boat.
Every paper.
Rowboats, motorboats, yachts, everything.
Everything. All kinds of boats. And at the end of the day, those companies, you saw Microchip, that's a kind of broad-based microcontroller industrial company miss. I mean, I think you're going to see those that have a lot of industrial and automotive exposure act poorly until the inventory gets a little bit under control. So their earnings don't collapse because the inventory isn't that perishable. It's just hard for gross margins to expand.
I'm looking at one of these so-called AI yachts, all right?
Okay.
Microsoft.
Yeah.
Is this correct? You say of your you have a short screen on Microsoft? What?
Well, what we're saying is software companies, and obviously they're more than a software company, but they have high revenue that's decelerating. And so what we show in our outlook is if you take a basket of software companies with below average growth that's accelerating and compare their subsequent performance to those that have above average that's decelerating, you make tremendous excess return in software. So that's a quantitatively derived screen that shows that maybe this isn't the best time to buy Microsoft. On the contrary, or at least try to consistent with that, we don't want to own big differences in the aggregate Magnificent Seven versus the bench weight. So if you want to be a little underweight, Microsoft and a little overweight NVIDIA to get your combo up there, that's kind of how we play. We tell people you got to own close to the market weight of the Mag 7, and Microsoft doesn't screen as one of the better ones right now.
Really?
Yeah.
Valuation in part?
Yeah, it's less the valuation, more the decelerating revenue.
Was Apple on that list? Talking about
Apple is also
revenue.
not. Apple is also not one of our favorite of the Mag 7. Yeah. So, but again, if you add up,
sound nervous admitting that.
No, it's on a short screen on a different page. You just didn't see it yet.
Okay.
Yeah, I just, I sent you 80 pages like 20 minutes before we came on air. So
yeah, I'm looking at it. I don't see Apple. I don't see Apple anywhere.
Well, yeah, so
conveniently left that one out.
No, we have to yell at somebody else, but
no.
It's in there. But
no, we don't. I probably missed it myself.
No, but our view is that again, you're close to market weight, the Magnificent Seven. Some look better than others. Software is generally, companies are investing in productivity. They're trying to fire people. They're trying to replace them with AI. They're going to be investing in security. There is generally software revenue growth and expectations is a lot more achievable, and I think semis have a problem. So I like that pair trade, admitting that they're going to be somewhat correlated if you get a big risk on trade.
All right. Well, we've left Nicole Webb sitting here listening to this whole thing. Thank you for your patience.
All right, will you fix me?
I'm going to fix everything.
Fix me and him.
Good to see you.
Good to see you.
Risk reward better for equities 20 and 24. Do you agree with that?
Yeah,
you can say no.
No, you
sounded a little apprehensive.
Right,
though.
she did.
Yeah,
you can say no.
I know.
Why?
The setup going into this year is getting. My concern overall is, even if so go back to 2023, we had above expectation growth doesn't translate into EPS growth. We look at the setup for 2024. There's so much consensus now around this idea that, well, even if the worst thing happens, which is we do go into this mild recession, then the Fed cuts and everything's fixed. And from our expectation, that's just a little bit of a fallacy. And when we look back at the meeting minutes from last month, there is still quite a few members who believe that, CPI comes in this week, we're 4% on inflation, we still have a 2% target, and rates hold longer than expected at these rates. And then you can make the case for, but we need to make sure there's ample liquidity come March. And to us, we don't want our clients to hear that we're so consensus that this is going to be a great year, that we're going to hit that 11% earnings growth estimate, that 2025 looks fantastic too, and that everything's just, it's so inevitable that it's soft and wonderful.
I'll tell you where she disagrees with me. You just put it on the screen. She doesn't think gross margins are going to go up for the average company. And I think that we talked off air for a bit. That's probably one of the biggest investment controversies. Okay, I think the average company can see margin expansion. You've seen margins come and trough for the last few months. And the analysts are not very good at estimating accurately. Yeah. But they're pretty good about knowing whether gross margins are up or down. They have about a 75% hit rate on it. More analysts have gross margin expectation expansion for 24 than most prior years. So I think that's where the rub is. I don't also totally agree with her that the consensus is universally bullish. Yeah. I think that's depends who you talk to. And
I feel like a lot to Nicole's point though. A lot more people have gotten bullish. I mean, even bears. I'm not going to mention any names on the air, but strategists who've been bearish for a lot and missed a lot are now bullish, or seemingly so.
Yeah, look, again, you and I have talked about it. I don't think those people just suddenly got dumb. You do that job long enough, you're bullish and right, bearish and right, bullish and wrong, bearish. You're going to be in all four quadrants. That's the life you live when you have to do that for a living. I think in terms of allocating, for private wealth or longer-term investors, I think it comes down to a belief margins are going to expand and earnings can grow for a while. If you believe that, I think the risk reward is positive for equities. If you think margins are going way lower or that they're at risk, then you're probably 6 months early buying them. I think that's the debate. Right?
But the other thing, Nicole, is what Adam said earlier is that you take almost everything out of it. It's don't fight central banks. Like we are at the end of the cycle. We are. Even if, in the unforeseen thing happens and they hike one more time, which seems completely unlikely, by the way. that the next move is going to be a cut. It's just a matter of when, not if.
Yeah.
Why isn't that enough at a time where inflation's obviously coming down, expectations are that it's going to continue to come down, and the economy's hanging in there?
So there's just a few data points that we hang on to as curiosity about what the setup really is for 2024. And so I'm just going to go back to the last jobs report. You have this propping up of the headline number by, healthcare and government jobs, where you see some of this destruction in cyclical jobs. And so, we start to go, well, what does that really shake out? And when we look at pricing and the company's ability to hold prices where they are, does that start to pull back? Does that affect margin? Where do you start to cut then to hold margin and hold it flat? Well, maybe that is your labor force. And so when we think about names, and I'm just going to go back to technology because they took a lot of their medicine over the last year, that was the first place they went. So to free up cash flow, to see that free cash flow acceleration, we saw job loss. And does that trickle through to some of these laggards of last year? And well, their numbers have looked good. Again, it's curiosity that maybe it's just not this acceleration into a bull market through the year. I do think something that Adam said multiple times is really important, and it's what we'll be listening to as we look at Q1 2024 earnings, which is productivity. And can we see an acceleration in productivity?
Well, we have.
And does it continue?
Are you throwing cold
Early
water
markets
on,
on close imbalance currently sitting at 2 million to the buy side.
Do I hear you kind of say that?
I don't. I think we ran up so fast at the end of last year that to us, we look at the setup today and we are cautious that the Fed doesn't cut as soon as about 50% believe that they will come March. Again, we can make a strong argument for the liquidity metric of cutting in March, but if we don't get it, if it isn't until summer, what kind of deterioration do we see? And then is it a Fed pivot that is necessitated by data, to Adam's point, which is actually destructive? So do they actually come in and start to cut and do it sooner rather than later, which is not often the way that they handle these situations?
Well, what do you like in the equity market right now, if anything?
Yeah. And so, I think there's a lot of curiosity around small cap and a lot of the acceleration we saw at the end of the year. When we look at the mid-cap sector, we like it more than small cap. We like the industrial makeup of mid-cap. And then a lot of small cap is a lot of these regional banks where we think actually the large banks are trading at a relative value similar to the small cap or regional banks. And so why not pick up the bigger names?
Well, because you get the re-steepening of the yield curve, too, like Adam was talking about.
Right. And we believe that you'll actually see a pickup in IPO business and M&A transaction. And so if investment banking can pick back up and you don't see the consumer side of banking deteriorate, then, I think you can make a really strong case for financials.
The way I see it, and it's obviously the devil's in the details, but I think if you own large cap banks and you own mid caps X banks, and that's your way to beat the index, I don't think you're going to do well if the stock market doesn't do well. Like, I think you need, I'm trying to square that with your economic view, because to me, mid caps, like, you need to believe the margin expansion story to be there, particularly with the industrials and the like. If you sound positioned more bullish than your upfront rhetoric to me.
And let me make this one item very, very, very clear.
Yeah. Do you agree? Not to play the Wapner role, but...
well, I don't need to agree with it or not.
Oh, no, but I'm saying...
I actually agree with what you're saying, and what we want right in the private wealth space.
Yeah.
It is so important to not have the messaging of risk on versus risk off.
Right.
People who went into January of last year stood on a pedestal and said we are risk off. They were wrong. And there is still the opportunity for there to be multiple possible outcomes in 2024. The bull case, the story behind it, it is there. It is there. And that's where we talk about, okay, well, look at all of the opportunity set, look at the laggards, look at the equal weight S&P, look at the opportunity in mid-cap. That is true. And you also need to look at what if the rest of this doesn't play out the way that it is priced into the market today. And that is, I think, more of what my messaging is in an attempt to say is you have to be mindful about your positioning, that
it isn't necessarily guaranteed to go one direction?
I'm more bullish. I'm more bullish than that. I think we look back 12 months from now, the market's higher, and you're believing that 25 and 26 are going to be better. And I don't want to fight the Fed and the ECB and the BOE, who are all going to be accommodative at the same time. I'm worried that there could be a month of a harsh sell-off, because if they really start cutting a lot, it's because things got worse. But once they start the accommodation, punch me in the face if I am bearish against all that accommodation. So I'm more bullish.
All right, we're making that note.
Yeah.
You got that?
Gently.
Right.
Punch me in the face with gently.
All right.
It's not a great, it's a radio face.
Our senior, Lawrence, he just wrote that down.
You got that down? You can punch me in the face, not him. All right.
All right, we're going to leave it there.
Yeah.
No punching anybody in the face yet.
Right.
Guys, thank you. Nicole, thanks. Adam, thanks. As always, let's send it to Pippa Stevens now for a look at the biggest names moving as we head towards the close. Hi, Pippa.
Hey, Scott. Well, Juniper Networks surging more than 20% following reports that Hewlett-Packard Enterprise could buy the company as soon as this week. The deal is valued at about $13 billion, according to the Journal, citing sources. Shares of HPE, though, sliding about 8%. And Unity Software dropping 8% after the company said it will cut roughly 25% of its workforce, or about 1,800 employees. Executives didn't provide estimates around the cost, but expect the charges to be incurred during Q1. Piper Sandler noting it could help Unity hit its financial targets, but on the flip side, growth trajectory is now less certain with product shutdowns. Scott?
All right, Pippa, we'll see you in just a bit. Thank you, Pippa Stevens. We're just getting started here. Up next, Skybridge's Anthony Scaramucci's back with us. We're going to get his take on that looming Bitcoin ETF deadline. SEC's supposed to make a decision by tomorrow. We'll see what happens there just after the break. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC. We are back. The price of Bitcoin surging nearly 70% over the past 3 months alone as expectations rise for potential approval of the first spot Bitcoin ETF, with an SEC decision expected this week, soon as tomorrow. Joining us now, Anthony Scaramucci. He's the founder and managing partner of Skybridge. Good to see you. Welcome back.
Thanks, Scott. Good to be here.
Is this going to happen?
Well, we have every indication to believe it would happen. I think you have to remember something about the SEC. If this wasn't going to happen, I think that would have been telegraphed into the market. I'm not saying they're as good as telegraphing things as the Federal Reserve, but they're pretty good at it. And so some of the big issuers that I've been in touch with believe it gets announced tomorrow, Wednesday, after the close, with potential trading Thursday or later in the week.
Yeah, you obviously have a dog in the fight because you were an early investor in BlackRock's product. Why'd you pick that one?
Well, at that time, they were having, Bitcoin was in the doldrums. It was a bear market. The team over there, they were looking for an outside investor. And so my partner, Brett Messing, I'm going to butcher Robbie's last name, but I think it's Medichek or Midichek. If he's listening, I'm sorry for the butchering of your name. But my partner, Brett Messing, met with him.
Sounds like a close partnership.
Yeah, no, sorry about that, because I'm drawing a blank. Probably the high altitude, Scott. But in any event, we put some money in there to help them get it started. And the good news is I think they caught
early market on close imbalance, still sitting at 2 million to the buy side.
ETF application, so I do think that this goes through.
Do you, when you look at the players, I mean, we're showing the list right now, Anthony, on our wall back at our headquarters, and I obviously have them in front of me. It looks to me to be at least a dozen on this list. Is that too many? Are there going to be more? I mean, how should we judge the number of players who are trying to get a piece of this action?
It's a good question. So we stood down. We had an application in 2021. It got rejected alongside of Fidelity's application. And I think that the 12 of them will probably garner the market share. And those 12 will likely, once due diligence goes through at the wirehouses, Scott, they'll end up on the platforms. I think this is a seminal moment for Bitcoin because most investors didn't want to open up an account or store it on their own personal wallet. They would prefer the storage in a brokerage account, and the ETF allows them to do that. And so this is sort of a SEC-approved wrapper of Bitcoin. And I think it opens up a window of opportunity for the Wall Street, those 12 that you're referencing, to go out and market the idea to their best investors.
How much of the run-up in Bitcoin towards the end of the year, we mentioned the gains are incredible over the last 3 months alone, and it was, of course, the best performing asset class of last year. But more recently, let's just pick over the last 3 months per se. How much of the gain there do you think was due to the expectation of these ETFs? And then some now suggest that you could get a sell on the news. What do you think about that?
Well, look, it's very hard to predict this stuff. I've been humbled by price predictions in Bitcoin. So if there's a sell on the news, though, I'll be surprised because there feels like there's several $1 billion of market demand. And remember, those 12 issuers want this to get off to a strong start. And I do think they have pent up demand. But you're asking a good question about recent appreciation. Remember, Bitcoin peaked at 68 or 69,000 in November of 2021. Scott, when the Bitcoin futures was approved, and I would have thought Bitcoin would have gone way higher, but we had a horrific year in 2022 where I think it landed around 16 or 16,500. So it's been a humbling process, Bitcoin. We entered the space in 2020. We like it long term. We think Bitcoin could eventually be the same or up there with the market capitalization of gold. That may take a decade. But it's very, very promising. And the fact that the SEC is going to allow this in brokerage accounts, I think this is meaningful. And you and I both know Wall Street. Now that Wall Street's involved, they will sell this product to their best investors.
Yeah, there's no doubt about that. What about the relationship with interest rates and Fed policy? If the Fed is done hiking and now rates are going to start coming down, obviously Bitcoin appreciated a lot last year as rates were elevated. How does that relationship go forward from here, do you think?
Well, listen, I think more liquidity in the markets is better for Bitcoin. The people that are studying Bitcoin and doing the work on Bitcoin recognize it as a digital store of assets. They see it as a digital form of gold. And so if there's laxity in the interest rate cycle, that means there'll be more liquidity. And I think that will be better for Bitcoin. It'll find its way into more model portfolios. But I was interested in the debate you guys were having prior to the debate. I don't want to punch anybody in the face, but I do believe that you guys are going to be right on rates. If rates go lower, it's very hard to fight the stock market. I guess I'm just worried about the top heaviness of it. Anytime we've seen this level of concentration at the top, there's been sloppy forward markets.
Well, I mean, it has broadened out. I mean, that was one of the principal stories to end the year, right? The fact that what was an incredibly top-heavy market suddenly became everything goes up, so to speak, except for energy. But you know what I mean? Like the Russell started working, and all these areas of the market that lagged started working again. The question is, does that continue into this year?
Listen, I think I read this morning that Microsoft has a larger market capitalization than the entire Canadian stock market. So yes, you're right, it's moved a little, but there really has to be, I think, a more even market if we're going to have a successful bull run over the next 2 years. Listen, tech got demolished in 2022, the same as Bitcoin. So there was no surprise to me that there was this residual reversal. But I think you have to worry as a long-term experienced investor about these concentrations. And I like those names. I think they're great long-term names. But I think that's got to be an issue for people. But
Early
listen,
markets on close imbalance still sitting at 2 million to the buy side.
Of the market, and you don't want to fight that.
And then Adam Parker will be right. Anthony, I appreciate it. Good catching up. Take care. We'll see you soon.
Good to be here. Thank you.
All right, that's Anthony Scaramucci, Skybridge, joining us as we expect the SEC to make that decision in the next 24 hours or so. Up next, big money advice, more of it. Rockefeller Capital's Angela Mwanza is with us. She advises ultra high net worth clients. She'll tell us how she's helping them navigate the year ahead. Closing bell coming right back.
All right, so we're coming into hold on a second, I'll move this stuff over. Whoop, put that over there. Oh, I gotta turn that fucking camera on. Does that work? All right, there we go. So, put that right there. Make that smaller. Okay, so let's take a quick look around the market here before it ends for the day. Can I mute that? Why is that thing not all the way over either? That needs to be over there, I guess.
We're back. NASDAQ, the only major average, is fighting to stay above the flat line today. NVIDIA reaching an all-time high. And my next guest is advising her ultra-high net worth clients to stay invested in mega cap tech this year. Let's bring in Angela.
Okay. I'm going to take a quick look here at... Did I look at SPX here? Does this have nope, hang tight 1 second here. I don't know why this isn't on there. Hold on 1 second here, we're having some issues. There, okay, show that. All right. I'm gonna go over here really quick. So this
market on close imbalance, 1.3 billion to the sell side.
Ooh, maybe we'll get the 4 billion to the sell side trigger at some point. That's not an imbalance for the total for the close here, but that's good for what I'm thinking here as well, or at least. So right now we're on the 1 minute trigger. We're going to switch over to a 30-minute trigger here. And we want to see some stuff here, right? I'm going to expand this up for you right now. So there's some important things I want you to realize here, okay? Key levels for you. 47.30 right here is the gamma flip. You can snap this at home if you want. I'm going to snap this at home for yourself. And it's important for you to understand here that here's your gamma flip, right? Remember earlier this morning we talked about if we can catch the bounce off the hourly trigger, if we can bounce up here and start to consolidate the top of the key to make this run higher, all is good, right? High five, everything is awesome, check mark. Now, inside of this close here, the last 13 minutes or so, right? I had said to you, yeah, you might get just one more dip buy down here, right? Now, on the half-hour trigger, you should have already bought it. If you wanted to DCA down here to buy that rip above, that makes sense. That's at 47.34.82, okay, on SPX at least. We'll look at SPY later, but basically, you want to be buying this to be going up, okay? Now, the key point here is see where this gamma flip is. As a bull, as a buyer, you want to be buying this stuff. This is where you buy. You buy the half-hour trigger, you DCA the hour trigger to go up and trade this ATH on SPX, right? So there's the all-time high on SPX. You see it there, right? Somewhere up in here. There's your 4,800, and you want to be trading this, right? You're not trying to trade this. You're not trying to buy dips underneath the hourly trigger, right? See the hourly trigger? You're not trying to buy dips down here. You're waiting for a turn, right? Waiting for Cap to tell you, hey, we're about to turn around and head to the upside, right? So just right here, looking at where we are, you should be buying these dips with stops underneath. Now, the key point here is you have stops under here, okay? And I'm going to tell you that because if this does fail, right, your stops are under there, because if this does fail in here and we don't go higher, this is a pretty major rejection, right? This is telling you that we have more sellers here than buyers, right? If we have more sellers here that are able to overrun these buyers, where do we go? We go at least down to the last known bottom, right? That's right here, right? We at least go down here and test this, okay? So you at least come back down and test this. right? And more than likely, if we reject here, it's actually not this lower. It's actually the next stop to the downside. So you've got the gamma flip for negativity here, right? And if we are going to go lower than this previous low here, that means we're going to erase all this. Your first target would end up being right about here. Your first target right here. And then your second target is likely somewhere down in here. You had demand right here, demand down here. Somewhere down in here, you likely have the real dip buy down in here. Somewhere down in there is the real dip buy. So when someone's telling you, someone's telling you, be careful, right? That's 4,500 down there, right? So if there's a failure here, you'll likely at least retest this. And more than likely, because you failed there, we want better support, more support. So there and more deeply right there. So this is your place to buy the dip. This is your place to sell the rip, okay? Selling the rip down here, selling the rip down here. Don't be buying the fucking dip way up there and all that other stupid shit that you hear out there in social media and stuff like that, okay? And I want you to be thinking about that. Be thinking about this gamma flip right here, right? That this is the bottom for bulls, right? They bought this dip down here, looking to keep buying this dip to go to the upside. Where are the expectations for upside moves here, right? You first have to beat this one right here. You got to beat this bad boy right there. Right? But not too bad, right? You just want to beat this previous high, make a new high, prove that you can go higher. Your next target is right up here. Right? And then your last target, of course, the last evil guy that you try to beat up here is right here. And so that you can make an attack for these all-time highs up in here, okay? There is some expansion to the upside. We've got an expansion here to 48.50. We have an expansion here, believe it or not, to 4,900. And that's the top of the market right now is 5,000. So there's expansion up there. It's not exactly where we want it, but there is expansion, okay? I made a post earlier today for bears, and I said to bears, if you were going to take a bearish stance on a yearly low, I said you would start your first position right here, right? Or right here. This works. Either one. Doesn't matter. Somewhere in here. Your second position would be up here at that 4,900. And your next position would be somewhere up in here, right? So the idea is no matter where we go, you're expecting the roll down. You go up here, expecting the roll down, or even up here, expecting the roll down. You'd cut the long side of your trade off and leave the short side of the trade on these two as you add this last one to try to capture this. Now, if you rein in your expectations for downside moves in here and this move to 5,000, you only need to go to 4,700. So either you're going to go to 4,700 here, you're going to go to 4,700 here, or you're going to come back up here. You're not even asking for 4,500, 4,000, any of that kind of stuff. You're just trying to capture all of this as a bear. Okay, so if you're bullish here, you're like, hey, we're going up. I'm a bull cap. I ain't no fucking seller. Suck my balls. You know where to buy the dip. It's right here. Your target to the upside is just above 4,800 and an all-time high in SPX. If you're looking for a trigger to sell above this, there are two reasons to sell above this. The first one, of course, is all-time highs on SPX. The second reason would be just the psychological impact of 4,900 and 5,000 up here. These are going to just be auto sell levels coming out from algorithms that want to sell 4,900. Then as we approach 5,000, you're going to get that kind of sell. So this is all quarterly stuff right here. So now there's something else to be said about this as well, that they could grind us in here, right? They just grind us. Then they make the move when they feel like it. All your calls are dead this week. They make the actual move on Monday. That's possible as well. So if you're taking if you're buying weeklies or anything like that, and you are bullish, always consider a call spread, or always consider, or at least where we are, consider putting some time on some calls that you can absorb some theta, some time decay, some premium decay, all that kind of stuff, so that you can actually make that monkey hook to the upside. It's possible they can just grind you. Right, you're all your calls are fucking dead. Then they make the move up. Does that make sense? Think about that too. So if everybody's loaded to the tits on calls right here, they might not make that move today. They might make it on Friday. They might make it on Monday, something like that. So just be aware of that. How dealers end up doing this. If everybody knows we're going up, they will murder everything. Then they'll come back and actually do what they want you to do. Hold on 1 second here. I got another beep. So this is for end of the day stuff today. If you want to take this up into the close, if you want to take this up for a Friday print, to get up there and beat all this stuff into Friday, that's all fine and dandy. Just know where your stops are, know where your gamma flip is, know where your dip buying is, and know what you're trying to do to get lower if you're a bear. Now, if you're a bear, right, I want to make one last point here. Let's say this sells and rolls down, okay? We break that gamma flip. Remember, you have to then confirm a rejection to the downside. So that hourly moves over, right? This hourly trigger, let's say it rolls down here, right? Hold on, we'll just go back in time here. Let's say that hourly trigger, let's say price starts to bleed off. We're wrong. It's a double top. Everything is doom and gloom. You can't go short right here, okay? You got to fucking wait for the recheck to go short. You just wait and stand by right here, because if you don't do that, what happens is you get fucking bent over and you lose all your money. This is where you get bent over, not waiting for the rejection and roll lower, okay? So you're like Johnny on the spot right there, Johnny on the spot right there, Johnny on the spot right there, Johnny on the spot right there. You're not picking these. You're in here waiting for the rejection candle on a half-hour basis, and then you're jumping on board for the trip down. You guys understand what I'm saying here? Hopefully, let me see if you guys getting all this. Make sure in the chat here. Tell me in the chat if you understand where I'm coming from with this stuff. You guys understand? Let's talk about inflation data this week. I'm going to tell you guys the truth here, okay? Someone made a good point about inflation data coming out, CPI, PPI. I'm going to tell you guys something here, okay? I want you to look at the inflation data and think about what the Fed and Treasury Department wants, okay? The Fed and Treasury Department likely does not want a cool inflation print right now. They don't want to drive us down to a fake or a bullshit 2% year-over-year inflation right now. Now, they likely don't mind it as we get closer into the end of the year towards the election season. So I'm not going to expect us to be beating inflation in a aggressive way. Keyword there, aggressive way. Anytime from now into at least October, November, at least that time period. Now, if they do stop unfudging the numbers, or no, even more fudge the numbers, and you see some kind of a cool print come in where we're blasted, even if it's their line, doesn't matter. If they show us an inflation print that's like at 2% year over year, and we fucking hard bounce and then get a hot inflation print, stuff like that, we will entertain that conversation of a Fed rate cut at that time. Until then, expect peak fucking fraud right now in this market. Peak fraud from the Fed, peak fraud from the Treasury Department. You know, if there was fraud going on, this is the ugliest it'll be, uglier than anything in COVID, because they were honest about it in COVID. They told you what was going on. If right now they have to be in this peak period of if I was a Fed and Treasury person, from what we've seen this far, their whole thing right now is manipulate the inverted yield curve, manipulate unemployment, manipulate inflation, and hold rates until we get through the election. Looks like the thesis, and that's what, to an extent, what Jerome has at least said in terms of rates. Higher for longer, no rate cuts anticipated until December 2024. He's made those fucking statements. Stop listening to the little Fed guys, girls, whatever they are. Don't they, them, I don't care. Don't listen to those people. Be listening to Fed Chair Powell and know and be aware that they're pumping money into the economy. You know that the Biden is pumping money into the economy, right? They're spending money like fucking crazy. That's QE, okay? They're lending money right now to fucking hedge funds to long this market. You can see it in the price of the stock market right now. So be aware of this stuff. Please have that at least that have that story in your head as you get these numbers. And the reason I'm saying that is because if the numbers come in against this thesis, you can act on that. If the numbers come in with that thesis, you can act on that. That's why you keep that thesis, not whether it's right or wrong, but you must have that thesis because they're running with that thesis right now, and what they're doing, all these numbers that are coming out and the rates not being cut and not being increased all fit the story and have fit that story and that narrative since about July. So you guys see me get mad in these rate decision meetings, right? How angry I am because I'm like, they're in the corner, they're in another corner, they're in another corner. They're just weaseling their way out along the way. Before you know it, we're going to be into October and December of next year, and this will be all over at that point. And that thesis will be dead, hopefully. So just keep that in mind as those prints come out as the week progresses, okay? Keep that thesis in mind. You don't, especially if you're a seller, if you're a doom bear, crash bear, that thesis is more important to you than it is to me. For your thesis to sell the market, why we're selling, how deep we're going to go, that kind of stuff. So if you see a shift if you see a shift in what they're reporting for unemployment and inflation numbers, velocity in unemployment, velocity in inflation coming down and then bouncing to the upside, just velocity in those reports, like super hot, super cold, that kind of stuff. That's a pre-prediction of rate cuts. That's an actual pre-prediction of, hey, they might start cutting fucking rates soon. Otherwise, expect that fucking fraud scam to continue on into probably the deep part of this year. Make sense to anybody or no? Am I even streaming anymore? Did I already end the stream? I don't know. It's 4:05 right now. We're going to get out of here, but I do want you guys to understand where we're at with this into tomorrow. Right now, we look like we're setting up for a gap up into the overnight, trying to trade that all-time high in SPX. Yeah, right, exactly. So at least you guys are here. At least you guys are here still listening right now. So that's my take. If you guys want my take on the end of the week, what I expect, I really would like to buy a dip lower, if possible, any point this week. But expectations are to the upside into or at least Thursday close, something like that. Trying to at least attack this this prior high that we have back here by close on, if possible, by close on Thursday or Friday to get up there and at least get up there and do some funkiness up in here. Try to park our asses. Now you're going to hear a bunch of bears up here also tell you that that's a major double top, big time. But we have a double top here too, right? So now we have another double top. We got a cup and handle going over here. Bull's going to tell you it's a cup and handle. It's going to push up even higher over there. We'll trade it as it comes. Trade it as it comes. Yeah, thanks for staying late, guys. I appreciate it. You guys have more market awareness probably anyways by understanding all this stuff. So what else do I got for you here? I think that's it. I'll catch you guys all tomorrow at 9:30 in the morning. I appreciate you showing up all day long today. Be cool, man.